Hi friends, a small intro video before you see the main video. Uh, these are concept revision videos for AFM, costing, or FM. Objective is very simple. Learn concepts with limited amount of time. Post concepts, do practice. These are applicable for first time learners as well as new learners, and these are taken from my regular or exam oriented sessions. Now you move to the main video. Okay, I'll move to security valuation now. This is technically not a single chapter. It is like two, three individual chapters which ICI has clubbed and made it as a single chapter. Ideally, this could have been broken down into multiple sub chapters. And this is the chapter which is going to take decent amount of time in our discussion also. Normally, I take around 2 days of discussion just for this one chapter because it's not a single chapter. When we start solving questions and revise internally also, I will do one part, revise that fully, and then we'll ignore it. That's all. Because here, this chapter alone will have 100 concepts, around 100 concepts will be there. Let's start understanding this. Security valuation basically means valuing any security. Security is a financial security. It could be equity, it could be a bond, it could be a hybrid instrument, it could be a money market instrument. Any instrument whose valuation is to be done is what we are learning here. Indirectly, I also have another valuation, which is business valuation, where some of these concepts will again get discussed. We will start going through first equity valuation, understand part of the equity valuation today, continue with equity valuation discussion in the next session as well. Some miscellaneous areas are also there. One area is called rights issue and buyback, and a small area called enterprise valuation is there in this chapter. We start with time value of money concepts, not very critical. I may not spend much time also on this. This is learnt at CA Inter as part of time value of money chapter. Practically extremely important concept. Here we have something called as future value. What is future values? Today's value, I take it to a future date. To take it to a future date, we do something called as compounding, multiply with 1 plus r the whole power n. You want to bring it to today, divide by 1 plus r the whole power n. Annuity means it is the same amount which is received or paid over a specified period. You want to take it to the future value, you multiply with future value annuity factor. You take it to today, you want to multiply with present value annuity factor. How is PVAF calculated? I'll explain maybe later on when we do question. FVAF is not that critical. We also have something called as perpetuity. What is perpetuity? Is there is no end to the cash flow. To value perpetuity, you will have to use your Gordon's formula or your cost of equity formula. What is cost of equity formula? KE is equal to D1 by P naught plus growth rate. Growth rate comes to the other side. KE minus G is equal to D1 by P naught, and P naught is equal to D1 KE minus G, which is what that formula. Cash flow 1 divided by discount rate minus the growth rate. Discount rate is cost of equity. Also, the annuity concept can help me in calculating something called as a loan installment amount. How can it help in loan installment amount? Concept is very simple. Loan amount is technically present value. Loan amount is technically present value is equal to annuity amount into present value annuity factor. Any loan you want to calculate EMI or equated annual installment, it is all through annuity factor. I'm not spending much time on this basics part. At home, I would 100% want you to complete these 7 examples which are there just to get little bit grip on this. Also in the same chapter, you will have ratios which I will not touch upon today itself, but I want you to go through ratios also and do the MCQs below the ratio. Now we start with equity valuation. In the equity valuation, there are multiple models of equity valuation which are there. The value of an equity share is arrived through the dividend paying ability of the share and the growth ability of a company. There are businesses which do not pay any dividends but still command good valuation. And there are businesses which pay steady dividends also. So a value of an equity share is because of two reasons. One, how much can you grow? And second is how much dividends can you pay? One classic example, Microsoft, which did not pay dividends for a very long period initially because they were growing at a rapid rate. So a growing company will command a good valuation. Also, a company which pays dividends will command. These are the two reasons I invest in a company. One, I expect dividends from them, or second, I expect capital gain from them. These are the two reasons we invest in a company. One principle of valuation which you need to be aware. This is something which should be very, very clear to you. Value of any asset you want to value. I want to value this pen which I have with me. How do I decide the value? You may say it's 2000 rupees, 3000 rupees. Logical value approaches present value of future cash flow, present value of future cash flow discounted at my required return, discounted at my required return. Somebody can say that this pen gives me some cash flow. Or let me take an example of a taxi. I am a taxi driver and I have a taxi. This taxi is going to give me some income. So what I need to do? Year cash flow. First year, taxi will give me 50,000. Second year, 2 lakh. Third year, 3 lakh. How will you calculate? Capital budgeting. You will learn calculation of cash flow using capital budgeting logic. Equity share. First year, how much dividend? Second year, how much dividend? Third year, how much dividend? Fourth year, how much dividend? At the end of fourth year, I'll sell it. At some stage, I'll have to sell it because it's infinite. There is no end to an equity share. Get year and cash flow structure of any asset. You want to value this building. First year, rent income. Second year, rent income. Third year, rent income. Fourth year, rent income. At the end of fourth year, sell it. Laptop, first year, benefit out of the laptop. If I can value, if you can decide that this is an income generating asset, put a value for the income which you generate. PVF at, what is PVF? Is discounting. You will discount this at 10, 12, 15, 18, 20, 25. What is this 10, 15, 12? This is the return which you expect from this asset. How will this be calculated? You will understand about something called as a CAPM approach. All that we will discuss. But basic logic is, what return do I want from the asset? If you give money to State Bank of India in the form of FD, you want 6% return. In the form of equity, same State Bank of India, you want 15% return. Same State Bank of India, FD you say you want 6% return. So if you want to value an FD, year cash flow PVF at 6%. You want to value a equity share of SBI, year cash flow PVF at 15%. PVF at 15%. Whatever return you want, this concept should be very, very clear to you. Any asset you want to value, because I'll discuss this in business valuation also. Anything you want to value, year, cash flow, PVF, DCF. This pen cannot generate cash flow. You cannot value using this logic. Use some other logic. There are multiple ways of valuing. Some other logic you use and then value. I want to value Bharadwaj Institute. Year, cash flow, PVF, DCF. First year, PAT plus depreciation 10 lakh rupees. Second year, 15 lakh. Third year, 20 lakh. Fourth year, 25 lakh. At the end of fourth year, we'll be selling Bharadwaj Institute to an investor. Let's assume I can do something like that. Year, cash flow, PVF, DCF. Once you are able to decide the structure, you can value any asset. Post your qualification, you may work some around, if you are at all you're working on valuation. Core concept is this only: year, cash flow, PVF, DCF. Whatever P multiple you do, whatever is the valuation, core concept is it generating money or not? Amazon, there is a value for Amazon. It all depends on what cash flow Amazon can generate. If money cannot be generated by a business for a very long period, value will start going down. Byju's had a huge value. Suddenly value started going down. Now almost very negligible value. Reason is cash flow generation is not happening. Concept is very simple: year, cash flow, PVF, DCF, best method of valuation. This is called discounted DCF method. They use the name DCF, method. Can I use DCF for debt? Yes. Can I use it for equity? Yes. Can I use it for hybrid? Yes. Can I use it for money market? Yes. Can I use it for land, building, plant, machinery? Anything you can value, as long as it generates you some income. I am buying a car for my usage. You cannot value that car. You cannot value that car because it is not generating cash flow for you. If anything which generates a cash flow, I want to value laptop. Yes, it generates cash flow for me. I can do it. You are buying a laptop. It doesn't generate for you. You cannot use this logic. Clear? Understood this first core principle? Year, cash flow, PVF, DCF. Keep always this in mind. At few places you are not able to do anything. See whether this can be done. Year, cash flow, PVF, DCF to value an asset. The logic of that will be used at many places. First model of valuation we have is Walter model. Not very critical from an exam point of view, but still it is discussed at inter level, again discussed at final level. What did Walter say is value of a company comes out of two reasons. First reason is dividends which are paid. Second reason, dividends which should have been paid but you retain and you are going to give this money later in future. First reason is dividends. Second reason is retained earnings. Why retained earnings also gives me a value? Because instead of giving me this money today, you are telling me I'll give you something excellent in future. That is what Microsoft did. They did not pay dividends for a long period with a hope that they'll pay huge money in future. People may be okay with it. So first part is dividend, second part is capital appreciation. Plus this is the value of the company. First part is called D by K. Where is this formula coming in? The formula is coming from this. K is equal to D by P naught. Ignore the growth rate for the time being. P naught is equal to D by K. D by K. No D1, D0 headache here. You will see that as we proceed in Gordon's model. D by K. This is one part of the valuation. Second part of the valuation is I retain some money. Whatever money I retain, this retained money can be extra beneficial for me or can be a disadvantage for me. What is extra beneficial and disadvantage? Whatever I am retaining, I will multiply this with a number which can be greater than 1 or less than 1. I'll multiply this with a number which can be greater than 1 or less than 1. Like I said, when I do capital adequacy ratio, we attach a risk weight. For the retained earnings, the model says that you can multiply this with 1.5, 2, 2.5, 3, 3.5, 4, or you can multiply with 0.5, 0.2, 0.1. Either you give huge value to this number or you give a lower value. What is that value? That is called R by KE. What is R? Return on equity. What is KE? Cost of equity. What is cost of equity? Now, for this chapter, you are the shareholder or investor and I am the company. So, what is cost of equity? What you want? You want 10%. I am an excellent company, Microsoft. 25% I am generating. Return on equity, 25. If I can generate 25 and you want only 10%, I'll not give you any dividend because I will retain the money and give you huge money in future. Give you huge money in future. You want only what? 10%. And I am capable of generating 25%. So whatever I retain has a multiplier called 25 by 10, 2.5 times value you give for that. 2.5 times. Whatever is the profit earned. If 10 rupees is earned, you can put 4 here, 6 here. You can put 2 here, 8 here. You can put 0 here. You can put 10 here. Whatever you paid is into 1 only. There is no extra benefit. Whatever I retain can have a multiplier of 1, 1.5, 2, 2.5, 0.5, 0.2, 0.1. What is that multiplier? R by KE. Logical. If that multiplier is more than 1, retain money. If that multiplier is less than 1, pay out the full money. Pay out the full money. Terms used. D means dividend per share. How will you calculate dividend? Total dividend divided by number of share. EPS into payout ratio. What is EPS? The profits generated by the share company into payout ratio is called dividend. Into retention ratio is called retained earnings. Dividend rate into face value. Dividend yield into market price. Multiple names can be used and we have used this term dividend rate, dividend yield when I did mutual funds also. Second part, return on equity. There are different names for this. You can call return on equity. You can call it as IRR. You can call it as rate of return on investment. You can call it as rate of return on retained earnings. You can call it as return of the company. Different names are there. How will you calculate? EAES divided by equity, or EAES if you divide by number of shares is called EPS. Equity if you divide by number of shares is called book value per share. So you can calculate ROE using this formula, which is EPS divided by BVPS. Third part is called earnings per share. What is earnings per share? We have done so many times. EAES divided by number of equity. What is EAES? PAT minus, we have not done preference dividend, but preference dividend may come in few questions. PAT minus preference dividend divided by number of share. Once you get this number, that is called earnings per share, or you can use this formula also, ROE into BVPS. Where is this formula coming from? ROE is equal to EPS multiply BVPS. What is KE? What do you want? What do you want? There are other names for it. What is your required return? What is your opportunity cost of capital? Or what is rate of capitalization of the company? Our cost of capital can be cost of equity if it's a 100% equity company. Our equity capitalization rate, different names I can use. I can use different names for this term. Any doubts till this? Any doubts on this? So I have dividend, which is total dividend by number of share, or I can do EPS into payout ratio, dividend rate into face value, dividend yield into market price. All of this is learnt. Okay, it's not new. It is done at CA Inter itself. Return on equity, other names are there. IRR, rate of return on retained earnings, return on investment, EAES by equity, or EPS by BVPS. Earnings per share, you divide by the number of shares and get EPS, or multiply ROE into BVPS. Clear? Now, why are we doing this? Two numbers. One is your return on equity and cost of equity. To multiply here R by KE into E minus D. Clear? Any doubts on this? First MCQ example, you will do it along with me. EPS 10, payout 25%, cost of equity 10%, return on equity 5%. What is the price of share as per Walter model? Straightforward, simple question just to get started with. I have to calculate price of the share as per Walter's model. Write the formula. Price equal to D by KE. D by KE plus R by KE into E minus D. Both have common denominator only. Somebody will ask, can I club it together? Yes, you can club it together. Why I explained as two separate parts? To explain the logic. First part is dividend. Second part is retained earnings or future capital appreciation. Retained earnings are future capital appreciation. Microsoft for a very long time, D by KE was 0 because they were believing in R by KE into E minus D. When growth options came down, they started paying dividend. They started paying dividend. How much is the earnings here? 10. Payout is 25%. So 2.5. Cost of equity is 10%. 0.10. I normally write decimal only. 0.10. R by K is 0.05. 0.1. 10. Here that multiplier is 0.5. 0.05 by 0.10. Whatever you're retaining, no, market is giving only half value for that. Market is giving only half value for that. Reason is you are saying give me 10% and I am telling you I'll give only 5%. Now you will fight with me and say that give entire 10 rupees as dividend. Give entire 10 rupees as dividend. What is the point of retaining the money when you can't earn even 10%? That's the discussion. Point is very simple. 10 rupees is there. Either I can keep it. I am the company, or you can keep it. You are the shareholder. If I keep it, I earn 5%. If you take it, you earn 10%. Obviously, you'll take the money and go away. So here it is 25, this side 37.5 put together. If the same company instead of 2.5 had done 10 by zero point 0.1 plus 0, no retention, it would have been 100 rupees. It would have been 100 rupees, no retention, zero retention. Entire money take it. 10 by zero point 0.1 would have become 100. Any doubts in this? Clear? What is the appropriate dividend payout ratio? Appropriate payout ratio depends on who can earn more money. If you can earn, what is you? KE. If you can earn, take entire money with you. If I can earn, what is I can earn? ROE. If I can earn, I will keep the entire money. Both are same. You take it, I keep it, indifferent. So if R is greater than KE, Microsoft in the initial years, zero dividend. If R is equal to KE, any amount you can pay 10, 15, 20, 25, 30, whatever percentage you pay. And R is less than KE, it's a declining scenario. It is a declining scenario. This scenario, pay out 100%. Last problem which I did know, we should have paid 100%. We should have paid 100%. Clear? Any doubts on this? Practically, companies won't go to the extreme of 100, won't go to the extreme of 0 also, but this is a concept is, if you have projects, if you can put money to good use, keep it. If you cannot put money to good use, give it to the shareholder, they will put it for good use. Clear? Total earnings 1 lakh, number of equity share 1 lakh of 10 each, P multiple 8 times. The company is currently following 100% payout ratio. What should be the optimum payout? Optimum payout is comparing R and K. Comparing R and K. Nothing for you to write. When you have to write, I'll explain. What is R? EAES by amount of equity. EAES is 1 lakh. Amount of equity is 1 lakh into 10. Amount of equity is 1 lakh into 10. So my ROE is 10%. ROE is 10%. 1 lakh divided by 10 lakh. 1 lakh divided by 10 lakh. ROE is 10%. Cost of equity has a formula called 1 by P multiple. I'll explain this at some other stage. 1 by P multiple, which is 1 divided by 8. 1 divided by 8. You will understand this later at some stage. So R is 10%. I can earn 10. You are adamant on getting 12.5. You want 12.5. I can earn 10. You say don't keep any money. Give us the entire money. Give us the entire money. Able to understand the concept till this? Any doubts on this? I compare return on equity with the cost of equity. Return on equity with the cost of equity. I can earn more. I will keep the money. You can earn more. You take out the entire money. Take out the entire money. Any doubts till this? Can we proceed? Next concept is limiting value. Let's understand what is limiting value. Limiting value means minimum possible value for a share. Then what is this minimum possible value? Minimum possible value means following a payout ratio which is opposite of the ideal payout ratio. Ideal 0, opposite 100. Ideal 100, opposite 0. What is limiting value? Limiting value is the minimum possible value for a share by following a payout ratio which is opposite of ideal payout ratio. Last question you did, ideal was 0%. If you had done 100% and calculated the value, that is called limiting value. Limiting value is following a payout ratio which is opposite of ideal payout. In the below example, tell me the ideal payout ratio. 20 and 15, what is ideal? Participate. 0%. Return on equity 20%. Cost of equity 15%. R is greater than KE. R is greater than KE. Ideal 0. Follow 100% payout and calculate the price. That is called limiting value. Follow 100% and calculate. 30 seconds, calculate. Follow 100% and tell me the value. 100% payout. 100% payout. Follow 100% payout. Okay, I've got the answer in live online. What's the answer? 100% payout means the first part only. EPS 10, dividend also 10. 10 divided by 0.15. Second part is not there. Second part is not there. Answer is 66.67. Any doubts on this? Clear? Now comes the important model, which is your Gordon's model, and then we will do a question where Walter and Gordon is done together. Gordon's model of valuation, technically called as growing perpetuity, best model to value an equity share. Walter is not that good. Gordon is a very good method of valuation. What did Gordon say is, I invest in a company. If I invest in a company, the KE, Gordon only gave this. KE is equal to dividend divided by the price I pay. This is my first earning. What I get back divided by what I give. What I get back D1. What I give price. Along with that, my value will go up. My value will go up, which is called growth rate. Which is called growth rate. He then changed this formula and said G goes to the other side. KE minus G. P naught goes to the other side. Formula became D1 divided by KE minus G. D1 divided by KE minus G. What is D1? Dividend of next year. Some discussion will still happen on that. KE already discussed. Growth rate, some discussion is needed. I'll explain as we proceed. D1 divided by KE minus G, or D0 into 1 plus the growth rate divided by KE minus D0 means today's dividend, or E1 means next year earnings. E1 is next year earning into payout ratio divided by KE minus G, or E0 into 1 plus G into the payout ratio divided by KE minus G, whichever way you want to do. Today's earnings, add growth rate, then into payout ratio. Tomorrow's earnings, directly into payout ratio. Today's dividend, add growth rate. Tomorrow's dividend, directly take it as D1. Any doubts till this? Now, the main headache is, question will give a dividend figure. Is it D0 or D1? Is it D0 or D1 will be a headache in many problem. If question uses the word paid out, will pay now, paid last year, it means it is D0. It means it is D0. Will pay next year, end of current year, future year, likely to pay, that is D1. That is D1. D1 means dividend of next year. D0 means dividend of last year or technically current year. Clarity is not there in the question. Go ahead and take an assumption. Go ahead and take an assumption. Clarity there, happy about it. Clarity not there in the question, I will have to take an assumption. There will be problems where clarity will not be there. We will give two answers. One with given dividend as D1, another with given dividend as D0, and give another answer. Any doubts till this? Any doubts on this? The dividend given in the question can be D0, can be D1. Paid out, will pay now, paid last year is technically D0. Practical world, what is D0 and D1 is? D0 means immediate dividend. Immediate means I buy. Next 5 days dividend will come. That's called D0. If it's going to take little bit more time, when I say more time, more than 3 months, 4 months, that is called D1. That is technically called D1. D1 means something which is going to come after 3 months or after 6 months. D0 means just paid 2 days back or getting paid or got paid in last 1 month. That is D0. What was paid earlier is called D0. What is likely to be paid after maybe some reasonable time, after a reasonable time, is called D1. I am in 2025. For 2025 financial year, whatever dividend is going to be paid will be D1. I go to the end of December, maybe it can become D0 also. It all depends on when is the dividend going to be paid. This is a practical angle for you. Problem solving, clarity may not come, so we may have to take assumption. Long-term growth rate is 8%. Company is expected to pay dividend of In my MCQ, I'll not have that clarity missing part. 4 per share next year. The cost of equity is 12%. What is the fair value of the share? D1 divided by KE minus G. D1 4 rupees, KE 12%, G 8%. You get the price. All our basics. We have already used this when we were doing that revision in growth rate in the valuation of your M&A. Any doubts till this? Can we proceed? Next important discussion is on the growth rate. Any doubts till this? Gordon's model, it can be D1 by KE minus G, D0 into 1 plus growth rate by KE minus G, or E1 into payout ratio by KE minus G, E0 into 1 plus growth rate into payout ratio by KE minus G. As long as clarity is there on the dividend, go ahead and take that number, divide by cost of equity minus the growth rate. How is growth rate calculated? Two approaches you follow. Second approach is very rarely used by ICI. It is more of a CA inter part, not at CA final. Okay, CA final mostly the first part. The growth rate all depends on two factors. Let's take an example. I create a fixed deposit of 1 lakh. This fixed deposit will give me 10% interest. I earn 10,000. Fixed deposit will earn 10%. I get 10,000 rupees from the FD. What can I do with this interest? I can take it, or I can add it to the FD balance. What did I do is I took 4,000 for my purpose. 40% I took it. 6,000 added to the FD value. Next year, 1 lakh into 10%, 10,000. Tell me 40% of this. Balance 60%. Next year, 112,360 into 10%. How much? 11. 40% of that. 4. Next, this one. 6, 7. 4, 2. 10,000 becoming 10,600 is what growth rate? What is the growth rate if 10,000 becomes 10,600? 6%. 4,000 becoming 4,240. Same 6% you will get. 6,000 becoming 6,360. Same 6% you will get. 1 lakh becoming 1,06,000. Same 6% you will get. Growth rate is 6% in this example. I'll come to the formula in some time. This is value of the company. This is total earnings. This is dividends. And this is retained earnings. Total earnings, dividend. Dividend means I took out the money. Retained earning means I added it in the company. So growth means growth in value of the company. Technically it's share price. Growth in the dividends of the company. Growth in the earnings of the company. Growth in retained earnings of the company. So growth basically means everything will go up. Dividends will go up. Earnings will go up. Retained earnings will go up. Share price will go up. Value of the company will go up. How did this 6% come? Is ROE 10% into retention 60%. I'm retaining 60% of the profits. You retain 60% on that. Whatever you're retaining, you're earning 10% on that. Whatever you're retaining, you're earning 10% on that in the next year. ROE into retention ratio. Can I increase the growth rate? Yes. Instead of 4,000, take only 2,000. Retain earnings 8,000. Next year 1 lakh 8,000. 10,800. Growth will become 8%. Growth will become 8%. The growth rate logical formula is earning ability of the company. Earning ability means ROE of the company or ROE of the fixed deposit. ROE of the fixed deposit multiplied with what am I retaining in the fixed deposit. If I retain full money, growth would have been 10% because ROE into retention is 100% retention. First formula is ROE into retention ratio. Growth rate means it's not growth rate in dividend alone. Dividends, earnings, total earnings, retained earnings, or your share price, value of the company, everything will go up at the same rate, ideally at the same rate. So ROE formula EAES by amount of equity, retained earnings, retention ratio is retained earnings by total earnings. Other formula, I'm not spending time on it. Later on, if you want, you just read through it. One example will be there. Important is this one. Important is this one. IRR of a company is 20%. IRR means earning ability of mine is 20%. I can earn 20%. Investor wants 15%. This is called KE. Dividend is 2 per share. Earnings is 5. 5 rupee earning, 2 rupee dividend. 5 rupee earning, 2 rupee dividend. What is the payout ratio? Retention ratio 40 and 60. Growth rate is 60 into IRR, ROE, ROI, rate of return on retained earnings. Different names can be there. ROE into retention ratio. ROE into retention ratio. Any doubts on this? Clear? Can we proceed? Done. I'll come back to other concepts later on. If you want to do this, the other one, you just try seeing this at home. Future value, present value logic. I don't see that very critical as of now. Now, okay, I'll discuss the other one also, because one concept has to be discussed with this. Another way of calculating growth rate is looking at the dividend history. What is looking at the dividend history is, you give me last 10-year dividend. So what I understood is, dividend was 10 rupees. You kept on increasing it, became 20 rupees. In how many years? In 10 years. Earlier value is called present value, later value is called future value. Whenever, if you are in 2000, 2000 is present, 2010 is future. If you are in 2010, 2010 is present, 2020 is future. Whatever date, the earlier value is called present value, the later value is called future value. So I had dividend history. 10 rupees is called present value, 20 rupees is called future value. We have an approach called future value is equal to present value into r power n. 20 is equal to 10 into 1 plus r power 10. What is that r you have to calculate? That is called growth rate. You will not be able to do in calculator. In Excel I can do it. That's why I didn't want to discuss it. 1 plus r power 10. This is one way of calculating growth rate. Looking at the past history. Looking at the past history, I can calculate the growth rate. Take the first dividend as present value, last dividend as future value, and you can use either future value factor or present value factor. Clear? Any doubts on this? There is one MCQ you can do later at home. Now, when I follow this approach, one scenario which can happen, a rare scenario can happen is, data could be given for EPS as well as DPS. The data could be given for earnings per share or dividend per share. Past history. Whenever they give you both, ideal scenario is to calculate growth rate using EPS. Why? Because EPS reflects the real growth rate of the company. Why DPS does not reflect? DPS can be changed by us by increasing payout, decreasing payout, increasing payout, decreasing. I can alter dividend, but I can never alter earnings. So earnings reflect the real growth of the company. If at all you use past data, not very, very critical concept, but if you're using past data, earnings growth rate is the real reflector of the growth, and not dividends is the real reflector. Clear? How will you do? Take the past information, one last dividend, whichever year you have, that is first dividend which was there, present value, and the last dividend which is just a year back, that is called future value, and then do the calculation. Any doubts on this? Not a very, very critical concept. CA Inter, it is tested in 5-6 question. CA final, I don't expect them to test it. Clear? How to compute return on equity? We have already done it at few places. Anyway, still I'll discuss. EAES divided by amount of equity. What is amount of equity? Share capital plus reserves and surplus minus the fictitious asset. If you divide that by number of share, you get BVPS. You get BVPS. EPS by BVPS. Let me see if you are able to do this. A little tricky example. Question 15. Get me the ROE. Question 15. Get me the ROE. 1 minute for you. Little tricky example. Not okay. It'll take time. Not very tricky, but take time. 1 minute for you to solve this. No, no, friends. Example 15, 15, not 14. Okay, I've got started answer in live online. Example 15, the below one. Okay, 15th example. You need to do some calculations and then get to the answer. ROE formula is EAES by equity. Tell me the EAES number first, which is your 10 lakh minus 50% 5 lakh minus preference dividend, which is now 4 lakh. Equity share capital plus reserves and surplus minus fictitious asset. Share capital is 5 lakh, reserves and surplus 45 lakh minus fictitious asset 10 lakh. Denominator is 40 lakh, 10%. Any doubts on this? Any doubts on this? Clear? Can we proceed? Any doubts on this? This is on return on equity. Whatever I'm discussing will become the base for many models which we are going to do. Major problem solving may not happen in today's session. Major chunk will be on the concepts, getting the grip on the base. Technically CA Inter. I'm just doing CA Inter till now. Any doubts on this? Cost of equity. What is cost of equity? Is what does a shareholder want? How will I calculate cost of equity? First is, if you are a dividend paying company, Gordon's formula. What is Gordon's formula? K is equal to D1 by P naught plus growth rate. At Inter, you would have learnt that if at all any flotation cost is there, P naught minus F we do. F is flotation cost applicable in case you make any new issue. If there is no new issue made, that is not applicable. Self-explanatory formula. Another formula is capital asset pricing model. What does capital asset pricing model say? RF plus beta into RM minus RF. 100% you will have clarity on this, but anyway, portfolio management, we will discuss this again. If you are a non-dividend paying company, example, Microsoft for a very long period was non-dividend paying company. I will do RF plus beta into RM minus RF. Another formula which I had used in some other question, I said 1 by P multiple. Let me explain the logic. What is the formula for P multiple? Tell me the formula for P multiple. MPS, EPS. Inverse is EPS, MPS. K is equal to D1 by P naught plus growth rate. If EPS is fully paid as dividend, because I have written a note, useful if there is a 100% payout. Rare scenario, even if there is no 100% payout, we may use this formula, but most of the time, 100% payout has to be there. So EPS is equal to D1, MPS is equal to P naught, growth will not be there, 100% payout. 100%. So that 1 by P is not a new formula. 1 by P is the D1 by P naught plus growth rate. D1 means E1. P naught means price. Growth is anyway not there. Growth is anyway not there. So not a new formula. It is this formula only. It is this formula. Inverse of P multiple. P multiple is MPS by EPS. EPS divided by MPS. Any doubts on this? Clear? Can we proceed? Give me answer to 16. Already got the answers in live online. In the MCQ, that headache will not be there. D0, D1. I would have drafted it that way. When you do a problem, the critical part is not the KE calculation. The critical part is understanding it is KE, because now you will know. But when I discuss it as a part of a bigger problem, suddenly you find it little difficult to grasp. What rate of return does an investor expect is called investor required return. Technically KE. Technically KE. What investor wants is called cost of equity. Calculation is not very critical. D1 by P naught plus growth rate, that's very simple. But what is asked in the question is KE, because when you do it as a part of a bigger problem, so many information will be there. Some student will say they're asking ROE. No, they're not asking ROE. They're asking KE. Investor, what he wants is called cost of equity. Clear? Any doubts on this? Give me answer to 18. 18th example. Started getting the answers here. 6 plus 1.5 into 8 as it is. Risk premium of market means RM minus RF. Risk premium of market means what extra market wants. Market return means RM. Risk premium of market means RM minus RF given directly to us. Any doubts on this? Clear? Can we proceed? Any doubts on this? Done. Let's come to 8. Let's come to 8. Sam Limited has just paid a dividend of 2 per share, expected to grow at 6% per annum. After paying dividend, board declared to take up a project by retaining the next 3 annual dividend. It's expected that this project is of same risk class as the existing project. Result of this project will start coming from the 4th year onwards. The dividend will then be 2.5, grow at 7%. Investor has 1000 shares in Sam Limited, wants a receipt of at least 2000 per annum from this investment. Show how the market value is affected by the decision. Also show how an investor can maintain his target receipt from the investment for first 3 years and improved income thereafter, given that cost of capital of the firm is 8%. You go through it and then I'll start explaining. Go through the question. Okay, I'll explain the question, discuss 2 concepts around it, and then we solve this question. I think with that we may end the session. Let's first understand. Sam Limited just paid a dividend. Just paid a dividend means D0. Expected to grow at 6% per annum. After paying dividend, board took up a project by retaining the next 3 annual dividend. It's expected that this project is of same risk. Same risk means KE will not change. You do any new project, KE can go up, KE can go down. If risk increases, KE will go up. Risk decreases, KE will go down. Result of this project will start coming from the 4th year onwards. The dividend will then be 2.5, grow at the rate of 7% per annum. Investor is having 1000 shares in the company and he wants a receipt of at least 2000. So I have invested in this company with the hope that I will be getting how much? 2000 per annum from this investment. Suddenly the company says we will stop paying dividend. but I need 2000 rupees. I need 2000 rupees. Two things they have asked us to calculate. One, what is the impact on the share price? Second thing, how can I maintain my income? Because I want 2000 rupees from the company. Company clearly told me we are not going to pay dividend. Now, two concepts we need to be aware. How do I maintain dividend income when a company is not ready to pay dividend? When a company is not ready to pay dividend, very simple. Company pays dividend, dividend income meets commitment. What is commitment? I am a person who wants regular income from the share for meeting my day-to-day expenses, whatever requirements I have. I had invested in such companies which will regularly pay dividend. Company stops paying dividend, do partial sale of share till the company starts paying dividend again. So I started with some 1000 shares in that example. I will sell some 10 share, 15 share, 20 share, 23 share. So whatever number I decide, I will sell it. Which year? They are talking about 3 years. So in the problem which we are doing, I need to know today's price. I also need to know what will be the price at the end of first year. Why at the end of first year? I have to sell shares. I also need to know what is the price at the end of second year because I have to sell share. I also need to know what is the price at the end of third year. Again, I have to sell the share. So I have to calculate so many prices because I am going to sell shares. I am going to sell shares. Today's share valuation P naught we can calculate, but P1, P2, P3, how do I calculate? So there are certain ways to do it. I'll explain. So here there are people who do dividend investing. Dividend investing means you are going to get regular income. You can do this example at home later on. The problem which I'm going to do is going to more or less discuss this example. Okay, this is one part. Second part is computation of price of different years. You would have learnt an approach called Modigliani-Miller approach at CA Inter. I'll explain the logic of that approach and then I'll tell you, is this only for equity? No, it is for land, building, plant, machinery. Anything can be valued using this logic. P naught means today's price, but you don't want only today. You want first year, second year, third year, fourth, fifth, sixth, seventh. Now, what Modigliani-Miller said is Microsoft today is 100 rupees. I want 12% return from Microsoft. So at the end of the year, it has to become 112. Microsoft said, I'll give you 1 rupee dividend. Then give me price 111. I want 112. My logic is very simple. 100 should go up by 12%. So by end of the year, can you give me 112? How can I get 112? Dividend 1 rupee, price 111. Dividend 2 rupees, price 110. Dividend 3 rupees, price 109. Dividend 14 rupees, price 98. Dividend 20 rupees, I want 112 at the end of the year. I want 112 at the end of the year. So he said price at the end of the year. Today price. Add 1 plus KE. What is 1 plus KE? What you want? 100. Add extra 12%. Add extra 12%. 112 I want. 112 I want. Then company says, I will give you dividend of 4 rupees. Price can go down. Dividend of 6 rupees. Price can go down. This is P1. P2 is equal to P1 into 1 plus KE second year dividend. P3, is this only for share? No. Value of property in first year. Value of property today into 1 plus KE are my required return minus rent of first year. It will not give dividend, it will give rent minus rent of first year. Value of property of second year, property value first year into 1 plus KE minus rent of second year, minus rent of second year. Any income generating asset, I want 14% return. If you are generating regular income, price need not go up 14%. Price can go up lesser. Clear? Able to understand this? You want to do in debt valuation. Value of bond at the end of year 1 is equal to year 0 value into 1 plus KD minus interest of year 1. Minus interest of year 1. Any asset you can value using this logic. Year 0 to year 1 you can move. Year 1 to year 2 you can move. Year 2 to year 3. Year 3 to year 2. Year 2 to year 4. Any years you can move forward. Clear? This formula you should understand with full grip. And this is a very good example. You will do this at home later on. Okay, at home you will do. Price is given in third year. From third year you have to come to second year. How will you come to second year? P3 is equal to P2 into 1 plus KE minus D3. Very good example. You do this at home. Okay, from P3 you will come to P2. From P2 you will come to P1. From P1 you will come to P0. All this calculation you do at home. Now I come back to the question which is being discussed. Is this only for equity valuation? No. This is for bond, equity, any asset valuation. Even a property can be valued using this logic. Clear? Able to understand till this? Can we proceed? Understand some of the concepts very clearly. Practical world has a lot of utility of all of this. Now coming to this question, company just paid dividend of 10 rupees and is growing at 6%. Let me value the company today without the project. Then I'll value the company with the project. There can be a difference. That difference is the market value of the share affected by the decision of the board. By the decision of the board. Board is taking some decision. Value can change because of that. Then how can I maintain the income? I need price of year 0, which is today's price. Anyway, we will calculate price of first year, price of second year, price of third year. I will calculate price for different years. With that, 2000 rupees I want. 2000 divided by price of every year will tell me how many shares are to be sold. Very simple concept, but lot of good things are tested. Today price P naught is equal to D1 by K minus G, assuming you continue to pay dividend. Why you continue to pay dividend? Without project, you will pay dividend. With the project, you will stop paying dividend. So now write P naught is equal to price before project. Price before project. P naught is equal to D1 K minus G. D1 by K minus G. What is the dividend paid earlier? What is the growth rate? 6%. 2.12. Cost of equity? 8%. Growth? 6%. 106. Good. That's the value today. I am going to do a project. Moment you do a project, A can change also, but it's not changing. Growth is changing, but there's one problem. After paying dividend, board has decided to take up a project by retaining the next 3 annual dividend. I told P naught equal to D1 by K minus G. I asked you D1, you are saying 0 because they are not going to pay dividend. Once you do the project, first year no dividend, second year no dividend, third year no dividend. Garden cannot be used till you pay dividend. First year no dividend, second year no dividend, third year no dividend. It's expected that the result of this project will coming from which year? Fourth year. Dividend will then be how much? 2.5 and will grow at what rate? 7%. So listen, like P naught is there, I can do P3. P3 means price of third year is equal to dividend of fourth year. P3 D4. P naught D1. P1 D2. P2 D3. P3 D4. D4 by K minus G. Price after project. Price after project. P3 is equal to D4 by K minus G. First you get this, then I'll tell how will we come to P0. P3 is equal to D4 by K minus G. What is the fourth year dividend? The question is saying 2.5. No change in cost of equity or cost of capital. 8% growth. And it's very crystal clear, 2.5 in the fourth year and then grow at 7%. Okay, if it was 2.5 and it has to have a growth, then I'll have to add the growth rate also. 2.5 in the fourth year. I have P3. From P3 I can come to P0 directly also, but I don't want to do that. I will use Modigliani-Miller. P3 to P2, P2 to P1, P1 to P0. Any doubts till this? Now write P3 is equal to P2 into 1 plus cost of equity minus dividend of third year. P3 is equal to P2 into 1 plus cost of equity minus the dividend of third year. Dividend is not there, so in my solution I would have just directly divided by cost of equity. But okay, P3 is equal to P2 into 1 plus cost of equity. Logic, understand formula. P2 I have a price. That price has to increase at the rate of cost of equity at least. And if you are paying dividend, it can go down little bit. 250 is equal to, what is the cost of equity? 1 plus 0.08. Any dividend in the third year? No. In that MCQ which you do at home, no, dividend is there in the third year, dividend is there in the second year, dividend is there in the, that's a very tricky one. So at home, practice it, you will get grip on the concept. Calculation is not very tricky, but at home, practice that question. Calculate and tell me what is P2 now. Any doubts on this? Repeat. P2 is equal to P1 into 1 plus KE minus dividend of second year. Minus dividend of second year. This is Modigliani-Miller formula. Logic is very clear. The formula logic is what you need to be aware of. Other things and all, if you try to do, it will not. Forward working, when you do, it will be easy to understand. Reverse working becomes little challenging to understand. What is P2? 231.48. P1 into 1 plus minus 0. P1 is clear. Okay, then I come to P0. P1 is equal to P0 into 1 plus KE minus D1. 214.33, 1 plus 0.08, project will increase the share price from 106 to 198. It's a very good project. 106 will become 198 as per the model of valuation. As per the model of valuation, it has to become what? 198.4. Any doubts till this? Understood the first part of the calculation? And why did I do every year calculation? For the next part. The second part you need not do. I'll discuss it, okay? How will the investor maintain his target receipt for first 3 years and improved income thereafter? How much the investor wants? 2000. First year, tell me what is the first year price? 2000 divided by 198.45. I will sell. Sorry, first year, not second, year 0. I'm asking first year price. Today I'm not going to sell anything. 214.33. 2000 divided by 214.33, you get how much? 9.33 rounded off to 10. I will not round off to 9. If I round off to 9, I will not get 2000 rupees. I need minimum 2000 rupees. I'll explain again. 2000 divided by 214.33. If you sell 9 share, you will not get 2000 rupees. So you will round it off to 10, sell it. Like this, we will keep selling shares. I sell 9.33 rounded off to 10. I sell 8.64 rounded off to 9. I sell 8 share. After everything is over, I'll be still having this many shares. And my income will be then this many share into 2.5. This many shares into 2.5. I will be having 1000 minus 10 minus 9 minus 8 multiplied with 2.5. Able to understand this? It's a good question. May not get repeated and all in exam, but it's a good problem. Any doubts on this? Any doubts on the concept? Understood this? I'll repeat whatever concepts we have done today in this area, and what I want you to 100% do is this part. I'll tell you the concept number. Before the next session, you have to do for concept 28 at home, 28 at home and 29 at home, 28 and 29 along with MCQ. In class, when I discuss, first I may not discuss, and even if I'm discussing, the pace will be very, very fast because discussing every ratio is a time consuming exercise. I will not have the time to discuss everything. But if you go through this properly, understand this properly, it'll be good. You need more clarity. My CA inter videos are there in my YouTube channel, but I don't think you will feel the need for it. You go through it, you will get clarity. But 100% go through this with all the examples. Some 6 7 examples are there, 28 and 29, before the next session. Impact of a new project on a share price. Now, in the practical world, the share price changes because of multiple factors. One major factor which will change the share prices, if I'm doing any new project and the new project gives me positive NPV. If a project is done and the project can generate positive NPV, it will increase the share price by NPV per share. Whatever is the NPV per share will be the improvement in the share price. Many a times, TCS is acquiring some company. Share price will start going up on the date of information or will go down on the date of information if people feel it the acquisition is positive NPV. Whenever you acquire a company, what is acquisition? When I acquire a company, I have to pay something on day zero. I will be earning something out of that company over the next 10 years, 15 years, 20 years, 5 years, and then I may sell that company. So it is a capital budgeting exercise. So whenever an acquisition is done or whenever a big project is done, if it is a favorable NPV project, share price will increase by NPV per share. And if it's a negative NPV project, share price will decrease by NPV per share. This is what will happen to the share price. What practically happens is, today I have existing shares into some existing prices there. On top of it, an organization may make a new issue also. If you make a new issue, in the numerator, this is like that mutual fund. In mutual fund, you would have seen we had existing net assets. Then if I make any new issue, new people are coming into the company, new shares, ideally the new price and existing price should ideally be same, whatever is the price, plus any NPV if the project can generate. I'm raising money and putting it in some good project. It will generate NPV for me. Add the NPV in the numerator. What is the impact of NPV is, any positive NPV will increase my wealth, will increase the wealth of the shareholder, and any negative NPV will decrease the wealth of the shareholder. A small example. EPS 100% payout. Moment you see 100% payout, KE can be computed as 1 by P multiple. KE can be computed as 1 by P multiple, or EPS is equal to dividend per share. EPS is 10, MPS is 100, number of shares is 1 lakh. Company is fully equity financed. A fully equity financed company means KE and KO is same. Fully equity finance means KE and KO is same. Company wants to do a project of 1 crore at the end of year 1. I want to do a project of 1 crore at the end of year 1. It will generate 21 lakhs from year 2 onwards. 21 lakhs from year 2 onwards. What is the new share price? What is the new share price? Now, I have to first calculate NPV of this project. How do we do NPV calculations? Inter you would have done year, cash flow, PVF, DCF. What is the project's cash flow? Discount it at WACC, weighted average cost of capital, or technically at cost of equity in this question. Discount it at cost of equity in this question. Why cost of equity? 100% equity financed. Clear? I don't want you to write anything, but it's a very good example. Understand this. KE is equal to D1 by P naught plus growth rate, or you can say inverse of P multiple. Both are same here. What is the dividend the company is going to pay here? 10, which is a 100% payout. 100% payout means no growth, no D0, D1 headache. There's no D0, D1 headache. Whatever is this EPS, that is D0, D1, D2, D3, D4, that headache doesn't come. So 10, what is the price today? 100. growth is 0. So cost of equity is 10%, KE, KO. KER, KO, both are same. Today the share price is 100 rupees. It will go up or come down by the amount of NPV per share. Go up or come down by the amount of NPV per share. Positive NPV, share price will go up. Negative NPV, share price will go down. Now the project which we are doing, year cash flow PVF at 10%, DCF. Year 1, I am spending 1 crore on a project. Year 0, I'm not spending. I'm not spending today, but I'm spending in the first year. First year, company wants to do a project of 1 crore at the end of year 1. So I spend 1 crore at the end of year 1. Second year onwards, I will generate 21 lakhs. So second year, 21. Third year, 21. Fourth year, 21. Fifth year, 21. There's no end to it. There's no end to it. I'll come to a perpetuity part in a minute, but this is the cash flow structure. Year cash flow, PVF at 10%, DCF. Year 0, this is a very important concept. I'm going very slow. There are reasons to do this. 1 crore, a place where students keep making mistake. Year 0, 1 crore. Second year, 21 lakh. Third year, 21 lakh. This, there's no end to this, okay? There's no end to this. In Excel, I can write it any number of years, okay? I'm just writing randomly. I've written some 227 years. In Excel, I can keep doing it for any number of years. So 21 lakh like this, it's happening. I have to discount this at 10%. 1 divided by 1.1. I'm not doing any rounding off in Excel. Clear? I've written it for so many years. DCF I calculate. And I do the NPV number. NPV is coming out to be 1 crore rupees is the NPV. Okay. Obviously, in your notebook, you cannot do 220 years, 200 years and all is not possible. So, this year 2, understand this very clearly because I have tried explaining many times, student make a mistake. 2 to infinity. From year 2 to infinity, we are going to earn. Whenever you value a perpetuity, value 1 is equal to cash flow 2. Value 1 is equal to cash flow 2 divided by KE minus G, which is 21 lakh divided by 10%, KE or KO, whatever name you want to call, minus 0. Answer is 2 crore 10 lakh. The biggest point is this will be written as year 1. Cash flow comes in the second year, but the value for that will be written in the first year. Cash flow comes in the second year, value for that will be written in the first year. Many students make a mistake here. Perpetuity is always valued a year in advance. Value 1 is CF2. Whenever you value perpetuity, if you are using third year cash flow to value a perpetuity, that is value 2. Your students in their mind imagine that cash flow is coming from the second year. Why is this guy writing it in the first year? Because reason is perpetuity valuation always happen a year in advance. Reason is Gordon's formula. When you do P0, you are okay to use D1. That time no confusion. But when I tell suddenly to value it in your NPV calculation, you end up making mistake there. When I tell you to value a share, nobody makes a mistake. I have not seen a student making a mistake in P0. D1 perfectly you write. If I ask P6, D7 perfectly you will write. But when NPV is to be calculated, your mind forces you to think that, okay, first year cash flow or second year cash flow, let us write it as year 2. Where does that make a difference? Because year 2 means second year PVF. Year 1 means first year PVF. And automatically that will lead to difference in answer. I've shown you detailed calculation in Excel. This is 0.909. Again, this also 0.909. When you multiply and get a final answer, you will get 1 crore. Okay, rounding off up and down difference can be there. Final answer will be 1 crore. Perpetuity is always valued a year in advance. If you have attended my regular class, I would have told this line 50 times in the class. Student still makes mistake, and you will also be still making mistake in sessions when I keep doing, because suddenly I'll be doing a perpetuity valuation, business valuation, and then you will again end up making a mistake. Now I can only explain it multiple times. Beyond a point, you will have to pick it up. Clear? Any doubts on this? Perpetuity is always valued a year in advance. So the project is going to generate NPV of 1 crore. If it is going to generate 1 crore NPV, 1 crore by 1 lakh, 100 rupees will be the increase in share price. 1 crore by 1 lakh, 100 rupees will be the increase in share price. Perpetuity is always valued, because here perpetual cash flow is received from year 2, valued a year in advance, year 1. This is return. But when you do, you will write this as year 2 and then do the calculation. You will end up getting a wrong answer. Clear? Able to understand this? Any doubts on this? It has, this concept will get tested at few places. I may not immediately test it now in a problem, but it will get tested at few places. Can we proceed? Done? Okay. Undervalued versus overvalued security. This is very simple. What is undervalued versus overvalued securities? There will be an actual market price given in the question, and we are required to calculate fair market price. What is fair market price? Either under Walter's model, or under Gordon's model, or under FCFE model. Multiple models are there. You do your valuation and the market gives a valuation. A share is said to be undervalued if I feel it is 500 rupees, market is at 400 rupees, buy that undervalued security. Buy an undervalued security, sell an overvalued security. If market is giving a very high valuation, today people are talking about Lenskart being overvalued. The valuation given is overvalued. That is why people are saying not to buy it. If it's undervalued, people will say go ahead and buy that company. So undervalued and overvalued is done by comparing actual market price with fair market price. Fair market price is a tricky point. Tricky point is your way of valuation could be different. My way of valuation can be different. I will have different assumption. You will have different assumption. AMP is same for everyone. FMP is going to be different, because if everybody thinks alike, no stock market buying and selling can happen. If everybody thinks Lenskart will go up, then there will not be any person who is selling the share of Lenskart. How will buying and selling happen? So in the market, there are 1 crore investors, 2 crore investor, and different people think differently. That is where a stock market buying and selling happens. Any doubts in this? Undervalued, overvalued. Okay, a small concept called holding period return. Nothing much for me to explain here. Already done in mutual fund chapter. NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0. Here it's called P1 minus P0 plus D1 divided by P0 into 100. Maybe some places I may calculate this. Okay. X dividend price and cum dividend price. X dividend price and cum dividend price. Now, any asset you buy, there are two types of prices are there in an asset. I buy this property on 30th March. If I buy this property on 30th March, and let's assume there are tenants already there in the property, I buy it on 30th March. Whatever price I pay is called cum rent price. What is cum rent prices? I will be paying, property value is only 1 crore, but I'll be asked to pay 1 crore plus extra 1 lakh rupee. That extra 1 lakh is because in the month of March, on 31st, the tenant will be paying me 1 lakh rupee. The tenant will pay me 1 lakh rupee on 31st March. Any asset has one base price, and there is an extra value for the property because rent is going to be immediately paid. There's an X dividend value, cum dividend value, X interest value, cum interest value, X rent value, cum rent value. Property, if you buy on 30th March, you have to pay 1 crore 1 lakh. If you buy it on 31st March, you have to pay only 1 crore. Because if you buy on 31st March, you will not get that 1 lakh rent. If you pay on 30th March, you will get that 1 lakh rent. For decision making purpose, we should always get the X dividend values. We should always get the X dividend values. Any place in any formula you want to use P naught, where will you use P naught? K is equal to D1 by P naught. That P naught should be X dividend value. It should be X dividend value. You calculated a fair market price. You need to compare that with the actual market price X dividend. X dividend. Any value should be X dividend. What is X dividend and cum dividend value? X dividend is real value of the security without accrued dividend. Real value of the property without accrued rent. Accrued rent. Rent keeps getting accrued on a everyday basis. Without accrued rent, if you take, that is called real value of the property. Cum dividend values are X dividend value plus the dividend income. Plus the dividend income. Real value of property 1 crore. Extra 1 lakh you are paying because you are going to get the rental income. Price will fall by the amount of dividend. Price will fall by the amount of dividend once the share becomes X dividend. Value of the property will fall by the amount of rent once the property becomes X rent. What is X rent is? Rent is paid out. If rent is paid out, it will become X rent. Where did we see this concept? In mutual fund. When dividend is paid, NAV will fall by the amount of dividend. NAV will fall by the amount of dividend. So in any calculation, for example, we were doing this fair price calculation earlier, and the question say the actual market price in bracket cum dividend is 25. From the cum dividend, you have to first remove the dividend and then only do comparison. Then only do comparison. Let's see whether you have understood this. Is a very tricky example. Get me the answer here. It is a tricky example. Let's see. Cost of equity. Get me the cost of equity here. No major numbers, anything, but it's little tricky example. Example 23. Okay, I've got answers in live online. 15. Okay, I've got 15 as some answers and 15.5 even in live online. Now, this is where the mistakes would be made. K is equal to D1 by P naught plus growth rate. P naught is 10. P naught is 10. What is 10? 11 minus 1. D1 is 1 plus the growth rate. Including dividend of 1 means it will be paid in a day or two. This is D0. Including dividend of 1 would mean this is D0. It is cum dividend price means in few days, 5 days, 10 days, this dividend will be paid. So 1 plus extra 5% on this, 1 plus extra 5%, 1.05 plus 0.05. Some of you in the live online have also told 15%, but the answer is 15.5%. No confusion here. Including dividend means it is going to be paid out in few days. In few days, this dividend will be paid out by the company. Able to understand this? Can we proceed? Any doubts on this? Done? Understood? So again, I'll repeat, because see, the point is whatever I teach, it may come back at some point of time later on. X dividend values, cum dividend value. Suddenly in bond valuation, I'll say X interest value and cum interest value. Or suddenly at some other place, I'll say X rent value and cum rent value. So you'll have to be very clear on the concept. Concept is for any calculation, remove this element called accrued interest, accrued dividend, accrued rent. Any formula you want to use, any place you want to use, you'll have to use only the X values and not the cum values. Clear? Okay. Inflation premium. What is inflation premium? Let's understand. Practical world, if I ask you what is the investor's required rate of return, we had a formula called RF plus beta into RM minus RF. So I asked my parents, we want to invest in a property. So they told me to do cash flow analysis. I did cash flow analysis. Year cash flow I calculated. Now I have to discount this cash flow. For discounting, I need the discount rate. I asked them what is the return we want. I asked what is beta of the property. They said we don't understand beta and all. What are you saying? What is beta and all? I don't understand. But somewhere I still wanted the required return. Practical world, the required return is only this. People understand only this way. Risk-free rate plus risk premium. They don't understand anything else. If my parents want to give a loan to someone, first thing in their mind is government gives 7%, which is risk-free rate. To the person whom I'm giving, this person risk is limited, extra 2%. Risk is very high, extra 5%. Risk is extreme, extra 20%. This is what people, any required return. If you give money to Mukesh Ambani, you would want 7 plus 1, 8%. You give money to the other Ambani, Anil Ambani, you would want 7 plus 20%, 27%. Reason is risk is on the higher side, risk is on the lower side. SBI fixed deposit 7 plus 0.5, 7.5 sufficient. SBI equity share 7 plus extra 5, 6, 13% is okay. So required return of any securities, risk-free rate plus risk premium. What is risk-free rate? Risk-free rate, RBI keeps controlling this. Inflation. Inflation goes up, RBI increases the interest rate. Inflation goes down, RBI reduces the interest rate. Inflation has a significant impact on your interest rates in the economy. India's interest rates for a very long period and now also is higher than US interest rate. Reason is inflation is low in US and inflation is high in India. The gap has been coming down. The reason is inflation gap is also coming down. So any person who wants a return for a security, if a US investor invests in US, he may be okay with 6%. And Indian investor may not be okay with 6%. Reason is there inflation is only 2-3%, extra 3-4%. So one, there is an inflation. Second, there's something called as real return on a risk-free security. What is real return is, if inflation is 5 and government pays me 7, I really earn only 2%. I really earn only 2%. The actual return earned by me is not 7% from government of India. It is only extra 2%. So to put it very simple, required return of any of the problems we have done, required return of shares is equal to inflation plus the real return of India plus the risk premium, or in other words, risk-free rate plus risk premium. Why am I explaining this? Inflation premium, a word will come in few questions. Inflation premium forms part of risk-free rate. Any increase in inflation premium will increase the risk-free rate. Any increase in inflation premium will increase the risk-free rate. This can also increase the market rate. If risk-free rate goes up, market rate can also go up. What is this market rate going up? Today 7%, stock market gives 10%, very happy. If the 7 in India becomes 10, stock market can't give 10. Stock market has to give now 12, 13, 14, 15. I'll repeat again. There's a risk-free rate. There's a risk premium. Risk-free rate is inflation plus the real rate of return. So risk-free rate has two subcomponents. One is inflation premium and the real return. Any increase in inflation premium will increase the risk-free rate, will increase the risk-free rate. And if the risk-free rate goes up, along with that, market rate may or may not go up. That's an assumption based area. ICI hasn't been consistent. There was only one question they have done, but there were a lot of assumptions needed in that question. Clear? Understood the concept of inflation premium? Now I go to the next model, which is an extremely important one. Again, we are continuing with only Gordon's model. Now let's understand what is this. I have to do a valuation of a share. For valuation of share, Gordon says P naught is equal to D1 KE minus G. So then I asked, the D1. For D1, you set growth rate year 1 10%, year 2 8%, year 3 6%, year 4 4%. This is the growth rate you are saying after year 4 till infinity, because an equity share has no end. Till infinity, the growth rate is 4%, 10, 8, 6 and 4. Last dividend was 2 rupees. So I asked 2 plus 10%, no problem. Okay, last year was 2 rupees, now 2 plus 10%. KE 15%. I asked growth. You're saying 10, 8, 6, 4. This is called step up or step down growth model. Step up or step down growth model. Now, what Gordon said is you can use my formula, Gordon's formula, only when you have a single growth rate. Only when you have a single growth rate. If you have a multiple growth rate, you cannot use my formula. Then what will I do? Visualize. Year 1 is over. Year 1 is over. Now, if I ask you growth rate, you will say 8, 6, 4. Still, I don't like it. I want only one answer. Year 2 is also over. Year 2 is also over. What will be the growth after year 2? 6 and 4. I don't like the answer. Year 3 also over. Year 3 also over. What is the growth rate? 4. P3 is equal to D4 by KE minus G. P3 is equal to D4 by KE minus G. When I ask you this, you give me only single growth rate. Till you give me single growth rate, I cannot use Gordon's formula. Okay, I have got P3. I have to go to P0. One approach, which is a longer approach, is Modigliani-Miller. From P3 go to P2, from P2 go to P1, from P1 go to P0, which is a longer approach. Will it give the same answer which I am going to do in the other approach? Yes, same answer. Longer approach. One question we did that because I wanted price of every year. Then what will I do here? I'll do year cash flow. First year, dividend income. Second year, dividend income. Third year, dividend income. At the end of third year, price. Logic is you are selling it at the end of third year. Logic is you are selling it at the end of third year. Whether you sell it or don't sell it, I'm not bothered about it. Whether you sell it or don't sell it, that's not my worry. You are doing the calculation as if you are going to sell the share at the end of third year. This is what the model is. Value of share is equal to present value of dividend plus present value of sale proceeds of share price on sales. Should sales be done? Not mandatory. It is just a valuation exercise. So step 1, PV of dividend. Compute dividend till the growth stability. Whenever growth is stabilizing. Whenever growth is stabilizing. Compute price at the beginning of the stabilization. Beginning of the stabilization means fourth year stability happens. Beginning of year 4 is called end of year 3. Beginning of year 4 is called end of year 3. Till growth stabilizes or till you give me single answer for growth rate. If you give me two answers, I don't like it. I cannot use it in the formula. Till you give me single answer, this exercise will keep going on. Discount step 1 and step 2 at KE or investor required return and compute the share price. Under a step up growth model, what will happen? What will happen is you will have first year dividend, second year dividend, third year dividend, fourth, fifth, sixth, and at last year you'll have to write two numbers, one dividend as well as price, assuming you sell it at that price. It could be P6, P7, P4, P3, depending on when the stability is happening. I have to wait till the year of stabilization. I'll have to wait till the year of stabilization. Practical world, single growth rate assumption is not logical, because in a practical world you cannot have a single growth rate. Growth rate can keep changing. Till you give me a single answer, I cannot use Gordon's formula. Once you have given me a single answer, I will start doing the Gordon's formula. This refers to a scenario where growth happens in multiple stages: an initial stage, an intermediate stage, final stage. It talks about 3 points. It can be 3, 4, 5, 6, 7, any number. I'm not bothered. We should compute dividends till the year of stabilization. Stabilization is reached when growth as well as K is stabilized. What is K is stabilizes? Cost of equity can also change, because the point is I want the denominator like growth. K today is 18, then 16, then 14, then 12. K can also change. What happens if K changes? How you do discounting? That I'll explain later. That part I'll explain later. But K can also change. Dividends growth rate can also change. Till stability happens, the formula cannot be used. Clear? Now let's see a simple example. Last paid dividend is 10. Same will grow at 20% for 2 years. Growth will stabilize at third year is the stability. Third year is the stability. You have to calculate dividends of first year, second year, third year. First year will come in the cash flow. Second year will come in the cash flow. Third year will help me in calculating price. Third year will help me in calculating price. I don't want you to write anything. Tell me what will be first year dividend. Last year 10 rupees. What is the growth? So what will be 12? Second year 14.4. Third year 15.84. First year dividend, second year dividend, third year dividend. Some question it can go on till 8 years, 9 years, 10 years and all. If they want to make it complicated, they can keep increasing the number of years. So 12, 14.4 and 15.84. We got the numbers. Now what will we do is P2 is equal to D3 by K minus G. Historical cost of equity 22, but today onwards cost of equity is 20%. I'm interested only in what is future. Future is 20%. So you see the calculation 20 minus 10 and you do the valuation. Once this is done, this MCQ is done, the concept is over. Technically, any problem I do after this, just time pass. But once this example is understood, you have understood the concept. I'll repeat again. Growth can happen in multiple stages. We need to wait till the growth stabilizes. Stability of growth can happen in any year. Once the stability is achieved, you will then end up computing the price in that year. It could be 5th year stability, 4th year price, 10th year stability, 9th year price, 20th year stability, 19th year price. Till you calculate price, you will have to write dividends discounted. That's called present value of dividend and present value of share price on sale. Stability is from year 1 itself, which is what P naught is equal to D1 by K minus G. So it is not a new model and all. The formula D1 by K minus G only I can use, but I have to delay the usage of it. Maybe to the 3rd year, 4th year, 5th year. After you get 5th year, I want to come to 4th year, not by this logic. Do Modigliani-Miller, which will take more time. 5th to 4th, 4th to 3rd, 3rd to 2nd, 2nd to 1st, 1st to year 0. Both are technically same answer you'll get. Rounding of differences can be there. Any doubts on the concept here? Any doubts on the concept? Can we proceed? Change in growth rate with change in payout ratio. Change in growth rate with change in payout ratio. Dividend estimation for future period. I want to estimate dividend for future period. Why I want to estimate? Step up growth model says estimate dividends till the year of stability. If there is no change in payout ratio, then very simple calculation. Last year dividend plus 10 plus 10 plus 20 plus 30, whatever we did in the previous questions. If there is a change in payout ratio, what is change in payout ratio is year EPS DPS. First year 10 rupees, dividend is 1, 10% payout only. Second year earning will grow at the rate of 10%, 11. Dividend will not grow at the rate of 10%. Reason is this year 10% payout, next year 15, next year 20, next year 25, 30, 35, 40, 45, 50. Till 50 it will keep on changing. Till 50 I will keep on changing it. In case there is a change in payout ratio, you cannot say 1 plus 10%. What you need to do is 11 into 15%. 11 into 15%. I'll explain again. In case there is a change in payout ratio, what is payout ratio is the dividends as a proportion of earning. Earning is 10, dividend is 1 rupee originally. 10 will grow by 10%. it will become 11. But 1 will not become 1.1. Reason is there is a change in payout ratio. So concept says if there is a change in payout ratio, estimate EPS of future years, EPS of earlier year plus the growth rate, and future dividend is equal to EPS into payout ratio. EPS into payout ratio. Able to understand this concept? I'll explain this better with the this example below you do at home, but I'll do a descriptive question. I'll explain again. If there is no change in payout ratio, go with the past dividend, add growth rate, calculate the new dividends. That is a very simple approach. In case there's a change in payout ratio, you cannot estimate dividends. You have to estimate EPS, then estimate dividend, then do discounting. Could be 5 years, 10 years, 15 years, 20 years, 25 years. It can be any number of years. Clear? I'll come to 19 in some time. Okay. One more concept. Any doubts first on this change in payout ratio? If there is anywhere a reference of payout ratio in the question, calculate earnings first and then calculate dividends. Extra work for us, but we have to do. Calculate earnings and then calculate dividends. In case there is no change in payout ratio, only dividends is sufficient. Last question, you never talked about earnings. Even the previous question, we never talked about earnings. This is one point. Second is linear fall in growth rate. Linear fall in growth rate. Let's understand what is linear fall in growth rate. Question may say that growth rate 10% till 5 years. 10% till 5 years. Thereafter, it will linearly decline to 5% by or to 1%. It will linearly decline to 1% by year 8. By year 8, it will become 1%. 10% till 5 years. Linear decline means uniform fall in growth rate. Decline can also be there, increase can also be there. So 10% in the 5th year, it will become 1% in 8th year. So 10 minus 1, 9% fall will happen. 10 minus 1, 9% fall. In how many years? 5th year till the 8th year. 3 years. Every year 3% fall. So 10% growth for the first 5 years, then 7, then 4, then 1. Thereafter 1. Thereafter it is 1. Some question will say 10% till 5 years, linearly decline and stabilize at 8%. Linearly decline and stabilize at 6%. Stabilize at 6%. How many years? I don't give you. In that case, ICI assumes that it will be 1% fall every year. 1% fall every year. Why is this needed? To calculate dividends. To calculate dividend. Growth rate, ideally, question can easily give me the growth rate. Why to complicate? They could have told me growth rate is 10%, then 12%, 5%, then 4%. Something like that, I'm happy to do it. But if I want to complicate a question, I'll say growth will be 10% for 5 years, linearly decline or linearly increase. It can be either ways. So number of years of fall is given. Annual fall is higher rate minus lower rate by number of years of fall. Number of years of fall not given. Take 1% fall every year. Take 1% fall every year. Can you give me answer to this example? A fairly simple example. In this example, in how many years the fall will happen? Is it given? No. 20% for 4 years. 20 will become 19. 19 will become 18 in the 6th year. 19 will become 18 in the 6th year. 17 in the 7th year. 16 in the 8th year. 15 in the ninth year, 14 in the 10th year. 10th year is the stability. 10th year is the stability. Number of years is not given. 1% change. 1% change. So 14, it has not been mentioned the fall is for how many years. 14 will become, sorry, yeah, 20 will become 19. 19 will become 18 in the 6th year. Clear? Give me answer to the next one. Live online guys, you also participate. 27th example. Already got the answers here. What will be the annual fall in growth rate? 2%. How 2%? Higher number is 20. Lower number is 14. In how many years? 4 to 7, 3 years. So every year the fall is 2%. 20 will become 18. 18 will become 16. 16 will become 14. Any doubts in this? Clear? Two major concepts I've done. Your institute study material has a model called H model of valuation. I really don't see this getting tested in exam. Also, we don't follow this in most of the times, but still material as study material as, that's why I'll discuss this H model. I don't see this to be very critical because there are logical gaps here. Okay, what does H model say is, a company will grow at two rates. One is called extraordinary rate and second is a stable rate. Like last question, last to last question we did, we had 40%, then it became 10%. Extraordinary rate and there is a stable rate 40% and 10%. This 40 to 10 transition will happen over 5 years, 10 years, 15 years, 20 years, some period. H model says for doing valuation, you assume that stability happened today itself. Stability happened today itself. Assume that way and do it. Okay, assume that way and do it. Dividend paid in last year 25. Cost of equity 8%. High growth rate 12%. Now long term growth rate 5%. High growth is for only few years and then it will stabilize at 5%. Number of years for transition from high growth to the low growth rate is 5 years. In 5 years this transition will happen. Assuming today it is stable. Today itself it is stabilizing. If it stabilizes today, P naught is equal to D1 by KE minus G. What was the last year dividend in this example? 25. Today stability happened. Today stability. Stability means 5%. 25 plus 5% is K is how much in this example? Growth rate 5%. Tell me this first. I'll again repeat. First, you have to assume stability happened today. Stability happened today. Whether logical, not logical, let's not worry about it. That's why this is not predominantly used in problem solving, practical world also. So, assuming it stabilized today, D0 into 1 plus normal growth rate. What is normal growth rate? 5% divided by KE minus normal growth rate. Assuming it stabilized today, there is one part of the calculation 875. One part of the calculation 875. Then he said, you are saying it stabilized today, which is not logical, which he also agrees. Stability today is not logical, and he also agrees saying that no, stability did not happen today. First he says stability happened, then he says stability cannot happen today and all. This is not logical. Then he goes ahead and says, I want to give some extra to you because you are growing at a high rate. You are growing at a high rate. I want to give you extra value. The growth is 12%. This will become 5% in 5 years. So ideally what he said is 12 will become 5, gap is 7%. Next year 12 would have become 10, gap is 5%. Then it would have become maybe 8, then it would have become 6, then it would have become 5. It will reach 12 to 5 in some years. In how many years? 5 years. So he says there is a extra growth of 7%. Extra growth of 7%. 7% benefit you will not get for all 5 years. Some years you will get 7% extra, some year 6% extra, some year 5% extra, some years 4% extra, and ultimately you will reach that number. So he says this extra growth you are getting, we will give extra value for that. What is the extra value? Today's price, that is today's dividend into the extra, but the benefit is not for 5 years, benefit is for half of 5 years. Benefit is for half of 5 years. Why not for 5 years? Because it is not extra 7% for all the years. 12 versus 5 in the first year, 10 versus 5 in the second year, 8 versus 5 in the third year, 7 versus 5 in the fourth year, 5 versus 5 in the fifth year. It will become equal after some time. So he says, I agree, there is an extra growth, benefit has to be given, that also is agreed, but the benefit can't be for all the 5 years. Benefit will be for lesser number of years. So he says give benefit for half of the transition period. Logic for half and all is not explained. Okay, half of the transition period, which is 2.5. This is like extra value discounted at same KE minus G. Discounted at same KE minus G. I'll explain the formula again. The formula which is used is D0 into 1 plus stable growth rate divided by KE minus stable growth rate, assuming stability happened today itself. 25 into 1 plus 0.05 divided by 0.08 minus 0.05. Extra benefit, same denominator. Extra benefit, same denominator, same 25. On this 25, give benefit for your extra growth. What is the extra growth? 0.12 minus 0.05. 0.12 minus 0.05. How many years benefit? Not 5 years. The benefit is for half of the transition period. Why half? Because few years you are above that by 7, 6, 5, 4. Ideally, you should not give benefit for 0.12 minus 0.05. You should have given for lesser period, lesser growth. But they said let it be as it is, but give benefit for half of the transition period. Half of the transition period is 5 by 2. Can you tell me what is the answer to this? 25 into 0.12 minus 0.05 into 5 by 2. 145.83. This part I would want you to do day before exam. If at all ICI, I don't see it to be tested. Again, I really don't expect this to be tested. It is there in institute study material. If at all they want to make a complex paper, because the recent AFM, lot of students score exemptions. If at all they get into a tough paper, two ways they'll get into. One is reverse working questions. Second way, they may ask questions which are unexpected. Areas which are unexpected can be asked. And third one is asking extremely complex question. If they end up asking extremely complex question, even if you solve another 1000 questions in my class also, you will not get grip on those questions. So there are increasingly people will talk about saying difficult paper can come. It's not in our control. You don't worry about the difficulty of the paper. You do your part of preparation. A difficult or easy paper I cannot really estimate. May 24 was a simple paper. November 24 was a reverse working, little challenging paper. May 25 easy. September 25 easy. Most of the times you will be in a position to answer it with the concept book full understanding itself. If you have good understanding of concepts, you will be able to handle it. Else you will find it difficult. The last question which I did, that growth rate calculation, if it suddenly comes in exam, you will start struggling, saying that what is this, what have they asked. Now I have done it, you will be able to do it. But now what I will do is, I would have done some other question where I did not discuss a reverse working. They may end up asking a reverse working there, which because concept clarity grip is not there, you will end up struggling. So that is the only point. As long as you have grip on the concept, any type of question can be handled. Extremely complex paper, again I'm repeating, if it becomes very difficult paper, I can do another 1000 questions in my class also. Grip will not come. Not only for you, if it's a very different kind of a question, it is difficult for me also to understand and then get to the answer in exam stress will be difficult only. Clear? Can we proceed? Done. So we are done with H model, which there is the same example is there in the study mat, in my question bank. Okay, there are certain other approaches of valuation. Before that, I get to another area, and I'll come back to this. How to compute cost of GDR? GDR is Global Depository Receipt. Let me first explain this, and then we do the cost calculation of this. What is Global Depository Receipt? Is Indian company. Let's take example Infosys. Infosys India wants to raise money from US investors. I want to raise some 10,000 crores. I can do an IPO in India, IPO or a revised fund offer, and get money from public, or a rights issue and I get money from public. But when the size is very high, I want US participation, UK participation. I want these guys to participate in my company. They are saying, yes, we like Infosys, but we will invest only in US dollar. We will not give you INR and all. I don't want to take any currency risk and all. I'm ready to invest, but I'll invest only in US dollar. I will not give INR and all. Don't expect me to give INR, which is where this instrument will come called as GDR. GDR is called Global Depository Receipt. If you issue this in US, it will be called American Depository Receipt, ADR. If a US company issues it in India, it will be called Indian Depository Receipt, IDR. The name is Depository Receipt. It can be called Global Depository Receipt, American Depository Receipt, Indian Depository Receipt. Somebody is going to issue this at some place. Infosys, what it does is it deposits some 10,000 shares with a custodian bank. Somebody is going to act as a custodian bank, some financial institution. I give and hand over 10,000 shares to them, not physically, but in some way I give it to them. Infosys, once I give this to the custodian bank, he says 10 shares can become 1 GDR. 10 shares can become 1 GDR. So 10,000 shares will become 1000 GDR. 10,000 shares will become 1000 GDR. I call the US the investor and gives him GDR, which is listed in America. It will be listed in US. Infosys ADR. It is a listed one. It is traded in the market. This is the share price of Infosys ADR, $16.5. Whatever is the chart you see here, this is for a year. Exactly same chart. Exactly same chart will be Infosys India chart in India. Exactly same thing. Just give me a minute. Infosys India. This is the chart in India. Exactly similar will be the chart in US. The price goes up in India, price will go up in US. Price goes up in US, price will go up in India. To put it very simply, ADR is nothing but an equity share. ADR is nothing but an equity share. Many a times in India, results are declared after the market closes. Once the results are declared, the price reaction may happen in US because the market will be open there. So people will say in US it has gone up, next day in India it will go up. Suddenly some news comes. In India it goes up, by evening it will react in US. So it is a equity share. It is a equity share. GDR are issued on the security of share and issues in US dollar. Investor invest money through GDR, gets regular dividend income when Infosys declares dividend. Instrument is same as equity. Cost of GDR is same as cost of equity. Cost of GDR is same as cost of equity. What is the formula? D1 by P naught minus F will come. Some flotation cost could be there, plus growth rate, plus growth rate. You can do this calculation in INR. You can do this calculation in US dollar. Answer will remain same. Answer will remain same. What is ADR? ADR is an equity share which is issued in US by an Indian company to raise money from those people. India declared dividend. Those guys will also get dividend. Only thing is one GDR could be equal to 3 shares, 4 shares, or could be equal to 1 share also. There will be some ratio. There will be some ratio. A global depository receipt is a financial instrument issued by a foreign depository bank representing shares of a company. It allows investors to trade shares in international market without direct ownership of underlying share, enhancing global accessibility and liquidity. My US Infosys India shares are listed technically there, so people will be interested. Cost of GDR is same as cost of equity. Cost of GDR D1 by P naught minus F plus growth rate. Let's see an example. Come dividend price. First of all, I don't like this come dividend price. I don't like this word come dividend price. Come dividend price means first get the ex dividend price. Come dividend price is 400. Dividend is how much? 20. So the share price is not 400. The share price is 5 shares underlie 1 GDR. 5 shares underline 1 GDR. So 1 GDR is equal to 5 shares equal to 5 into 380,900. 5 into 380,900. Shares will be priced at a discount of 20%. I want to make them happy. I want to issue it at a discount of 20%. That's my wish. At a discount of 20%. So my issue price is minus 20% here. Issue price is minus 20%. What is the issue price? 15 or $15.2. 100 rupee per dollar. 100 rupee per dollar. You can convert into dollars. How will you convert? Divide by 100. Divide by 100. $15.2 is the issue price per GDR. 15.2 is the issue price per GDR. Compute cost of GDR. Now, how will I calculate cost of GDR? Is very simple. K is equal to T1 P naught minus F plus growth rate. This entire calculation, you can do it in dollars, you can do it in INR, final answer will remain same. 1 GDR is equal to how many shares? 5 shares. Last year, dividend per GDR is 100 rupees, 5 into 20. Last year, dividend per GDR is how much? 5 into 20, 5 into 20, 100 rupees, 5 into 20, 100 rupees. What is the growth rate? 10%. 100 plus 10%. I wanted to issue GDR. Ideal issue price of the GDR. Ideal issue price of the GDR is ideal is 1900, but I want to issue it at 1520. 20% discount I want to give. I think there should have been a flotation cost also. Let me just see the solution. Yeah, it's missed in the question. 5% flotation cost is there. Okay, it got missed out in the question while typing. 5% flotation cost is also there in the question. Minus 5% of 1520. 76. It got missed out in the question. Okay, plus growth rate 0.10. This will be the cost of GDR. Cost of GDR. Can I do it in dollars? Divide your numerator by 100. Divide our denominator by 100. That is dollars. Keep it in rupees. Keep it in dollar. That's your wish. Any doubts on this? You get some 17.62%. There was that typing mistake. That's okay. 5% flotation cost is there in the question. Any doubts on this? I'll repeat again here. Concept is very simple. Infosys India wants to raise money from US investor. They like my company, but they are not ready to invest in Indian currency. So I deposit with maybe a custodian bank, issue shares there. Issue shares means issue ADRs there. It is listed there. I have to comply with whatever listing provisions are there, declare results, everything I have to do. So I have to declare results. I have to comply with all the provisions of the US regulators. Trading will happen. Dividend declared. Dividend will be passed on there. Clear? Able to understand this? Done. So for calculating issue price, you will have to know one, what is the ratio, and is there any discount you want to give, and is there any flotation cost. We'll do a problem around this in some time. Any doubts on this? Done. Okay. In that step up growth model, the multiple step up growth model, we saw a question where price was to be calculated. We saw a question where growth rate was to be calculated. We saw a question where dividend was to be calculated. And there's another question where cost of equity itself is to be calculated. Cost of equity itself is to be calculated. What happens there is what we are going to see in concept 26. Cost of equity itself is missing in the question. Now, the formula for KE we follow is what? D1. But when I use this, I ask you what is the growth rate, you start giving me two different answers. You say 10%, 12%, 14%, 16%. I cannot use this formula. I cannot use the formula till you give me a single growth rate, and you will give different growth rate. You will give different growth rate. Cost of equity with multiple growth rate. Direct formula of concept 9 cannot be used as growth changes. As growth changes. Then what are we going to do? We are going to follow an approach called IRR approach. How does it work? You will understand as we proceed with the discussion. So we have seen earlier calculating price, calculating dividend, calculating growth rate, and now KE itself is missing. Take the current market price as outflow of the investor, assuming we buy it today. I go and buy the share today. Whatever I pay today is my outflow. Compute dividends till the stabilization phase. Dividends you can calculate. How will you calculate dividends? Base dividend is given, growth rate is given. Take terminal value based on perpetuity valuation. What is perpetuity valuation? P7 is equal to D8 by K minus G. P8 is equal to D9 by K minus G. Discount above and compute NPV. If you get exact zero, it means that is the rate which is investor earning. IRR, if you get NPV 0 means IRR is equal to that rate. That is the rate investor is earning. We are calculating what investor will earn. IRR of the investor is cost of equity of the company. IRR of the investor is cost of equity of the company. More clarity on this will come as I proceed with the problem. There is one good example which is there here, and a question is there in institute study material. I'll do the question of institute study material. Example, you will do it at home. Both are same. My MCQ will be lesser, 2 years or 3 years data. Institute study material question will have more number of years. I'll explain again. Here, I am not giving you KE. I'm not giving you KE. So if KE is not available, I will have to calculate IRR of the investor. How will I calculate IRR of the investor? I buy the share today by paying the price given in the question. First year get dividend, second year dividend, third, fourth, fifth, sixth, till it stabilizes. And there is a price. Discounted at KE. What is the KE? You will assume some rate. You will have to assume one only. So you may assume 5%, 10, 15, 20, 25, 30. In my MCQ, when you do, I have told 22 and 23. So some table has to be given below the question. Use 22 and 23, some rate I have told. So I'll follow one rate, get NPV. Positive NPV. Answer is your IRR is very close to it. I need one positive NPV, one negative NPV. How we do IRR and all, I'll not spend time now. That I'll spend when I go to capital budgeting, because IRR is discussed there. But I need one positive NPV, one negative NPV. Understood the concept till now? We have seen question where price is to be calculated, growth rate is to be calculated, dividend is to be calculated, and now comes a scenario where cost of equity itself is to be calculated. Go through 23 and complete part 1. I'll come to part 2. I'll do only part 2. 2 minutes for you to complete part 1. Part 1 you complete it. I'm not even explaining it. I've started getting answers in live online for that. I think here also we should have done. What's the answer? 17.6. This is very simple. 1 rupee plus growth rate is 12%. 1.1 to D1. P naught is 20. Growth rate is 12%. You got 17.6%. This should be self-explanatory, easy to understand. Can we proceed? Instead of the situation in part 1, dividend will grow at 20% for 5 years and 10% per year thereafter. What is firm's expected or required? Required return on equity is cost of equity. Okay, part 1 was also cost of equity only. When you have single growth rate, D1 by P naught plus growth rate, or D1 by P naught minus F plus growth rate. But now comes the headache. They are saying 20% for 5 years, 10% per year thereafter. What we will do is, we will write year, cash flow, PVF, DCF, PVF at a random rate. What random rate? We got 17.6. I'll try 18%. I get positive NPV. Increase it to 20. I get negative NPV. Reduce it to 16. 18 is what my start will be. Why 18? 17.6 we got earlier. Okay. What are we going to do? Year, cash flow, PVF, DCF. Year 0, I buy the share. Year 1 dividend. Year 2 dividend. Year 3 dividend. Year 4 dividend. Year 5 dividend. At the end of year 5, P6 by D6 by KE minus G. Clear? Able to understand this? We will get NPV. Positive, great. Negative, then you will have to increase, decrease. Exact 0 you are getting, best. Exact 0 I get, answer is over there itself. Exact 0 we may not get. Any doubts on this? Any doubts on this? Now write computation of IRR. Computation of IRR. Computation of IRR in bracket cost of equity. Have space for 8 columns. 4 columns we are opening now. Have space for 8 columns. Okay. Year, cash flow, PVF at 18%, DCF. In Excel, if I do it, I can use a function called goal seek. It will give me exactly the answer, 18.5, 6, 7, 8, any number. Directly I'll get it. In your notebook, you need one positive NPV, one negative NPV. How IRR is calculated, formula and all, you may be aware. You have done it at Inter also, but I'll spend time when I go to capital budgeting. Year 0, I buy today. What is the price? Minus 20. Minus 20. First year, last year dividend was 1 rupee. What is the growth rate now? They said 1 plus 20%. 1.2. 20% is the growth rate. Year 2, again what is the growth rate? 20%. Year 3, 2 decimal, let's keep it as 2 decimal. 7, 3. Year 4, 7, 3 plus 20%. Year 5, 2.49. Any doubts on any of the numbers here? Again year 5. D6 by KE minus G. D6 by KE minus G. What is the growth changing from 20 to 10%? 2.49 plus 10% divided by KE. I have taken it as 18. My assumption is it is 18. Later on we will increase or decrease the KE. As of now we are taking it as 18%. 18 minus 10%. 18 minus 10%. 34 point. Any doubts till this? That's all. No writing beyond this. Okay. I don't want you to write. If you have understood till this, it is over. Calculation, I don't want to waste time now. Any doubts on this? Any doubts on this? First year dividend, second year dividend, third year dividend, fourth year dividend, fifth year dividend, and at the end of fifth year, perpetuity valuation. If we get positive, we increase or decrease. Listen, when you do revised NPV, revised 19 or 20, this number has to be calculated again. Year 5 number again. Year 1 dividend will remain same. Second year, normally whenever you do any revised NPV, cash flow remains same. In a capital budgeting problem, year cash flow PVF DCF, same cash flow, again another PVF DCF. But here, year 5 number, denominator can become 19 minus 10, 20 minus 10, the values will undergo a change. Any doubts on the calculation till now? Beyond this, be in listen mode. I did all these numbers. Some rounding of differences can be there. Let's not worry about it. We got. I've done it little differently here. Let's not worry about. NPV is going to be 0.29. Okay. When you do calculation at home, you'll find NPV as 0.29. NPV will be 0.29. What is or let's do it here. Let's do it here. Do 4 decimal. Presentation is little different here. 1 divided by 1.18. 4 decimal they have told. 8475, then 7182, then 6086, 5158, 4371, and again 4371. You'll have to multiply this. 2 decimal, we will keep it here post multiplication. 1.02, 0, 3, 0, 5, 0, 7. No, looks 0, 9, 14 point. I'm just going by the numbers you're giving. Tell me the total NPV. Printed answer, I've done it little differently. I think this is easier. Final answer 0.23. In the printed answer, it was 0.29. Okay, 0.29, 0.23. That's rounding of difference. Any doubts on 0.23? We have got positive NPV. We'll increase it. We will increase it. Increase it to what rate? 20%, 19%. Any number I can take. I'll increase it to 20%. I'll increase it to 20%. When I increase it to 20%, here that 20, 1.2, all that will not change. Perpetuity alone will change. 3 more columns. Cash flow, I told you 8 columns. Cash flow, PVF at 20%, DCF. Cash flow, PVF at 20% and DCF. We have already done one NPV. We got positive. I'm increasing. Solution, I would have increased it to 19. I don't know, whatever I've done. I want to do 20 now. Any number you can take. 1% also is fine, but I've increased it to 20%. Till 5 years, copy paste. Last year alone will change. Last year will change. Denominator is 20 minus 10. 27 point. Discount it now. You will get a negative NPV. You will get a negative NPV. Printed answer, we have done 18 and 19%. 18 and 19%. Net, the final conclusion, everything remains same. The logic is the same only, but here I've done 18 and 19. In class, we are doing 18 and 20. Do the same thing. Eight three three 6944 5787 4823 4019. When you multiply minus 20, it will exactly be 1. You should get exactly 1 mostly. All the 5 will be 1. And last year is 11.01. This will give obviously negative NPV. This will give negative NPV, 1 positive NPV, one negative NPV, IRR will be calculated. So we have seen all possibilities now. We have already seen one possibility of growth, one possibility of your dividend, one possibility of price computation, and the last possibility is KE itself. KE itself. Only thing is KE is more time consuming. KE is the most time consuming. Reason is you need one positive NPV and one negative NPV. Any doubts on this? What is the NPV you get? Okay, 3.99, negative 3.99. Any doubts on this? Any doubts on negative 3.99? Can we proceed? Any doubts on negative 3.99? Now, right, IRR is equal to, as of now, whatever I say, you please write it. Formula, everything I'll discuss there when I go to capital budgeting. L1 NPV at L1 divided by NPV at L1 minus NPV at L2. I will not expect you to remember this formula. I'll explain logic there, okay? Into L2 minus L1. When I go to capital budgeting, we will discuss it. Into L2 minus L1. L1 NPV at L1 by NPV at L1 minus NPV at L2 into L2 minus L1. L1 means lower rate, 18. What was the NPV at 18%? Divided by 0.23 minus of minus 3.99 into L2 means higher rate, L1 means lower rate. Broadly, the number will match. Some variation can be there because we took 18 and 20. Solution is 18 and 19. 18.11%. All possibilities seen. This is what, if at all step up growth model is tested and they want to twist, they can twist in multiple ways. Any doubts on this? Can you proceed? Able to get clarity on this? Any doubts? Done? Printed answer is also same thing, but slight up and down variation I have done. Any doubts on this? We have done till concept 26. I go back to two concepts which are pending, I think 2-3 concepts pending. P multiple approach. An approach which doesn't need any major discussion. As you are aware, P multiple is EPS into P multiple is the fair price. P multiple can be given in question. Great. If not given, there are two ways of calculating P multiple. If you are doing 100% payout, P multiple is 1 by cost of equity. P multiple is 1 by cost of equity. Another approach, which is not a very logical approach, is 1 by return on equity. What is return on equity? Is EPS by BVPS. Inverse is BVPS. So the second approach is followed if you make this assumption. Book value and market price is same. With that logic only we are going to do. Book value and market price is same. P multiple ICI takes us 1 by ROE rather than 1 by cost of equity. With the logic is book value per share is equal to market price per share. Book value per share is equal to market price per share. They may not give it in the question, but this is the logic. They'll be doing 1 by ROE, 1 by ROE, return on equity, 1 by return on equity. ROE 8%, P multiple 1 by 8%, P multiple 1 by 8% into EPS is the fair price, Under P multiple approach, 1 by return on equity. What is the logic for return on equity? ROE is EPS by BVPS. Inverse is BVPS by EPS. Logic is BVPS is equal to MPS, and which is what we are calculating. Any doubts on this? Any doubts in this part? Can we proceed? Because P multiple is MPS by EPS. Here ROE inverse is BVPS by EPS. This is one approach. Along with that, they may ask an approach called earning growth model. ideally an approach not to be used, but sometimes question may ask. What is earning growth model is D1 by KE minus G. Don't use D1, use E1. E1 means earnings of the first year. Earnings of the first year. Instead of using dividend, you will use earnings of the first year, which is called E1 divided by KE minus G. E1 divided by KE minus G. We normally use D1 divided by KE minus G. Here we are going to use what? E1 divided by KE minus G. When will we use? Question specifically may tell use earning growth model. Clear? Any doubts on this? Any doubts on this? Okay, Mr. A is thinking of buying shares at 500, having a face value of 100. He is saying some bonus will come in the ratio of 1 is to 5. Dividend is 20%. Same will be maintained on the expanded capital base. He intends to sell the shares at the end of 7th year at a price of 900. Incidental expense for purchase and sale. He expects a minimum return. Minimum return of 12% is KE. Minimum return is KE. Should Mr. A buy the share? In order to decide whether I should buy the share or not, I have to calculate the fair price. How will I value the share? Present value of future cash flows discounted at investor required rate of return, technically Gordon's formula. They make it more simpler for you, saying that I'll give you first year dividend, second year dividend, third year till seventh year, and at the end of seventh year, you don't take any effort. I'll give you the price also. At the end of seventh year, I'm giving you price also. What is the price given in the question? 900. Only thing is, when I sell it, I have to incur some expenses. So I may not get 900, I may get little lesser. I may get little lesser. So what we are going to do, year, cash flow, PVF, DCF. In class, you will write year and cash flow. PVF, DCF, we will not do now onwards. You will write year and cash flow with me. PVF, DCF, we are not going to waste time. I'll tell you the total from the question itself. Clear? Able to understand this? Let's start. Year, cash flow, PVF, DCF. You need not write the PVF and DCF column, okay? Heading you can write, but you are not going to fill it. Year, cash flow, PVF, DCF. What is the dividend the company is going to pay? 20% on face value. On face value. First year 20, second year 20, third year 20. There is some bonus paid. When is the bonus paid? During the fourth year. I had one share. Now one share will become 1.2. Decimal not possible, but let's assume decimal is possible. I may not be buying one share. I may be buying 100 share. 100 would have become 120. Bonus is in what ratio? 1 is to 5. So my 1 has become 1.2. On this 1.2, I'll be getting 20 rupees either from the fifth year or from the fourth year itself. It all depends on when is the bonus made and when is the dividend declared. This I had touched upon one mutual fund question saying that whenever a bonus or a rights issue is made, on that bonus share, you may get dividend, you may not get dividend. Your one share has become 1.2 during which year? During the fourth year. I assume fourth year I get on 1.2. On 1.2. How 1 became 1.2? 1 is to 5. There is a bonus in the ratio of what? 1 is to 5. So 1 share has become 1.2 share and 1.2 into 20 rupees per share. Year 4, 24. Year 5, 24. Year 6, 24. Year 7, 24. What is 24 is 1.2 into 20. 1.2 into 20. I purchased one share. It increased to 1.2 share. Any doubts on this? At the end of 7th year. At the end of 7th year, I'll sell the share. What is the selling price? 900. Now listen, you will not be selling one share. You will be selling 1.2 share. You will be selling 1.2 share. This you have to be aware of. Why 1.2? Some bonus got declared in between. 1.2 into 900. Some incidental expenses are there on purchase. 5% of the market price. Incidental expenses are 5% of the market price. 1.2 into 900 minus 5%. 1026. Your work is over now. Now onwards, only listen mode. Any doubts on any of the numbers here? Any doubts on any of the numbers? Yes, purchase, both purchase as well as sale as well. It says incidental expense for purchase and sale is 5%. Purchase 5%, sale also 5%. Purchase part I'll explain in some time. As of now, we have done the sale. Any doubts on this? What is the required return of the investor? 12%. We are not doing, beyond this you will not do, okay? PVF at 12%. This will unnecessarily take a lot of time at your end. 1 divided by 1.12. We will do DCF. This is the fair price of share. 563.68. 563.68 is the fair price of the share. Now, after 563, you will write along with me, okay? Then write maximum purchase price, right? Maximum purchase price. Maximum purchase price plus transaction cost is 563.68. Price, I will have to buy, pay cost on that. Put together, I can pay 563. Put together, what is put together? Purchase price as well as transaction cost. I am incurring transaction cost on purchase as well as on sale. If somebody say it is available at 550, don't give answer 550, 563. You cannot compare that way. 550 on that I have to pay 5%. If I pay 5% on 550, it will go to 580 or 590. It will be a bad purchase. So purchase price plus the transaction cost is 563. Purchase price is A. Transaction cost is 0.05A. Purchase price is A. Transaction cost is 0.05A. 5% transaction cost you have to incur. Put together, I can pay 563. Why? I am getting 563. I will pay 563. Getting 563 from the share, paying 563 for the share. Any doubts on this? Tell me the purchase price. And question says it is available at what rate? 500. I'm happy to buy at 500. I'm happy to buy it. You cannot give answer directly with 563 and 500. 536 and 500 is comparable. Should Mr. A buy the share? Yes, he can buy. What maximum price? 536.84. 536.84. Why 536? Because including the transaction cost. Including the transaction cost, I will pay 563.68. Any doubts on this? Able to understand this? Clear? Can we proceed? I'll explain again. My inflows total is 563. In a normal scenario, max purchase price is 563. In a normal scenario. But here purchase price plus transaction cost is 563. Purchase price plus transaction cost is 563.68. Any doubts on this? Can we proceed? This is where two concepts were there. Now this question I thought I'll do problem first and then concept. Impact of bonus on terminal value. Whenever a bonus is declared, what is terminal value? Is last year value. Whenever a bonus is declared, be careful. Sale proceeds is higher number of share into selling price. What is higher number? 1 became 1.2, 1.5, 1.8, 1.9. To take that higher number of share and then multiply with the selling price. One share can become 1.2, 1.5. Whatever we did is the same example here. Okay. Second part is maximum purchase price, no transaction cost, maximum purchase price 563. No transaction cost, maximum purchase price 563. If it is there, 563 divided by 1 plus 0.05, which is what you would have done. It is the same formula only we have done. I told you in different way, 536.84. If you are going to pay transaction cost, maximum purchase price is not equal to the price we calculated or the present value we computed. Any doubts on the concept here? Clear? Two concepts are there for only one single question. You have to divide by 1 plus transaction cost. No transaction cost, 563 is the maximum purchase price. Any doubts in this? Can we proceed? Clear? Okay, I had told you to go through those ratios part. If you have gone through it, it will be easier whatever questions I'm going to discuss now. If you have not gone through it, I cannot really help it. My explanation, I may do little bit only, or I may not do even the explanation. Format of income statement, it starts with sales, deduct cost of goods sold, you get GP, deduct operating expenses, you get operating profit, which is called EBIT, deduct interest, you get EBT, deduct tax, you get EAT, deduct preference dividend, you get EAES, number of equity share, EPS. How interest is calculated? Problem silent, respective debt into the respective interest rate. Problem gives effective interest rate, total debt into effective interest rate percentage. How is this making a difference? If at all you had solved the MCQ, you would have seen this at home itself. You see this example, 8% debenture, 125. 10% bond, 50. How do I normally calculate interest? 125 into 8%, 50 into 10%. Question says effective interest rate is. So ICI said add this and directly do into 8%. ICI said add this and directly do into 8%. In fact, in one MTP, they have given this as a MCQ question and they have asked if 8% is the effective rate, when was the bond issued exactly? April, May, June, July, August, something like that. They have asked it, and it is there in my MCQ question. You see that later on, okay? But they asked exact period when the bond was issued, because your interest outflow is not for the full year. Interest outflow is for the part of the year. 10% if you pay one full year, 8% if you pay, 10% equal to 12 months, 8% equal to maybe 10 months or 9 months, something like that. They had asked this as one MCQ question. Any doubts on this? Interest calculation, normally what you do? Interest rate into the debt plus interest rate into the debt. But if they give you single effective tax rate, effective interest rate, you can add up the overall debt and multiply with this. I 100% wanted you to do this MCQ and this concept. You will then only appreciate. Otherwise, this discussion may go above your head. I cannot really help it because I don't want to spend time on this area. Purely CA inter area. We'll be doing a question on this. These are important ratios. Unless you have grip on this, you will struggle in. I may use ratios in some 30-40 question. Suddenly I'll say debt equity ratio. Suddenly I'll say debt ratio. Suddenly I'll say equity ratio. Suddenly I'll say asset turnover ratio, inventory turnover ratio, COGS ratio. This entire category, I don't want to rush through and explain it. It will not go on your head. So I am not explaining important ratio. I've already told you. Unless you have a doubt in any ratio, you can tell me. If at all any category at home when you saw, if you found it difficult, let me know. I'll explain that category. If you live online guys also, if you have found any category difficult, I will explain. If you have not gone through it, I cannot really help it. This category I wanted you to see purely CA inter. If at anything of CA final is there, I can explain. Clear? Can we proceed? Any category you want me to discuss, then let me know. There were terms like capital employed, all this done at CA inter. You should have ideally understood it. I'll be discussing this suddenly in business valuation, suddenly in derivatives, suddenly in maybe in mergers and acquisition. We have already discussed some of these ratios. Portfolio we may discuss. If any doubt is there in any category, let me know. I've not got any points from live online guys, which means I assume you are okay with all the category. I'll come back to that one concept which is pending is FCFE approach. But before that, let's come to question 30. This is already done by you as an MCQ, okay? Already done by you as an MCQ, but it's the same question here. If you have done the MCQ, you would have found this question there also. Question 30, let's look at. Following information are available for PQR Limited for the year 2008. 8% debenture, 10% bond, equity shares, reserves and surplus, total asset, asset turnover ratio, effective interest rate, tax rate, operating margin, dividend payout ratio, current market price, required rate of return on share. You are going to do major chunk of it. Draw an income statement. What is income statement? Sales less COGS, if COGS data is there, or less operating expenses, EBIT less interest, EBT less tax, EAT less preference dividend, EAES number of equity share, EPS. Sustainable growth rate, ROE into retention ratio. Growth rate is ROE into retention ratio. What is ROE? EAES by amount of equity. Retention ratio 100 minus payout ratio. Fair price using dividend discount model. Discount model is Gordon's model, D1 by KE minus G. What is the KE? KE is given in the question. What is the KE here? Required rate of return of investor 15%. And what is your opinion on investment? You do the income statement, you do everything. I'll give you around 6 minutes. You start doing it. After 6 minutes, I'll do it in the screen. Okay, 6 minutes for you to do this now. Okay, you keep doing it. I'm now doing it in the screen. You can check it in case you want. I had to do an income statement. I'll keep explaining and doing it. Particulars amount. Sales will be calculated through a ratio called asset turnover ratio, which is sales by asset. Sales is asset turnover ratio into total asset, 1.1 into 600. If a student is not aware of this ratio, problem is over for you in the first step itself. You write wrong sales, the problem gets over there itself, nothing else to be done at your end, entire solution will go wrong. Minus expenses 660 into 90%. Operating profit is 10%. 90% is expenses. 594. Operating profit is 66. Interest, if the effective interest rate was not given, 125 into 8, 50 into 10. Maybe because it is given, somewhere it is in between. So this interest number comes out to be 125 into 8, 50 into 10. What's the number you get? Sorry, not 175 into 8. 175 into 8, 14. 52 is PBT. Taxes, which is 20.8. PAT is, EPS is 31.2 divided by how many shares are there? 10. EPS is 3.12 and dividend is 0.52. Dividend is 0.52. Any doubts on this? Any doubts on this? Initial part itself, you make a mistake, then it is gone, which is your asset turnover formula. ROE is equal to EAES by equity. EAES is 31.2. Equity is 100 plus 300, 7.8%. 7.8 ROE into retention. 7.8 into 83.33, 6.5%. Whatever dividend we have calculated, you can take it as D0 or D1. I don't have an answer to it. It is assumption. I'm not sure what is there in the answer. Any doubts on this? I think problem is over for me. Any doubts on this? Your fair price is 0.52 taken as D0 plus 6.5% growth rate divided by 15 minus 6.5%. Somebody wants to say, no, this is D1. Go ahead and take it. That's your wish. I have told what does I say answer here. Time permits in exam. Give two answers wherever confusion is there. If there was a consistency in ICI solution, I would have told this is what they will follow. Consistency may not be there in many questions. Any doubts on this? Can we proceed? This entire question is extremely simple if you are aware of ratio analysis. If you are not aware of ratio analysis, entire solution will go wrong. Again, I'm repeating, in the categories of ratios, if at all you want me to explain any category, last time I'm asking, any category, if you have not got clarity, you can let me know. else I proceed ahead. Good MCQs were there below that. Ideally, if you had solved it, you would have got the required grip to face the exam. Any doubts? Can we proceed? Clear? Capital gearing ratio. This entire capital structure or the only capital gearing? Okay. What is capital gearing ratios? Capital structure basically means composition of debt, equity, and preference. Capital structure means in that we have all the five categories. Debt ratio, debt divided by debt plus equity. Capital employed means debt plus equity. Preference is not there for practical purpose in most of the company. Equity ratio, equity by debt plus equity. Debt equity ratio, debt divided by equity. Capital gearing ratio is another name for debt to equity ratio. Another name for debt to equity ratio. Only point in a capital gearing ratio is preference. If at all a question has preference capital, I used to work in a rating agency. Any company had preference capital. We will analyze the nature and either add it to debt or add it to equity. There are companies in the practical world which issue 0.01% CCPS. What is CCPS? Compulsorily convertible preference share. For all practical purposes, it is equity. Even I think your accounting standards may talk around it. But when I used to work in a rating agency, we used to take it as equity. Another company, 12% redeemable preference share. For all practical purpose, it is like a debt. We add it to debt. Practical world, companies will not issue preference capital like 12% and all. Reason is if I issue it as debt, at least I get tax benefit on that. Why will I issue preference? Capital gearing ratio is the only ratio which says don't apply your brain and all and say preference is part of debt or preference is part of equity. Preference will always be added to debt. Preference will always be added to debt. The formula for capital gearing ratios: fixed charge bearing capital. Fixed charge means where you pay fixed amount. Interest is a fixed amount. Preference dividend is a fixed amount. So fixed charge bearing capital divided by equity. So I pay fixed interest, fixed preference dividend. That technically there is no difference between debt to equity ratio and capital gearing ratio. Practical world, preference you may not find in any company. Clear? Got any doubts? Any other ratio if at all you want me to explain? Any other ratio you need explanation, you'll have to tell me. Dividend yield ratio. Okay, there is an explanation needed on yield ratios. Now, yield as such, yield, okay, the formula is here. What is earned by what is invested. Yield basically means what is earned divided by what is invested. Dividend yield, dividend is earned, price is invested. Dividend is earned, price is invested. Earning yield, earning is earned, price is invested. Earning is earned, price is invested. Dividend yield, dividend by price. Earning yield, earning by price. Earning by price. Yield means what you earn by what you give. What you earn. Return on equity. Equity guys earn EAES. They give equity. Return on asset. Profit is earned. Asset is invested. Return on capital employed. EBIT is earned. Capital employed is invested. Same logic is dividend yield and earning yield. Dividend yield means dividend is earned, price is paid. Earning yield means earning is earned, price is paid. And opposite of this is dividend rate. Dividend rate is not there. Dividend rate is dividend per share by face value. Divided by face value. Yield means divided by market price. Any other category, any other ratio you need explanation. To clarification, do we need to take preference dividend if not cumulative in capital gearing? We take non-current liability. Okay, there are two more doubts. The doubt which has come is, do we take preference dividend even if it's non-cumulative? Capital gearing, no brain application. Capital gearing means preference will form part of debt. Debt plus preference divided by capital employed. Debt plus preference divided by, debt plus preference divided by equity. No application, nothing, no extra thinking. Fixed charge bearing capital, whether dividend is cumulative, non-cumulative, whether it is a high dividend, low dividend. Second point is, do we take non-current liability in long-term debt? ICI for debt equity ratio or debt ratio has given multiple formula at CA Inter. The term debt can mean long-term debt. The term debt can mean long-term plus short-term. The term debt can also mean long term, short term, creditors, current liability, everything included. So it is an assumption based area. In practical world, again, I used to work in a rating agency. Our way of calculating ratio was different. Bank used to calculate ratio, their way of calculating ratio was a little different. Some variation will be there because formulas will be changed by people. Some people will prefer to take average numbers in the denominator. Some people will prefer to take only that year number in the denominator. So it can change based on people's way they look at. So whatever two doubts were there, I've clarified. If anybody else has any doubt, anybody else has any other doubt in the ratios, let me know. In case you need more clarity, there is a 12-hour video. I don't want you to see the 12-hour video, but if you open the 12-hour video, there will be something called a timestamp below that. In the timestamp, you will see me explaining each category of ratio. 20 minutes, 30 minutes will be every category. In the timestamp itself, you will find. If you have time, you need more clarity, you need to go through that timestamp, you will get clarity. CA inter ratio analysis 12-hour video is there. Just look at the concept, no problem solving, all that is not needed. Clear? Can we proceed? Now, why are we focusing on ratio? Reason is with ratio, I will do something called as fixed interest. So there is another doubt by Kavya. Fixed interest and fixed dividend, which I'm going to come to it. That I have not told you to look at. 30 and 31, I will be explaining now. I'll be explaining now. What is the purpose of calculating all this ratio? Purpose of calculating this ratios is I want to value a company. You have told Walter's model, Gordon's model. You have told your P multiple approach. So many models of valuation is there. The best way of model of valuation is called customized model. Now, what is customized model? I am going to value a company with some subjective calculation. For example, I want to value TCS Infosys. TCS has a P multiple of 25 times. Okay. So I feel Infosys value should be EPS of Infosys into 25. EPS of Infosys into 25. This is my belief that EPS of Infosys into 25 can be the value of Infosys. Or cost of equity is 10%. TCS. I want to value Infosys. Walter's model or Gordon's model, I can use the KE as 10% and do the calculation. Beta is 1.2. Using that, you calculated KE. Whatever different ways are there. Now, if TCS has a P multiple of 25, then Infosys got irritated saying that why 25? I am better than TCS. You give me 26, 30, 35, 40. Or I am weaker than Infosys. Either I am better than Infosys or I am weaker than Infosys. If I am better than Infosys, better P multiple or lower cost of equity. Better P multiple or lower cost of equity. How do I find I am better or weaker? By comparing ratio. Impact of ratio on required return. Required return means cost of equity. If you are better than the competitor, your KE will go down. Your KE will go down. KE going down, value will improve. KE going down, value will improve. So an organization today, you want to value TCS, take Infosys data. Infosys P multiple will be there in the question, in the historical information. Take that P multiple, value TCS. You may see obviously a difference. TCS, I think, may have a better P multiple. Infosys can have a lower P multiple. Reasons? The various ratios. What are the ratios you can look at? Whatever is relevant. One ratio is growth rate. Growth rate is also a ratio only. Growth rate. Maybe I will look at net profit margin. I'll look at GP margin or an operating profit margin. Some pointers I will take and then adjust the P multiple. Our ratio is better than the industry. P multiple will improve. Required return will decline. Our ratio is weaker than industry. Weaker than industry. How much should you adjust? Your assumption. That is your assumption. If you are better, you will command a lower cost of equity or a higher P multiple. If I look at practical world, Infosys has a P multiple of 21. Okay, now it is almost same. Earlier TCS used to be on the higher side. TCS share price has gone down over the last few months. 21.5 to 21.81. The P multiple is same. Ideally, TCS earlier commanded a higher P multiple. Now, in order to compare this, which is better, which is weaker, I will take the help of ratios. I'll take the help of ratio, which is where ratio understanding is needed. So what we are going to do is capital gearing ratio of industry 0.75. What is capital gearing ratio? Debt plus preference divided by equity. My company equity share capital 100, so denominator is 100. My capital reserves and surplus is 150. Preference is 100. Debt is 200. My capital gearing ratio is 2 times. Industry is at 0.75. I am at 2 times. More borrowing is a weaker company. More borrowing is a weaker company. So I am a company which is weaker than the industry. I am a company which is weaker than the industry. If I am a weaker company, my cost of equity will be higher than the industry. Then they are saying industry needs 10%. Required return is to be changed by 2 basis point for every 1 basis point deviation in capital gearing. You will see a question being solved where this is not written. You have to make assumption and proceed. But here in MCQ, I didn't want this headache. So what it means is industry is at 0.75. We are at 2, weaker by 1.25. Extra KE 1.25 into 2 times 2 basis point. Basis point means 0.02% for every 0.01% deviation. So my required return will go to 12.5%. My required return will go to 12.5%. Any doubts on this? Any doubts on this? I'll explain the logic again. I will calculate ratio. After you calculate the ratio, you have to decide you are better, weaker. Till this we are on the same path. After that, if you have decided better, KE has to go down. Till this, no changes. How much to go down is a subjective call. How much to go down is a subjective call. Somebody will say one ratio better, add 0.5, deduct 0.5. Another ratio, add 0.5, deduct 0.5. 0.5 addition, 0.5 deduction. 20 ratios are there. Started with 10, added 0.5. Deducted 0.5, deducted 0.5, deducted again 0.5, added 0.5, deduct. Like this you keep going on. Ultimately you'll get the KE for your company. You wanted to take 20 ratio. 20 ratio, that is a subjective call. Any doubts till this? So this is one point that I will compare. Now in this comparison, ICI has added one stupid ratio called fixed interest and fixed dividend coverage ratio. Technically there is no ratio like this, but they themselves have added this in the exam question. In one mock test, when they asked, they gave this formula itself in the question, saying that you use this formula because it's not a logical formula. It is not a logical formula. Interest coverage ratio means EBIT by interest. Preference dividend coverage ratio means PAT by preference dividend. I cannot club both of them together. I cannot club them together, but they have given this, which is PAT plus interest divided by interest plus preference dividend. Again, not a very logical ratio, but let's not worry much about it. In case question says fixed interest and fixed dividend coverage ratio, you have to start with PAT, add back interest, denominator is interest and dividend. Coverage ratio logical formula is source of paying something divided by what is getting paid. My expenses coverage ratio is my income divided by my expenses. Your expense coverage ratio is your stipend income plus any pocket money you get divided by your expenses. Divided by your expenses. What is the source of paying something divided by what is getting paid? Interest is paid out of EBIT. Preference dividend is paid out of EAT. So technically both are separate. They said we will club it together. So they said PAT, add back interest because that is what you're going to pay, divide by interest plus dividend. Divided by interest plus dividend. Any doubts till this? Any doubts on this? Can we proceed? Any doubts on this? My important point is, if ratios are calculated, you can understand you are a better company or a weaker company. Better company, P multiple will improve, KE will go down. Weaker company, P multiple will go down, KE will go up. Clear? Any doubts till this? Can we proceed? Ideally, if I am doing valuation, I will try to follow this approach. and I will see every question you do, you write year, cash flow, PVF, DCF, everything is given in the question. Practical world, PVF for 10%, you have to justify why did you use 10%, you have to give an explanation. That explanation will be this, saying that industry is at 12%, I believe TCS is a better company, weaker company. Using all this logic, I feel it as 10%. You have to give justification. In exam, everything is given to us, we are just doing calculation. Practical world, how are you saying growth rate is this number, how is the cash flow coming, everything has to be justified by us. Clear? Any doubts on this? Can we proceed? Okay, let's proceed with the discussion. We have one more approach which is pending, which is called free cash flow approach. Let's quickly understand this. Free cash flow approach, the formula is FCFE1 by KE minus G. The actual formula is not FCFE1, the actual formula is D1 by KE minus G. So the name used is FCFE1, but the real formula is D1 by KE minus G. Let's understand what is FCFE. As the name indicates, it's called free cash flow for equity shareholders. What is free cash flow for equity shareholders? A company earns profits of 20 lakh rupees. Okay, I have earned profit of 20 lakh rupees and depreciation was there. Let's assume some 10 lakh rupees is there. So I have a cash flow of 30 lakh rupees. This cash flow, whatever I have generated, we will not be adding back depreciation when I do calculation. I'll explain as we proceed. But cash flow is 30 lakh rupees. I have three purposes for this: working capital, capital expenditure, balance. This 30 lakh what I had, I have a working capital requirement of 20 lakh rupees. I need money for working capital purposes. So I need 20 lakh rupees for working capital. Company has said we need 20 lakh, but we will not use from our profits fully. 10 lakh we will borrow. Another 10 lakh we can take it from the profits which is generated. Or 60% we will borrow, 40% we will take it from this. So I need 20 lakh rupees. In this 8 from profits, 12 from borrowing. So out of the 30 lakh which is available, 8 lakh is gone. Out of the 30 lakh available, 8 lakh has gone for working capital purpose. I want to do capital expenditure. Another some 20 lakh requirement is there. Let's assume 30 lakh requirement is there. Again, I decided same ratio. 12 lakh from profits, 18 lakh from borrowing. So out of the 30 lakh, 8 lakh is used. 12 lakh is used. We are left over have 10 lakh. This 10 lakh is called free cash flow. Free cash flow means there is no use of this money. There is no utility of this money. I do not have a purpose for which this is to be used. So in an ideal situation, an organization should convert this free cash flow as dividends. Should convert the free cash flow as dividend. When you do not have any purpose of the money, you should not ideally keep it. Practical world, organizations don't do like this. For example, most of the IT companies will not have any purpose, but still they'll keep retaining, thinking that in future I'll need money. And suddenly they'll do a huge buyback and all because they have so much money available. They'll do a buyback or they'll do a big acquisition. So what is free cash flow is cash flow available after meeting working capital requirement and capital expenditure. In capital expenditure, we have a term called net capex. This depreciation, don't add it. You adjust the capex figure itself as capex minus depreciation. The capital expenditure requirement which we have a term called net capex. What is net capex? Is capex adjusted for depreciation. There are many businesses which do capital expenditure and their capex will be almost equal to depreciation. In that case, what will happen? 10 lakh fixed asset goes down to 8 lakh, goes back to 10 lakh, goes down to 8 lakh, goes back to 10 lakh. 8, 10, this will keep happening. They don't need extra money. Depreciation, whatever is there, that money which is not paid will take care of my requirements of the business. So we use a term called net capex. What is net capex? Capex adjusted for depreciation. So I will understand like this. EPS is 10 rupees. Depreciation is 20 rupees. Capex is 30 rupees. Net amount is 10. Net amount is 10. So I need 10 rupees per share. Instead of giving overall number, I've given per share number. It's easier for us to do. 10 rupees I need for what purpose? For the purpose of capital expenditure. Then I need 2 rupees for working capital. 10 plus 2, 12 rupees is needed. My EPS itself is 10 rupees and I need 12 rupees. Obviously not going to be sufficient. Then there's a debt ratio. What is debt ratio? Is debt divided by capital employed. So debt ratio basically means if you need 12 rupees, debt will contribute 0.6. Equity will contribute only 0.4. Equity will contribute only 0.4. Debt equity ratio. Debt will contribute 0.6. Equity will contribute 1. Equity will contribute 1. Debt ratio means debt will contribute 0.6. Equity will contribute 0.4. So you need 12 rupees. In this 12, profit 4.8, 40% only. Balance is borrowing. So from the EPS, I need only 4.8 from the profits. Leftover money is called FCFE. Leftover money is called FCFE. That can be FCFE 0 or FCFE 1. This year means 0. Next year means FCFE 1. FCFE 1 divided by KE minus G. Technically, this is a superior approach as compared to dividend model. Reason? Dividends you can adjust the way you want. Suddenly you will pay more, suddenly you will pay less. FCFE cannot be adjusted by management discretion. Management cannot suddenly increase it, suddenly decrease it. But free cash flows, dividends can be suddenly increased, decreased, but free cash flows are something which the business is generating. It is not on the discretion of the management. Clear? Able to understand this? So in an ideal scenario, FCFE should be equal to dividends of the company. Should be equal to dividends of the company. So this is not a new model of valuation. It is already learnt as dividend growth model. The name is called FCFE growth model. What is FCFE? Is PAT minus how much equity. Equity means retained earnings. Retained earnings is part of equity. Equity funding for what? Net capex and working capital. Equity funding is net capex into 100% minus debt ratio. If they give debt ratio, I want a complicate question, I'll give debt equity ratio. Debt is so much, equity is balance, debt is 10, equity is 100. Debt equity ratio means debt divided by equity. Equity will be 1 time, debt can be 0.5, 0.4, 2, 3, 4, whatever they give in the question. Able to understand this? Any doubts on this? Clear? Okay. In my material, I have added this as part of equity itself as a small area called stock lending. I'll explain it. I normally do it after derivatives, but here I'll be able to explain because some of you will have already knowledge of this. But anyway, derivatives knowledge is not fully needed. Let's understand what is stock lending. Stock lending basically means lender temporarily lends the share of a particular stock to a borrower. See, in practical world, I buy something, I sell it. I have purchased something and I will sell that shares. There's something called a short sell. What a short sell is, I today sell a Maruti car. I sold it to you. I sold a Maruti car to you. You are asking, give me the car. My plan was to buy Maruti car after 6 months. But today itself, I sold Maruti car to you. I don't know why I sold it, but I sold a Maruti car to you. You are now asking me to give Maruti car. What I did is, I came to a friend of mine, asked him, can he lend his Maruti car to me, assuming it doesn't make usage, non-usage does not make any difference for the time being. He lends this Maruti car to me. What I do with this? I give the Maruti car to you. You use it for 6 months. After 6 months, I will purchase the Maruti car and return to my friend. This is what the exercise is all about. I do a short sell. When I do a short sell, I sell something. Why will I short sell? Infosys today is at 1000 rupees. I feel Infosys price will go up. Then what I do? I buy Infosys today, sell it later. That is great to do. Infosys at 1000 today, I feel Infosys will go down to 500. Will go down to 500 in 3 months. If it goes down, obviously I will not buy it, but I want to do something else. I want to sell today at 1000. Sell first at 1000 and buy later at 500. Sell first at 1000, buy later at 500. This exercise is called short sell. This exercise is called short sell. I'm doing with something in my mind saying that normally people understand buy first, sell second. But what can also happen is sell first and buy second. In this exercise, when you do, the other party and all doesn't understand all this. He says, give me share. Because I've sold the share to you, you are asking me to give the share. So I go to a friend of mine, ask him to lend his shares to me. When he does this lending, he may charge something to me. He may charge something to me. This concept is called stock lending. What is stock lending is, I have sold shares of Infosys today at 1000. Why did I do this? I got 1000 rupees also from you. I did this with one thing in my mind, that after 3 months, it will come at 500, buy at 500 and give it to my friend. In this process, I'll make 500 rupees profit. I sold at 1000. This is my objective. Whether I make profit, not profit, that's a different story. For this, he may charge me some 100 rupees. I'm happy to give that 100 rupees to him. So, lender, owner who has shares and lends it, he will get a lending fees, which is his income. He will get a lending fees, which is the income of the person. Who is this person? My friend. My friend is going to lend the share. In between, if any dividend income comes, he is still the owner. He will get that dividend income. If at all any dividend income comes, he is the owner. He will get dividend income. For me, what will happen? I have to pay this lending fees expense for me. Apart from lending fees, my friend is saying, I don't believe you. You give me some guarantee. So I give him a guarantee from a bank. Bank charges me for that also. Bank is charging me. So I pay something to my friend. I pay something to my bank with only one objective. I will make some profit on this. If I make profit in this, these two expenses, net profit can be there, net loss can be there. Rare scenario, I sold at 1000. In between, Infosys gone up to 1200 or 1300. If price goes up, sell at lower rate, buy at higher rate, you will make a loss there. So you can make a profit on short sell, you can make a loss on short sell. Why are we doing this? Pure speculation. This is a pure speculative activity done by an investor with an objective, done by a speculator, not an investor, done by a speculator with an objective to make some quick money. So I sell Infosys to you today. You are asking me, practically this can be done through to Infosys futures. There all this headache will not happen. That you will understand when we do derivatives. But here what I did, I sold the share to you. You got the share from me, but you are asking me delivery. One thing I can tell you is I'll give you after 3 months. You start cribbing about it, saying that no, I can't wait for 3 months. So I go to a friend of mine, tell him, give me the share. I give the share to you. You keep the share with you. You are happy having the share with you. And in this process, he charges me something, bank charges me something, and on top of it, I may make a loss also on short sell. I may make a loss also on short sell. Lender, he is very happy. Whoever is lending, he will get lending income. He may also get a dividend income in between because he continues to be the owner. He continues to be the owner. This is the entire exercise. Any doubts first on the exercise? What is stock lending is? It is basically a temporary lending given by one person to another person. Does this happen in practical world? Yes, it does happen. There are apps which allow this to be done, and you can get some income out of this activity that will be paid by one person to the other person. Clear out? Any doubts till this? Move to some allied area. First allied area we have is rights issue and buyback of share. Once in the exam, you may find a question from this area, rights issue and buyback. Very simple area. Maybe we'll both put together, will take us maybe 1 hour kind of a discussion. Let's do this. Rights issue, as the name indicates, it is offered to existing shareholders at a price which is lower than the current market price. Why do I offer it at a lower price? To encourage the investors to participate in this exercise. So for them to participate in the exercise, I give them at a price which is lower than the current market price. Theoretical X rights. X means once the rights issue gets over, at what price will the share be quoted in the market? Once the rights issue get over, at what price will the shares be quoted in the market is called X rights price. Value of right entitlement. Every company in a practical world, when a rights issue is done, they will issue something called as RE, right entitlement. These RE are bought and sold in the market. You can buy RE, you can sell RE. What does buy RE and sell RE means? I got a rights issue. Rights issue means I have to give more money. I don't have money itself. Where will I give the money? So they'll give me this right entitlement. I can transfer my right to you and you can buy it at a lower price. So you get a benefit and for that you pay me some 2 rupees, 3 rupees, 10 rupees, 15 rupees. That's called right entitlement. The right which I have, I can buy it at a lower price. It's a good thing to do, but money is not there. Money is not there. So what do? I transfer to my friend. He buys the right from me, pays me some 10 rupees, 15 rupees per right entitlement. And if a rights issue happens and if that money is going to be used in some purpose and that can give you positive NPV, share price will go up by the amount of NPV per share. And if it will give you negative NPV, share price will go down by the amount of NPV per share. This is the formula. Existing shares into existing price, new shares into rights issue price plus NPV if at all there. Many question NPV data will not be there. Whole divided by existing shares plus new shares. This is the exact formula we used when we did mutual fund NAV second formula. There was a second formula, existing net worth, items increasing net worth, items reducing net worth divided by existing units and new units. Same logic only. Existing shares into existing price, new shares into new price plus NPV, very rarely available, consider it, divide by existing shares plus new shares. What is value of a right? Because they'll ask you to value a right entitlement. That value of a right is technically called as, let's see an example and then do. Current market price is 130. 10 lakh shares are there today. Company needs 2 crores for a new project. I need 2 crore for a new project. What will be the X rights price if the firm offers rights in the ratio of 1:2? 1:2 basically means 10 lakh shares are there. Extra 5 lakh shares is allotted. 1:2. 1:2. Today we have 10 lakh share. 1:2 is the ratio. I'll be allotting 5 lakh share. How much money I want to raise? 2 crore. 2 crore divided by 5 lakh is how much? 40. So what is the formula is existing shares, existing price, new shares, new price or rights issue price divided by existing plus new. Existing shares given in the question is 10. Existing price is 130. You could have come across this area maybe even in your accounting standards. 10 into 130 existing shares into existing price, on top of it extra 5 lakh share. At this will give me 2 crore. This project which I am doing can generate some NPV also. I don't know. If it is there, write the NPV also. Write the NPV. Whole divided by 10 plus 5. Tell me the answer. 100 is the X rights price. 100 is the X rights price. So listen, what concept says is today the share is at 130. Rights issue is happening at 40. After rights completed, 130 will go down to 100. On how many share? 1 share. 1 share. 40 will go up to 100. On how many share? Half a share. How half? Because 1:2. On 1 share, lose 30 rupees. On half share, gain 60 rupees. Net gain, net loss 0. On 1 share, earn 6, or on 1 share, lose 30 rupees. How lose 30 rupees? 130 will go down to 100. 130 will go down to 100. On the other side, 40 will go up to 100, 130 will go down to 100, 40 will go up to 100, because later on you cannot say this is a right share, this is a normal share, no differentiation. My 130 rupee share has become 100, I am worried about it, 30 rupees loss. And a 40 rupee share has become 100, 60 rupees profit. This is one share, that is half share. Clear? Understood this? In case I am not able to do this, then this profit will not come for me. I'm not able to buy that share, then how will I make that profit? Which is where I will transfer mine to you and you pay me 30 rupees. You pay me 30 rupees today. I will give my right to you. I'll give my right to you and you have to pay me money. You have to pay me money, which is called value of one right is equal to theoretical X rights price minus the rights issue price, which is 100 minus 40, 60, and this 60 divided by the rights ratio 1 is to 2, 30 rupees is the value of one right, value of one right at a per share level, value of one right at a per share level is 30 rupees. My 30 rupee loss, I want my friend to pay. I want my friend to pay. He can then go ahead and buy the share from the market. The value of one right is equal to theoretical X rights price minus the rights issue price, and you can also say the same answer at a per share level. One share, two shares will give you one right entitlement. Two shares will give you one right share. So you can earn 60 rupees, but at a per share level it is 30 rupees. At a per share level it is 30 rupees. I'll explain this again. Theoretical X rights price is existing shares into existing price, new shares into new price plus NPV if at all there, divided by existing shares plus new shares. Value of one right is equal to theoretical X rights price minus the rights issue price and divided by the rights ratio, that is called value of one right at a per share level. Value of one right at a per share level. Any doubts on this? Can we proceed? Rights issue and impact on wealth. Impact of rights issue on wealth of shareholder. If you subscribe to the rights issue, 30 rupees loss, 30 rupees profit, no impact. Sell your right entitlement, 30 rupee loss, 30 rupee from friend, no profit, no loss. Ignore the rights issue, wealth will go down. Ignore the rights issue, wealth will go down. Why will wealth go down if I ignore the rights issue? Reason is there is a 30 rupee loss. Where is the profit going to come from? You're not subscribing, you're not selling your right entitlement. If you don't do both, be ready to suffer a loss. Be ready to suffer a loss. So advice to any investor in practical world also, if at all, there are a lot of people who ignore the rights issue because they don't even know what has happened. If you have purchased a share and there is an RE allotted in your account, you should go ahead and sell it or subscribe it. If you take no action, the value of RE will become zero. Once the issue is over, you have not transferred it to anyone, it will become zero and you do not have money to buy the share, then automatically you will suffer a loss. Either subscribe to the rights issue or sell the right entitlement to some other person. Otherwise, there is going to be a loss for the investor. Clear? Able to understand this? And this is how it will happen. Existing wealth, existing shares, my shares, okay? I could be having 100 shares, 200 shares. If I subscribe, my shares will go up. I have paid some cash, revised wealth is there. Original wealth and revised wealth will remain same. If I sell the rights, original wealth, revised wealth will remain same. If I ignore the rights issue, my wealth will go down. If I ignore the rights issue, my wealth will go down. Good MCQs are there, but I'll explain this with the descriptive question itself. You can later at home do these MCQs that will give you grip. So a rights issue is basically made to my existing shareholders at a price lower than the current market price in order to attract these people to buy my company's share. I do it at a lower price, because of which weighted average share price goes down. I will suffer a loss. I compensate by the income from the rights issue. Clear? Any doubts on this? The next part is on buyback. This is the only, there is only one way which a company can increase the wealth of the shareholder, that is buyback. Split, bonus, reverse split, or your whatever we saw now, rights issue, none of them can increase the wealth. Buyback alone can increase the wealth if it is a good buyback exercise. How can buyback increase the wealth? I'll explain as we proceed. Now, what is buyback? Buyback is an exercise where an organization is going to buy back its existing shares from the shareholders. When I buy back this existing shares, most of the time I'll buy back it at a premium. I'll buy back at a little higher price than the current market price. So when I do this, already one set of shareholder become happy about it. Whoever is subscribing, they are getting a better price than what is there in the market. They exit out of the company with higher wealth. This is one part. Normally at a higher buyback price. Second, whoever is staying back, they are thinking about what will happen to the price. That price depends on EPS into P multiple. That price depends on EPS into P multiple. P multiple cannot change unless company does some fancy thing. P multiple cannot change. EPS can go up in a buyback exercise, can go down in a buyback exercise, or may remain constant. If it goes down, wealth is destroyed for the existing people. If it goes up, wealth will improve. Now, what will happen here is PAT may go down or remain same. PAT may go down or remain same. How can PAT go down? I had done buyback. I need 500 crores for the buyback. What did I do? Took a bank loan. Interest cost on debt will reduce the PAT. Interest cost on debt will reduce the PAT. I did not do this. I did something more. I had 500 crore fixed deposit. Break the fixed deposit. Loss in interest income on existing will reduce PAT. Third thing, I had 500 crore, zero utilization. You do that, PAT will not change. So PAT may go down in a buyback exercise or may remain same. Number of shares automatically will go down. If PAT goes down, number of shares go down. Depending on which goes down more, EPS may go up, may remain same, or may increase also. Any of them can happen. A good buyback exercise is one where you try to do it in a manner that you are able to increase the earnings per share for the existing shareholder. If you can do this, automatically existing people will be happy. EPS goes up, share price will automatically go up, and share price goes up, I will be benefited. Any doubts on this? So buyback can have impact on existing PAT. If the question has to give me that, many problem will not give any idea. Then PAT continues. Shares go down, EPS improves, MPS will improve, existing people happy, people who have left also, they are also happy. Both the set of people are happy. All the people gain out of the buyback exercise. This is the only mode where wealth can be created for the investor. There also, for the people who are going out, on the income tax side, there are a lot of challenges which are there. They have changed the taxation way. So automatically, even for people who are going out, there will be challenges. This is practical angle. This is point number one. A buyback can increase EPS, decrease EPS, may remain constant. What is EPS? PAT by number of share. Number of share 100% will go down. PAT will go down if you pay extra interest or if there is a loss in interest income. This is like that cash consideration which I was talking about in M&A. In M&A, when you do cash consideration, there will be an item called minus after tax interest cost. Same logic will work here. Impact of buyback can also be on the book value per share. What is book value per share? Book value share capital plus reserves and surplus minus fictitious asset divided by number of share. In a buyback, net worth will go down. The journal entry for a buyback exercise is your share capital account debit, reserves and surplus account debit to bank account. You are paying money. This is a broad journal entry. I'm not getting into the exact journal entry and all. Your bank balance goes down. Along with that, share capital goes down. Some reserves and surplus will go down. Share capital will go down to the extent of number of shares bought back. Reserves and surplus will go down to the extent of extra payment which you have done. So net worth will 100% go down. With the net worth going down, shares will go down. Book value per share may go up, may remain same, may increase also. Anything can happen. Clear? Any doubts on this? Existing net worth minus the buyback size. Existing net worth minus the buyback size divided by shares, existing shares minus the shares bought back. This is the impact as far as book value per share is concerned. ICA question may not test on book value per share, but they may test on the EPS part. CA Inter, they test on book value per share. I have kept it that also here. Clear? Able to understand this? Now let's see it in a problem. Once I am done with the problem, at home I want you to do MCQ in this area, be it the rights issue part or be it this. Some places I've done all MCQ, some places I want you to practice the MCQ. Any doubts on buyback? Buyback is an exercise. Many IT companies do buyback. Reason is they keep making profits, don't give it to the shareholder. Reason is every IT company grows by doing something called as acquisition. For doing acquisition, I need healthy money available. So I think I'll acquire some company, keep money. Not able to find, I will do a buyback. I will do a buyback. I think currently Infosys is under a buyback which is happening. It is completed or it is going on. So a lot of companies do buyback. Buyback can increase my EPS, can increase my EPS in case it is done with the right mix, right price, and interest income is not, because Infosys has a lot of cash with them, they're using cash. Loss in interest income should take care of the number of shares which is going down, and EPS should ideally improve. Improves, MPS will improve. EPS does not improve, MPS will not improve. Clear? Able to understand this? Okay, I now move to bond valuation. We are done with equity valuation and the miscellaneous area of equity. I'll be moving to bond valuation. And once bond valuation is done, there is a small area called hybrid valuation and an enterprise valuation and something on money market. Bond valuation will take maybe 4 hours of discussion, and then the allied areas can get over. Now coming to bond valuation, the objective of this area is to arrive at the fair value of the bond. Only one formula to value the bond, no 2 3 different formula. Present value of future cash flows discounted at investors required rate of return. And cash flow calculation also not tricky, because the cash flow will remain almost same. Year 1 interest, year 2 interest, year 3 interest, year 4 interest, and principal. You may get back your principal. Bond valuation is present value of future cash flows discounted at investors required rate of return. There is fixed amount which is going to be paid most of the time. There are some exceptions we will understand as we proceed. Few basic term. Face value, which is the nominal value of the bond, nominal value of the bond. Coupon rate, interest rate payable on bond, interest rate payable on bond. Interest is always calculated on face value, always on face value, irrespective of whether the issue happens at premium or issue happens at discount. Maturity value, amount payable on redemption. If at all it's a redeemable bond, there can be an irredeemable bond which has unlimited life. Amount payable on redemption taken at par if problem is silent. And yield to maturity. Maturity value is taken at par. Issue price, if at all some question says and you don't have data, you take it as par. YTM basically means return earned by the investor by holding the bond till maturity. YTM means yield till maturity. Yield means return which you are earning. The return earned by an investor by holding the bond till the life of the bond is called yield to maturity. There are other names for yield to maturity, and yield to maturity is basically the discount rate which we use to value the bond, because this is the return which the bond gives, or you can understand the return which the investor wants. So YTM can be called as cost of debt, discount rate, required return of investor, expected return, opportunity cost, market rate of interest, prevailing rate of interest, going rate of interest, interest rate of a similar bond. Yeah, these are the names we have seen in different question. Maybe I may end up seeing even some other names also, but predominantly these are the names for YTM. What is YTM? The return expected by the investor or the return earned by the investor. How do you value bond? Very simple. I'm going to anyway discuss present value of future cash flows discounted at investors required rate of return. Valuation of bond. Fair value of bond is today value, which is present value of future cash flow. What are the cash flows of a bond? Very simple. Interest and principal. It doesn't go through like equity valuation where you need to do growth rate on dividend. All that headache is not there. We also had to calculate price at the end of the life. That headache is also not there. It will be principal value at par mostly. Interest and principal discounted at investor required rate of return. 2-3 conditions you need to be aware of. One major condition is there are different types of bonds. What are different types of bonds? Bonds which pay half yearly interest, bonds which pay quarterly interest, bonds which pay annual interest. If you are paying quarterly interest, you have to do discounting every quarter. What is discounting every quarter is, till now we have learned that it is year, cash flow, PVF, DCF. This is not the right thing. It can also become quarter, cash flow, PVF at quarterly rate, and DCF. First quarter, second quarter, third quarter, fourth quarter. 10 years life. First, second till 40 quarters, and at the end of 40th quarter, redemption will happen. At the end of 40th quarter, redemption will happen. Half yearly bond, 5-year bond. First half year, second half year, third half year, 10th half year. At the end of 10th half year, redemption will happen. What interest will you write? Quarterly interest. Quarterly bond, quarterly interest, quarterly discount rate. Half yearly bond, half yearly interest, half yearly discount rate. Annual bond, annual interest, annual discount rate. This rule is very, very critical. What is this? Because when I have to value the bond, I'll be writing the cash flows of the bond and discounting these cash flows and discounting this cash flow. When I'm doing this discounting, I have to take care that annual bond, annual cash flow, annual YTM. Half yearly bond, half yearly cash flow, half yearly YTM. I did this very happily, completed. Suddenly question says, give me second year price, third year price, first year price. No problem. Modigliani Miller. P1 is equal to P0 into 1 plus cost of debt minus I1. I1 is interest rate of year 1. You want to do second year calculation? P2 is equal to P1 into 1 plus cost of debt minus I1. Minus I1. A simple example for you to understand. Nominal value means par value, face value. Face value of 10% bond is 100. This just to understand, okay? Redeemable value is 120 in 2 years time. Investor return is 14%. Investor return is 14%. How will I value? Year, cash flow, PVF at 14%, DCF. What will the bond pay? 100 into 10%. 100 into 10%. First year interest, second year interest plus principal. Second year interest plus principal. Don't worry about PVF DCF part, okay? Even when I do question, my focus will not be PVF DCF. That's just waste of time. My focus will only be year and cash flow. Clear? Understood this? PVF DCF, we may do initial sum question, but that's more of a formality. Another example. Current market price of a bond is 1000. Face value of a bond is 1000. Interest rate on bond is 12%. YTM of bond is 15%. What will be the price at the end of year 2? You need not do. You just be in listen mode. P1 is equal to P0 into 1 plus cost of debt. 1 plus cost of debt minus interest of first year. 1 plus cost of debt minus interest of first year. What is the price today? 1000. Cost of debt. Cost of debt. Cost of debt means what investor wants. What is investor wanting? YTM. YTM of bond is what is 12%? Company is paying 12%. That is not cost of debt. What is investor wanting? is called cost of debt. This is what I said. YTM can be called as cost of debt, discount rate, required rate of return, expected rate, opportunity cost, market rate of interest, prevailing rate of interest of similar bond, going rate of interest. Nowhere I said it is the interest rate of the bond. Interest rate of the bond is different and investor expected rate is different. In this question, bond is paying 12%, investor is wanting 15%, 1 plus 15%, 1 plus 15%. I'll repeat again, 1000 into 1 plus 15%. I'll tell you to write in some time, initial some 20 minutes, you may not write much, okay? 1 plus 15%. How much interest we will pay in first year? Amount, tell me. 120. Can you tell me the answer here? 1000 into 1 plus 15%. Live online, guys, you can type 1000 into 1 plus 15%. 1000. This is P1. Then I have to go to P2. What is P2? P1 into 1 plus cost of debt minus I2. Can I go to P3, P4? I can go to any year. Wanted second year. P2 is equal to P1 into 1 plus KD minus I2. P1 is 1030. Cost of debt is 15%. Yeah, I've got answer in live online, minus 120, which is, any doubts on this? Can you proceed? Next example, we will do it together. You are going to do it in your notebook. Okay, we are going to do it together. You are going to do it now. Any doubts till now? What is bond valuation? Arriving at the fair value of bond. How will you arrive? This is the approach: year, cash flow, PVF, DCF. Year, cash flow, PVF, DCF. Very simple approach. Nothing like Gordon, Walter, nothing comes here. There are certain other terms which I have to explain, which I will proceed. I'll explain as we proceed. 10% bond, 10% is rate of interest, okay? Pays interest in September and March. September and March means half yearly bond. Every half year it is paying interest. Face value is 100. YTM is yield to maturity. Yield to maturity is how much? 12%. What will be the market price with balance life of 2 years? Bond is paying interest how often? Half yearly. So now write. The heading is half year cash flow PVF DCF. Not year cash flow PVF DCF. Half year cash flow PVF DCF. I want you to write, okay? Half year cash flow PVF DCF. With the MCQ itself, lot of good understanding will come. Half year cash flow PVF DCF. What is the YTM question has said? Normally it is for a year. 12% is for a year. I want half yearly. I want half yearly. So PVF at 6%. 12% is for a year. We are doing half yearly calculation. How many years is the balance life? 2 years means 4 half years. 2 years means 4 half year. First half year interest, second half year interest, third half year interest, fourth half year interest and principal. Interest and principal. 4 half years you write. Later on I'll explain annuity part. 1, 2, 3, 4. 4 half years. Can I do annual and do? Technically wrong. Answer will not match. Major variation will not be there, but still answer is wrong. Half yearly bond, half yearly cash flow. What is the rate of interest on the bond? 10% for a year. What is the face value of the bond? 100. So 100 into 10% into 6 by 12. How much? 5. 100 into 10% into 6 by 12. And on the last year, 5 plus 100, 105. 5 plus 100, 105. Question has not mentioned the redemption value par. Divide by 1 divided by 1.06. All this is formality. 0.943. 3 decimal we normally do. 890. If somebody has completed in live online, you can give me the answer. 840 are here also. 792. 5 into 0.943. This part I will not explain much. This is just a formality, technically waste of time. 4.715 or 72. 4.45. I already got the answer in live online. 4.2. 83.17. 83 point, how much you said? 1. Total is how much? 9. 5. 5, 3 or 5, whatever number you are getting. And then in the MCQ, we will choose the answer. From the MCQ, we will choose the answer. So the MCQ answer is 96.5. Any doubts on this? Any doubts on the concept here? Half yearly bond, half yearly cash flow, half yearly discounting. Quarterly bond, quarterly cash flow, quarterly discounting. This I can do it as an annuity and all. I'll explain that as we proceed. Any doubts till this? Can we proceed? Done. Question 47, which has a lot of good adjustments, came in November 22 exam. This is part of my priority material also. Mr. X wants to invest 1 lakh in 7 years, 8% bonds in the market. 7 years, 8% bonds in the market, face value 100, which were issued 2 years ago. You are required to advise what is the maximum price for bonds to be paid in the following scenario. X is expecting 9% return. X is expecting 8% return. Present rate is 8.25. Present rate is 7.75. There are 4 scenarios. What are these 9, 8, 8.25 and 7.75 mean? KD are technically the yield to maturity or the discount rate We normally use the discount rate, which is an investor expectation. 4 scenario. I'm not going to do 4. I'm going to do 8%. Yeah, 8%. There's a reason to do 8%. I'll explain that later. We are only going to do 8%. Please write in your notebook. Year, cash flow, PVF at 8% and DCF. Year, cash flow, PVF at 8%, DCF. I don't want other scenarios, okay? And once that is done, I will be able to touch on a concept which I want to explain later. Year, cash flow, PVF at 8%, DCF. I'm going to value the bond, okay? One bond only. I'm not going to bother about whether you invest 1 lakh or 20 lakh. That's not my worry. I'm going to value only one bond. How many years is the life of the bond? 1 to 7 and 7th year separately. 1 to 7 and 7th year separately. What is the interest bond is paying? 8%. What are we expecting? 8%. Both are same. That's the reason I've included this example. I'll be able to touch on a concept later. So cash flow is 8. Maturity cash flow is 100. Maturity cash flow is 100. Redemption is a, oh sorry, I did not see something. Sorry. Which were issued how many years ago? So 1 to 5. Sorry. 1 to 5. Only 5 years life. Extremely sorry. Okay. I want to invest in a 7-year bond, but they were issued how many years ago? 2 years ago. So balance life is only 5 years. Balance life is 5 years. Extremely sorry. 1 to 5 and 5 years. 1 to 5 and 5 years. It was already issued. So what is gone is gone. Future cash flow is only for a 5-year period. Only for a 5-year period. Now tell me the 5-year annuity factor. First, I write this 681 3.993. 31.94, 68.10, 100.04. Okay. Any doubts on the calculation? There are other scenarios. The reason I've not touched upon also, I'll explain as we proceed. Anyway, in exam, you'll have to do all. Now, this leads to a new concept which you need to be aware of. Relationship between YTM, coupon rate, and bond price. What is YTM? Investors' expectation. There are 10 different names for YTM. Coupon rate, interest rate which the bond is paying. The problem which you have solved. What is the interest rate of the bond? What is the YTM of the bond? 8%. If coupon rate is equal to YTM, bond will quote at par. Bond will quote at par. Technically, it meets expectation. You want 8, I give 8. You are not unhappy with me. You are also not very happy with me. Neither unhappy nor sad. Nothing is there. So you are giving me the par value. All this provided redemption is happening at par. Redemption is happening at par. If redemption is happening at, so this, that 8%, if it comes in exam, I will not solve it. I'll directly write 100 is the answer. I'll directly write 100 is the answer, provided we got 100.04. The reason is rounding off. Okay, that is more of a rounding off difference. If coupon rate is greater than YTM, you wanted 7, I am giving you 8. You became very happy because I am exceeding your expectation. I'm exceeding your expectation. You will give me a premium valuation. You will give me a premium valuation. Coupon rate greater than YTM. You are very happy with my company. Exceeds expectation. Me bond is quoting at a premium. For example, in this question, if I take this 7.75 scenario, people want 7.75, bond is giving 8. The bond will quote at 101.05. Bond will quote at 101.05. You are very happy with my company because you wanted 7.75. I am giving you 8, exceeding expectation. Exceeding expectation, bond will quote at premium. The opposite can also happen. When I am paying 8 and you are wanting 9, you became unhappy with my company. You became unhappy with my company. I am not meeting your expectation. Bond will quote at discount. Bond will quote at discount. I exceed expectation. Bond will quote at premium. I am not able to meet expectation. Bond will quote at discount. Meet your expectation. Bond will quote at par. All this provided redemption is at par. All this provided redemption is happening at par. If redemption is not happening at par, please do detailed calculation and give me the answer. This is, and shortcut, only one scenario, 8 and 8 matches. Other scenario and all, you can tell it will be discount, but you have to do the calculation. You can tell it will be premium, but you'll have to do the calculation. Any doubts on this logic first? Bond quotes at par, bond quotes at premium, bond quotes at discount, depending on the relationship between the coupon rate and the yield to maturity. Coupon rate, now I am the company, you are the investor now onwards. Okay, what I pay and what you want. So every question I'll ask what you want, basically YTM or investors expectation. I pay what you want, both are happy, par value. I pay more and you are needing less amount, you became extremely happy with me and giving me a premium valuation. I am giving you 7, you wanted more than 7, it will be a discount. Clear? To put it very simply, in any question, if the bond quotes at par, if the bond quotes at par, YTM is equal to coupon rate. YTM calculation is a very time consuming exercise. You will understand this as we proceed. So in case a bond is quoting at par, YTM is equal to coupon rate. YTM is equal to coupon rate. Any doubts till this? Let's come to situation 2. If the bond are available at par means YTM equal to coupon rate. YTM equal to coupon rate, and 1% is the transaction cost. What is the effective yield? 1% is the transaction cost. What is the effective yield? Any doubts till now? Any doubts on any of the concept? I'm going extremely slow. Any place you have a doubt, base is ready, then I'll obviously start going at my normal speed. Any doubts till now? Now, right. Effective yield. with transaction cost. Effective yield with transaction cost. Bond at par. Bond at par. Bond at par. Gross YTM equal to coupon rate. Gross YTM equal to coupon rate. What is the coupon rate? In case if it is not par, then there is a lengthy calculation which you will understand as we proceed. This question, that lengthy calculation is not needed. Gross YTM 8%. Now, I was under the impression that I will get 8 and pay 100. But suddenly they gave me a surprise. The surprise element is I have to incur a transaction cost of how much? 1%. So listen, I will get 8, but I have to pay 101. I have to pay 101. 8 divided by 101 into 100 is how much? 7.92. This is the exact logic. ICI has followed a little different formula, same 7.92. Any doubts first on this? I was thinking I'll pay 100 and earn 8 rupees, which is right. But suddenly they are saying there is a transaction cost of 1%. There's a transaction cost of 1%. Now, right. Net YTM or net yield 8% into 1 minus transaction cost percentage. 8% into 1 minus transaction cost percentage. Once you have written this, I'll explain the logic again. 8% into 1 minus transaction cost. What is the transaction cost here? 1 minus 0.01. 7.92%. 7.92%. Practical world, if transaction costs are there, it can depress my returns. It can depress my return. How is the return getting depressed here? I was to earn 8%. Because of some transaction cost, I'm effectively earning only 7.92%. Any doubts till this? This is the concept 39 here. Revised yield is equal to normal yield into 1 minus transaction cost percentage. 1 minus transaction cost percentage. Any doubts till this? 1 minus transaction cost percentage. Real logical formula is 8 on 100 has become 8 on 101. 8 on 100 has become 8 on 101. Any doubts till this? Can we proceed? Can we proceed? Find the number of days to break even. If the bonds are available at par and 2% is the transaction cost. Now they are asking something on break even period, right? Break even period. Break even period. Break even period. How much is the transaction cost? 2%. So listen, 365 days I will be earning 8%. In 365 days, I will earn 8%. My net yield can go down, but my gross yield is 8%. I'm going to pay some transaction cost. My managing director is saying this transaction cost, in how many days will the recovery happen? Because if I continue for 10 years, 20 years and all, then the transaction cost does not matter. But you buy and immediately you sell it in 1 month and all, you may not even recover the transaction cost. How much transaction cost we are paying? Question mark equal to 2%. How many days does it take to recover this? Approximately 3 months. It will take us 3 months time to recover this transaction cost. If you suddenly sell it within 3 months, you will earn nothing. You will end up earning nothing. If you keep playing a waiting game, then every year you will earn 8 into this 2% will be subtracted from there, and effective earning will be there every year. But you suddenly sell it immediately, then there is a huge loss for you. Then there is a huge loss. So number of days to break even, how much? 91.25 or 91 days. 91 days. I'll explain again. 8% or technically 8 rupees. 8 rupees is earned in 365 days. I want to earn 2 rupees. Why 2 rupees? 2% is the transaction cost. This is called break even period. This is called break even period. So break even period is also explained here. Transaction cost divided by the normal yield to maturity into number of days in a year. An example is there. I've already done the detailed problem. MCQ you do at home later on. Any doubts on this? So three concepts I've touched upon. One, how do you value the bond? Present value of future cash flows discounted at investors required rate of return. 10 different names I've already told you for investors required rate of return. Maybe a 11th name can also come in exam. Clear? That is first part of it. Second part we have learnt, in case there is a transaction cost, yield will depress, yield will go down. And if you want to calculate the break even period, then there is another calculation to be done. We have also learnt about relationship between YTM, coupon rate and bond price. Relationship between YTM, coupon rate and bond price. What is the relationship? If you are happy, I am also happy, par. You alone are happy, premium. I am happy. When I say I am happy, basically I gave you lesser money and you are unhappy about it, it will go to a discount level. Clear? If investor is happy with the company, premium. Investor is unhappy with the company, discount. No impact, neither happy nor happy, unhappy, then it will be at par. Any doubts till this? To 48. An investor is considering the purchase of following bond, face value 100, coupon rate 11%, maturity 3 years. If he wants a yield of 13%, what is the maximum price he should pay for? Please do year cash flow PVF DCF. I give you 2-3 minutes. Year cash flow PVF DCF. I want you to write please, okay? Year cash flow PVF DCF. Okay, last question. There is a doubt from a student. We got 91.25. Should we round up or round down? Doesn't really matter. If it's an MCQ question, choose from the option. If it's a descriptive question, you can say round it up to 91 or 92. 91 or 92. Complete part 1. Some students have started giving answer. You complete it here and then I'll explain part 2. Year cash flow PVF DCF you have to do and get to the valuation. Part 1 is fairly simple, straightforward discussion. Part 2 is where I want to spend time. We've started getting almost the answers here. So I'll write it here. Year cash flow PVF at what rate they've given? 13%. DCF, how many years? 1 to 3. Third year. What is the bond paying? 1100. PVF at 13% is 2.36. 3 decimal is fine. Normally 3 decimal, okay, unless the question tells you differently. I normally do 3 decimal only PVF. Third year how much? 693. This is 69.3. Other one 25.97. Put together the answer is clear. I've done everything. Very happy with this. The computation is done. Any doubts till this? Then they are saying if the bond is selling at 97, what will be his yield? I'm going to touch upon an important concept called yield to maturity. This once I discuss, we will do 2-3 questions and I think today's discussion will end at that stage. What will be the yield if bond is selling at what rate? 97.60. What is yield is IRR of the investor. IRR of the investor. If bond quotes at 95.27, investor will earn 13%. If it quotes at 95.27, investor will earn 13%. But bond is quoting at 97.6. Now, investor yield, right? Investor yield investor yield. Shortcut. You are not going to write this in exam. This will be in your calculator. Because for doing IRR, I need one rate to start with. If they give the rate in the table, saying that you do 11, 12, 13, 14, no need to do whatever I'm doing now. Whatever I'm doing now is not needed if they give you two rates in the question. If they don't give you two rates, one shortcut we will follow. This shortcut is just for the purpose of getting to know what rate to start with. This shortcut you have learnt at CA Inter. You would have learned something called as cost of redeemable debt, where you would have learnt interest after tax plus something called as redeemable value minus net proceeds divided by life whole divided by redeemable value plus net proceeds by 2. Something you would have learnt at CA Inter. Same formula I'll have to use here, but no after tax, because mostly tax data will not be there. So shortcut, right? Interest plus redeemable value minus net proceeds by life divided by redeemable value plus net proceeds by 2. Again repeating, this should not go into your exam notebook. It is not needed. Still, if you write, that's okay, but it is not needed in exam. Why are we doing it? What discount rate do I start? 11, 12, 13, 15, 18. Here I already have one start. I can start at 13 and do it also. But some other question you may not have that start. What is the interest the bond is paying every year? 11. 11 is the interest paid by the bond. What is the redeemable value of the bond? Have they given any redeemable value? 100. Net proceeds means today's price. What is today's price? 97.6. No, student has said redeemable value is 111. No, redeemable value means what the bond holder will pay, not including interest, not including interest. So redeemable value is 100 only at par, at par. It is not including interest, okay? 11 plus 100 minus 97.6 divided by 3 whole divided by 100, 97.6 divided by 2. You will get an answer into 100 to express in percentage. $98.8. What's the answer you said? 11 point. Most probably the IRR will be closer to 11.94. It could be even 11.94. I don't know, or maybe 12%. We don't know. We'll see. 11.94 is the shortcut answer. Students have asked me, is this sufficient? 0 marks you will get if you do this. Shortcut method has zero utility in exam. ICI will not award any marks for doing shortcut method. It does not really matter. Shortcut method is just for only one purpose. I am doing this to get to know what rate to start with. YTM more relevant for a redeemable bond. Irredeemable bond, what happens? I'll explain later. More relevant for a redeemable bond. Interest income plus redeemable value minus today price divided by life divided by redeemable value plus today price divided by 2. I want to complicate a question. I can say after tax you do. Then you have to deduct tax at every level. Any doubts till this? This is one. The ideal approach is IRR method. IRR method. How will I do IRR method? Year, cash flow, PVF, DCF. One positive NPV, one negative NPV. Have space for 8 columns. 8 columns will ensure you can do NPV 3 times. 8 columns. Again, I'm repeating, have space for 8 columns. What rate I'm going to start with? 12%. 11.94 you got. Shortcut answer. Any doubts on 11.94? Any doubts on 11.94? I will now try 12%. I may get positive. I may get negative. I think this question 12 will give 0. That's what I remember. But okay, we will try one positive, one negative. Let's start with 4 columns. Have space for 8 columns. Year, cash flow, PVF at 12%, DCF. Year 0. How much do I have to pay today? 97.6. 1 to 3 years, I will get interest income. 1 to 3 years, I'll get interest income. Have space for extra column. If needed, we will open it. Not needed, obviously, I'll not open it. 1 to 3. What is the interest? 11. At the end of third year, 100. PVF at 12%. 1 divided by 1.12. First, the third year factor is 712 and the annuity factor is 2.402. Yeah, some student has completed. They're saying IRR is 12%, 97.6, 11 into 2.402, which is 26.42, 71.0. And what is the total? 0.0, which is almost zero only. If you have got positive answer, then we will do another answer. All that we will do as we proceed. So answer is IRR 12%. Answer is IRR 12%. We have almost got a zero answer. We have almost got a zero. So IRR is equal to 12%. Any doubts on this? So below this table, IRR in bracket yield to maturity 12%. Yield to maturity is 12%. What was the purpose of that shortcut? Shortcut told me start at 12. We got answer correctly. It is possible that you may not get 12 as 0. Okay, we will see as we proceed. Shortcut will only help us in starting. If the same question comes with below the question, they give two discount rates. Please start with whatever rates they have given. No need to do shortcut and all. Directly start with rates given by them in the question. Can we proceed? So YTM basically means yield to maturity. The term maturity means there should be a redeemable bond. YTM of bond more relevant for a redeemable bond. Method 1, shortcut. Interest income, redeemable value minus today price divided by life, whole divided by redeemable value plus today price by 2, not to be used in exam, not to be written in your notebook, doesn't serve any purpose. Only one purpose, what rate to start with. Other one is IRR, one positive NPV, one negative NPV. This is the same example. What is the YTM under shortcut method? 11.94. We have another example which you are going to do now. If the market price of the bond is 95, years to maturity 6 years, coupon rate 13% per annum paid annually, issue price is 100. What is the yield to maturity? Use PVF of 14 and 15 to compute YTM. No other headache. I'll do 14 and 15 only. I'll do 14 and 15. I'm not going to get under shortcut method. I'm not going to get under any shortcut method. Let me again read it. Market price is how much? 95. Years to maturity 6 years. Coupon rate 13%. Issue price 100. Zero utility of that issue price. Would have happened some 5 years back, 10 years back. I am not interested in knowing it. It was issued at 100 rupees. Zero utility to the problem which I am solving. Today I will buy. At what price can I buy today? 95. How many years will I get interest? 6 years. How much interest we are going to get? 13%, 13 rupees. At the end of 6th year, redemption will happen. At what rate redemption will happen? At no, nothing is given. At 100 redemption will happen. First thing I can do is a shortcut. If I want to do, I can do a shortcut. I don't need it here. 14 and 15. Let's do IRR. Let's do IRR. There is a doubt, is the formula to be used if the bond is redeemable at par? Nothing like that. The shortcut can be used anywhere. You can use the shortcut formula whether redemption is happening at par, whether redemption is happening at premium, redemption is happening at discount. All that does not really matter. What is the purpose of the shortcut? To tell what rate to start with. To tell what rate to start with. Here I've already told you 14 and 15. Can we start? Now write year, cash flow, PVF at 14, DCF, PVF at 15, DCF. PVF at 14% and PVF at 15%. Year cash flow, PVF at 14, PVF at 15 and DCF. I'll ultimately give you the shortcut answer also, just to get one more question, but doesn't really matter. The shortcut is not going to matter in this question. Year 0, what are we going to pay? Minus 95. Minus 95. How many years is the life? 1 to 6. How much is the interest? 13 rupees. At the end of year 6, 100. You do in your notebook. I will be doing it in the screen. You can refer if you want, but you keep doing it. This will be the last question where I'll be doing YTM. Okay. Later question, I'll write year cash flow and close it. So you do in your notebook. Started getting answers in live online, but okay, let's complete it fully first. If you get anything different, if you find any calculation errors, you can let me know, but otherwise you keep doing it. Forty-nine point 19, 43.20. What is the NPV you get? Negative 2.61. These should be your numbers. If you get anything different, it could be rounding off difference or a calculation error from my side. These are the numbers. Okay. I'll have to use the IRR formula. Formula I had given you earlier. I'll use that formula. Logic of the formula will come to you in some time. I have not done the IRR logic formula, which is in capital budgeting. I will keep it till I go to capital budgeting. I'll not touch the logic of the formula now. Any doubts on these numbers? Are you getting these numbers? IRR is equal to L1 NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. L1 is lower rate, L2 is higher rate. L1 is I think 14. We got NPV of 1.16. 1.16 minus of minus plus 2.61. 15 minus 14. How much? 14 plus how much? 3.1. Any doubts on this? Some of you have mostly this answer. Any doubts on this? Can we proceed? Some small rounding of differences can be there. 14.31. Can we proceed? If at all I was to do a shortcut answer here, because they gave 14 and 15. Just for your understanding, one more time, I'm doing the shortcut. What will shortcut do? Interest income. How much is the interest income? 13 plus. What is the redeemable value? 100 minus what is the price we will pay today? 95. How many years? 6 years. Whole divided by 100. 95 by 2. 100 by 95. 100 plus 95 by 2. So numerator will be 13.83. Denominator 97.5. closer you will get. Exact answer you want, it's only through the IRR approach. Assuming you are doing an MCQ question, you are running short of time, maybe you try the shortcut, put a tick mark and proceed it. If at all you're running short of time, that's the only utility I feel for a shortcut method. Otherwise, I don't see any other utility. Any doubts on this? Can we proceed? Done? Okay. Yeah. Some more points I have to discuss and then I'll come to questions. Any doubts on the YTM part? There can be different types of YTM. There can be different types of YTM. You can do for investor. You can also do it for the company. Investor means there can be a pre-tax, there can be a post-tax. Calculations is going to be similar. Approach is going to be similar. Points alone you will have to know. I haven't seen ICI getting into post-tax till now. Pre-tax means use pre-tax cash flow and calculate the YTM. Post-tax means deduct tax on interest and capital gain. Deduct tax on interest and capital gain and then do the computation. Same YTM, when you do it for an investor, we call it as yield to maturity. If you do it for the company, it is called cost of debt. It is called cost of debt. Will the answer be different? No, answer is going to remain same. You can either do it for the company or you can do it for the investor. Company, I have not seen any questions getting tested in exam. If you do it for the company, year 0 inflow for the company, 1 to 5 years outflow for the company. At the end of 5th year, outflow for the company. You can use pre-tax number. You can also use post-tax number. Pre-tax means without tax benefit. Post-tax means with the tax benefit. Clear? Nothing much to worry about. And later on at home, if you want, you can go through this examples which are done. Any doubts till this? So I have touched upon till now, yield to maturity. Till now, we have learnt relationship between coupon and YTM. We have also learnt about valuation. In valuation, we have learnt half yearly bond, half yearly cash flow, half yearly YTM. If they ask yield to maturity for an half yearly bond, you have to do half yearly cash flow, half yearly discounting, one NPV, another NPV, and complete the answer. Any doubts till this? I think the last concept which I may touch upon today, and then based on this understanding we will do 2-3 questions and we may end the session. Current yield of bond. Current yield of bond is basically relevant for an irredeemable bond. For an irredeemable bond. For an irredeemable bond, at inter level you would have learned cost of irredeemable debt. At inter you would have learned cost of irredeemable debt. What was the formula for cost of irredeemable debt? Interest, ignore the tax angle, which will not be there, divided by net proceeds, or you can call it as P naught, So I can then do an irredeemable bond. This is the formula for current yield. Current yield is equal to interest divided by current market price. There was one question in bond valuation. I discussed this, but I said I'll explain later. Sorry, not bond valuation. In mutual funds. In mutual funds, there was one question where I did discuss about something on current yield. What is current yield? Is interest as a percentage of current market price. Interest as a percentage of current market price. Mostly useful for an irredeemable bond. Can I do it for a redeemable bond? Not much use. If the question say current yield is so much and it's a redeemable bond, maybe they are telling YTM. They are only telling YTM. Current yield would mean currently interest rate in the market. For an irredeemable bond, yield is equal to YTM. Word I cannot use because there is no maturity. There is no maturity for an irredeemable bond. For an irredeemable bond, yield is equal to interest by current market price. Interest is face value into coupon rate. Interest in rupees divided by current market price. Redeemable bond, year, cash flow, PVF, DCF, longer calculation. Other one, very short calculation, extremely short calculation. Any doubts till this? For current yield, more relevant for irredeemable bond, more relevant for irredeemable bond, ratio of interest to current market price, ratio of interest to current market price, interest divided by current market price, yield and price relationship, yield and price relationship, yield and price has inverse relationship. If yield goes up, 9.09 went up to 10.09, price will go down. Yield goes up, price will go down. Reason is, yield going up means suddenly you are saying your expectation is increasing. I cannot meet your expectation increase and all, because my price, my 10% is already decided. Suddenly you are saying earlier 9.09, now saying 10.09, then you will say 11.09, then you will say 12.09. I cannot meet your expectation. Price will start crashing down. Price will start crashing down. And in case your expectation go down, your expectation go down, then price will start going up. I cannot change my interest rate. I cannot change my interest rate. My interest rate will remain same. My interest rate will remain same. For an irredeemable bond, we use current yield logic. Redeemable bond, we use something called as volatility, which you will understand later. You will understand that later. There's a concept called volatility. Okay, now let's do some of the balance concepts, and then as we proceed, you will get more clarity. Increase or decrease in interest rates and variable bond. If a question says that there is an increase in interest rate or there is a decrease in interest rate, increase in investor expectation, increase in market rate, all that would mean YTM, or technically the discount rate changing. What can change in a company, or what can change when you do valuation, is only the discount rate. What cannot change is the interest rate of the bond. If a bond started with 10%, it will continue to be 10% interest payment unless there is one exception. Increase or decrease in interest rates or yield has to be interpreted as change in investor expectation. What can change is only the investor expectation or the discount rate. Interest rate of the bond never changes, because when I issued a bond, I told that this is the bond interest and you subscribe to my bond at that interest rate. Cannot be taken as change in bond coupon rate. Bond coupon rate, as they don't change during life. Normally, bond coupon rate is the interest rate, do not change. Exception, variable bond. What is variable bond is, when I issue the bond, I tell interest rate is equal to going rate of interest in the market. Whatever is the interest rate in the market, that will be the interest rate of the bond, are technically called as a floating bond. What is a floating bond is, I'll say interest I will pay is RBI repo rate plus 2%. RBI increases repo rate, I will also increase my payment. RBI reduces repo rate, I will also reduce my payment. That is called a floating bond or a variable bond. Very rarely we see floating bonds being issued. Whereas when a bank gives a loan, mostly the bank, when gives a loan, it will give a floating rate of loan to the investor, to the borrowers. Exception, variable bond. In this case, both discount rate and coupon rate can change. A variable bond is one whose interest rate changes with investor expectation. Interest rate on these bonds will always be equal to prevailing rate in the market. That also, if they want, they can deviate. How can they deviate is, they can say I will give prevailing rate plus extra 1%, or prevailing rate minus. Normally same they'll give, whatever is the prevailing rate will be given by them. If that happens, these bond will always quote at par, because always coupon rate is equal to YTM. Always coupon rate is equal to YTM for a variable bond. For a variable bond, if a question says there is an increase in interest rate, very simple, increase in interest rate means increase in YTM, decrease in YTM. That is what you will have to understand. It can't be increase or decrease in coupon rate, exception being variable bond. Clear? And as the name indicates, a variable bond will pay rate which is prevailing in the market. If you are meeting the expectation of the investor, bond will quote at par. Coupon rate, equal to YTM. Bond is going to quote at par value. Clear? Any doubts in this? Okay. This is a very important concept. Step up or step down discount rate. Step up or step down discount rate. Now, when we do our valuation exercise, just give me. Whenever we do valuation exercise, we write year, cash flow, PVF, DCF. This is not only for bond valuation. Whatever I am discussing is even for equity valuation, but that time this adjustment did not come. Here, year 1, ignore the year 0 part. We are just doing the valuation now. Year 1, 10 rupees. Year 2, 10 rupees. Year 3, 110 rupees. I ask what is the discount rate. The investor says, first year, I want a return of 10%. But I see Indian economy struggling in 1 year. So second year, you have to give me 11% interest. Expectation is changing. My expectation, first year you give me 10% income. Second year you give me 11% income. And third year you give me 12% income. Your income expectation is changing year on year. Why does it change? It can change if RBI increases or decreases interest rate. Today I asked you what are you expecting, and you are giving me 10% for the first year, 11% for the second year, 12% for the third year. I said give me one number. You said no, I cannot give one number at all. 10, 11, 12. This is what I want. You please give me this. So first year what we do is 1 divided by 1.1. Tell me the number in the calculator. 1 divided by 1.909. Second year my expectation is 11%. Now, when the second year expectation is 11%, you'll have to understand how are you telling that second year 11%. There are two ways this 11% can be told, and according to that, the calculation will undergo a change. First year, no problem. 10% you wanted, 0.909. Second year, you are needing 11%. Is this only for the second year, or suddenly you are saying that from the beginning itself you should give me 11%? There are two ways of giving that 11% number. If I invest for 1 year, give me 10%. If I invest for 2 years, from the beginning till the second year end, give me 11%. From the beginning till the second year end, give me 11%. Or it can be interpreted as only for that second year. How does that make a difference? Uniform discount rate. Uniform means no change. This is what you have been doing. 1 divided by 1 plus R square. Second year I am doing calculation. Okay. So if it's a uniform discount rate, 1 divided by 1.1 equal to. If it's a forward discount rate, what is forward discount rate? Is only for the second year you are giving a different rate. Then PVF of year 1 divided by 1 plus new discount rate. PVF of year 1 divided by 1 plus new discount rate. Forward discount rate means the interest rate is applicable only for the second year. First year 10%, second year 11, third year 12, fourth year 13, fifth year 15. If that is what you do in the calculator, now do 1 divided by 1.1. This is first year. Now divide 1.11. 8. No. 1 divided by 1.1. Then divide by 1.11. Next year 11%. 0.81. Then divide by 1.12. This is one approach. Okay. Second approach is beginning. 1 divided by 1.1. From the beginning again, 1 divided by 1.11 2 times. 1.11 2 times. From the beginning, 1 divided by 1.12 3 times. 712. Now, a problem when interest rate changes can be solved like this. There are two ways it can be solved. No change in interest rate, no headache. 1 divided by 1.1. No change in interest rate, 0.909. 826 751. No change in interest rate. 909 826 751. 10%. No change. No doubts. No discussion. Okay. In case it changes, either I may follow this approach, or I may follow this approach. First understand what is the difference in approach, and then how do we identify what is the difference. First approach is, again I'm repeating in the calculator, 1 divided by 1.1. Leave the number as it is in the calculator. Now divide by 1.11. Leave the number as it is in the calculator. Now divide by 1.12. This is one approach of calculation. What is second approach is 1 divided by 1.1. You got the answer. Remove the answer now. Start from the beginning. 1 divided by 1.11 two times. Remove the answer. Start from the beginning. 1 divided by 1.12 three times. There are two approaches. How do I identify which approach? I will touch upon as we proceed. But understand that a bond valuation, when I do, one approach is 909, 826, 751, easiest, no headache, which is what you have been doing till now. Then comes the first scenario where there is a change in interest rate, but that change is only for that specific period. Only for that specific period. Today, I go to a bank, ask what is 1 year FD, they'll say 10%, let's assume. 2 year FD, they'll say 11%. This 2 year 11% means first year also they'll pay 11, second year also they'll pay 11. First year also they'll pay 11, second year also they'll pay 11. This is one way FD rates are given by the bank. Another way is I went to the bank, asked 1 year FD, they gave me 10%. I asked them at the end of first year, I will renew the FD. Can you today itself give me the interest rate for the next year? They may give, that is technically called as FRA, which you will learn in interest rate chapter, forward rate agreement. So I asked the bank, what is the interest rate for year 1 to 2? He says 11% for the second year. Let's freeze the rate today. And he also tells me 12% for the third year. Let's freeze the rate today itself. This is one way the interest rates can be. This is called forward discount rate. Forward discount rate means that extra interest rate is applicable only for that second year, only for the third year. Spot yield discount rate. What is spot? Spot means from today. From today. Forward means only applicable for. So this 10%, 11, 12. Forward spot yield. Forward means this is applicable for 0 to 1. This is also applicable for 0 to 1. Forward means applicable for 1 to 2 years. This is 0 to 2 years. 0 to 2 years. This is 2 to 3 years. 0 to 3 years. A bank normally does this. Bank normally does this. When I ask for an FD rate from the bank, they will tell 10, 11, 12. 10 is applicable for 0 to 1. 11 is applicable for 0 to 2. 12 is applicable for 0 to 3. So I have to read the question, understand what they are trying to tell. By understanding what they are saying, you can calculate PVF as 0.909, 819, 731 or 909, 812, 712. Obviously, both will end up giving different answer in the end. Both will end up giving different answer in the end. Clear? Any doubts on this? Final one more time explanation. This is the point. I have to see whether there is a uniform discount rate. Uniform, very happy, no problem at all. Just keep on doing the same rate. If there is a change in discount rate, it can be a forward discount rate or it can be a spot yield. Discount rate for year 1 2%, increases by 2% for every year. What will be PVF of year 3? PVF of year 1, 1 divided by 1.1, leave the number. Divide by 1.12, leave the number. Divide by 1.14, leave the number. This is called forward rate. This is called forward rate. Spot yield. ABC wants to issue 9% bond redeemable in 3 years. The annual spot yield curve. The annual spot yield curve. Spot yield curve means it is applicable from today till whichever year. 1 year you want to calculate 1 divided by 1.12. 2 years you want to calculate 1 divided by 1.1162 square. 3 year you want to calculate 1 divided by 1.1133 cube. Any doubts on this? Any doubts on this part? Same thing can happen for cost of equity also. This example 66 you see at home. I did not discuss it in equity because I did not change the discount rate there. But it can change. It can change for bond valuation. It can change for your equity valuation. It can change for your real estate valuation. Any doubts on this? Okay. This part is little illogical. I can't help it. Okay. Expected price of a bond. A question may ask this. Two times it has come in exam till now. ICI uses a formula called intrinsic value of bond into beta. I am not getting into much logic here because in the heading itself I mentioned not a logical item. What is intrinsic value? Is real value of a bond. What is real value? Present value of future cash flow discounted at investor required rate of return. You got the intrinsic value, multiply that with beta. Why multiply with beta? Don't ask me. I cannot give any logic for that, and I don't agree to that calculation also. But in exam, if at all it comes, you just do this because 2-3 times it has come in exam. Any doubts? Can we proceed? Okay. Aqua Industries is planning to issue a debenture series on the following term: face value 1 to 4, 5 to 8, 9 to 10. Some rates are given. What I want you to do in your notebook is write year and cash flow, PVF at some percentage, only percentage. You keep writing in, I will start writing in 2 minutes. Year, cash flow, PVF at what rate? Write this and then wait. Year, cash flow, PVF at what rate? This question, I want you to do that. 2 minutes for you to do it, and then I'll start doing it. And then I'll explain the concept also. Year, cash flow, PVF at what rate? Please don't waste time on doing DCF calculation and all. PVF, not even PVF calculation. PVF at what rate alone you write. Year, cash flow, PVF at what rate? I don't need anything beyond that because anything beyond that is calculator's work, which if you do a mistake, that's unfortunate. Year, cash flow, PVF at what rate? They want us to calculate issue price of the debenture. Normally, a bond will pay same rate of interest. This is not a variable bond. Variable bond means with some benchmark. But here, when I issued itself, I told first 4 years what interest we are going to pay. So 9 rupees. It is basically 1, 2, 3, 4. Separately, we'll have to write. Then 5 to 8, what interest? 10. 9 to 10, 14. And at the end of year 10, extra how much we will get? 5% premium on maturity, which is 105. Clear? 9, 10, 14, 105, 1, 2, 3, 4. You'll have to write it like this separately. There's no other choice. You'll have to write it like this: 9, 10, whatever is the number. PVF at what rate you have taken? Now it says current market rate on similar debenture is similar debenture 15% mean the market is expecting 15% only. Infosys is paying 15%. TCS should also pay 15%. Infosys is paying 15%. TCS is also should pay 15%. Company proposes to issue the price the issue in such a manner that it can yield how much? 16% rate of return to the investor. 16% rate of return to the investor. This is the only discussion here. One, writing the cash flow, which you have done. I did not see much challenge from your side. So the concept says this: discount rate for arriving at an issue price. Investor required return is the ideal discount rate. Multiple other names are there as per concept 37: prevailing rate of interest, market rate of interest, going rate of interest. Exception: company wants to offer higher yield, lower yield, and hence the same can be taken as discount rate. Company is saying, I will do something different. Please go ahead and take that as the discount rate. Company wants to give more, maybe make it attractive. Company wants to give less, make it unattractive, whatever be the reason. If company wants to offer more, use the higher discount rate. Company wants to offer less, use the lower discount rate. To put it very simply, issue price at 16%. Intrinsic value, if you want to calculate, at 15%. Intrinsic value you want to calculate at 15%. Issue price you want to calculate, it will be at 16%. Indirectly, my issue price will be lower, intrinsic value will be higher. Everyone will get excited and buy the bond. Everyone will get excited and buy the bond, because when you apply a higher discount rate, the value will keep going down. So I will issue it at 70. The intrinsic value could be 75. The intrinsic value could be 75. Intrinsic value is at 15%. They're not asking me to calculate intrinsic. I can say determine the intrinsic value and issue price of the debenture. Intrinsic value at 15%, issue price at 16%. Any doubts on the concept here? Can we proceed? Give me what should be the answer to this example which you see here. Read it carefully and then give me the answer. Not very tricky and all, but still take time and give me the answer. I've got the answer in live online. So treasury bill is 9. A rated bond will be 12. AA rated is AAA plus 1, but I don't know the AAA. AAA is given here. AAA is what? A rated bond minus 2%. Minus 2% means 10%. And from this 10, it goes to 11. Any doubts on this? Any doubts on this? This is what we saw. The company plans to issue 10% debenture. Yield on a similar debenture is 15%. Company plans to issue in such a manner that it gives how much? 18% return to investor. You want to give 18%, then use 18% for the valuation purpose or for arriving at the issue price. Real value you want to get, then it is at 15%. Any doubt? Coupon rate does not really matter. The coupon rate does not really matter in the valuation exercise. Any doubts on this? Can we proceed? Done? Okay. Go through this example and tell me what should be the discount rate. Same thing, right? Year cash flow PVF at what rate? Year cash flow PVF at what rate? Year cash flow PVF at some rate. Write in your notebook. Question 53, 2 minutes for you. Year cash flow PVF at what rate? Other things I don't want to waste time. I've started getting answers. I want you to write in your notebook. Year cash flow PVF at what rate? And moment you have written that, no, it means that problem is over. The other things were just formality. Other things are just formality. Writing year cash flow is the most critical part. They've asked for a few things, all that I'll explain. But first, get me year cash flow PVF. How many years is the life of the bond? So there are 3 requirements. First is intrinsic value. If you want to do intrinsic value calculation, you cannot write year 0. You will start with first year. Then they've asked for yield to maturity, means IRR, year 0, and then the calculation will start. So year cash flow PVF at, I don't know the rate. Okay, I'll write the rate. How many years is the life you said? 1 to 5, year 5. 1 to 5 and year 5. How much is the interest the bond is paying? 50, 15%, which is 150. Redemption is at par, which is 1000. PVF at we are issuing what rating? Double A rated bond. Treasury bill is at 9%. 9 plus 3 is 12. 12 plus 2 is 14. Clear? There's a doubt. Okay, there's a doubt that if company wants to offer a lower yield for like higher yield we saw last question, if they want to offer lower yield, take the lower yield for the discounting purpose. It is all depends on what company wants to do. Obviously, if company does that, nobody will subscribe or very less people will subscribe to the issue. Any doubts on this? IRR you want to do, then start a year zero also. Start a year zero also, where the price is how much? 1025.86, one positive NPV, one negative NPV. What is the formula for current yield? Interest divided by current market price. Not a very good formula. It is only for an irredeemable bond, but they're asking specifically, I can't help it. Current yield is what? Interest divided by current market price. Any doubts on this? Any doubts on this? I really don't have much to explain here. I will now proceed to the next discussion. Any doubts on this? Can we proceed? Okay, let's get to the next concept. Realized yield. Let's understand this concept now. Realized yield. Realized yield means IRR assuming something called as a reinvestment rate. What is this reinvestment rate? Where is this coming into picture? Let's understand this now. Okay, I invested in a bond. I invested in a bond. The bond pays me year cash flow. Year 1 I get, or year 0. Let me start with year 0. I pay 1000 rupees. I pay 1000 rupees. First year 120, second year 120, third year 120, fourth year it gives me 1200. What is 1200? Is 120 plus the redemption value. And I ask you calculate yield to maturity. Yield to maturity, which is nothing but IRR. In your notebook, you will do one positive NPV, one negative NPV, and then get to the answer. So I got answer as 13.63%. I wanted another answer. What is another answer is this 1000 as it is, okay? Nothing I got in first year. Nothing I got in second year. Nothing I got in third year. How is it possible? Nothing I got. I got money. But what did I do? Is this 120 came, no? I put it in some fixed deposit. This 120 came, I put it in some deposit, or I invested somewhere else, or I told the bank, the company itself to keep this money. So whatever this 120 came, this gave me extra 10% every year. I reinvested this money. I reinvested this money at the rate of 10%. In the calculator, 120, add 10% 3 times. From the first year 120 you got, you earned 10% 3 times. 159.72. 120 plus 10% for the second year, 10% for the third year, 10% for the fourth year. You got the money, but you told please keep it with yourself. Can you add for the second 120 10% 2 times? For the second 120 10% 2 times. 140. For the third 120 only one time 10%. And for the last time no addition. For the last time no addition. See, I invested money. I got 1000, 120, 120, 120, 1200. I took this money, that's all. What you did? Dividend reinvestment, interest reinvestment. You did interest reinvestment. With whom did you do reinvestment? Could be with the same company, could be with someone else, whatever it is. You reinvested the money. Why did you reinvest? Let's not debate on that, but you reinvested the money. Because most of the times when an FD is created, bank will give me two choices. One is called interest payout. Second is called interest accumulation to the FD value. So I may go for accumulation. I may go for payout depending on whatever is my need. So 120 went up by 10%, 10%, 10%, reinvested at 10%. I got this. I did again an IRR, okay? This IRR is 13.11%. This IRR is 13.11%. How will you get the IRR? Year cash flow, PVF, DCF, but year 0, 1000, Fourth year 1636. Nothing comes in between. Nothing comes in between. Invest and get money only once. Invest and get money only once. I want you to now tell me 120 plus 13.63%. Tell me the number. 120 plus 13.63. 136 point. Add another 13.63%. 154.9. Add another 13.63%. Okay, now listen. What is that 176 is? The first 120 came now. You earn 13.63 times. Assuming you reinvested at 13.63. Assuming you reinvested at 13.63. Whether I get such a bond, I don't get, I'm not getting into that debate. I reinvested at 13.63. First year you got money 13.63 times. That is the last answer. Second time you got 2 times. That is the second answer there. And the last money you got only 1 time. I got the, see, earlier you were doing 3 years, then 2 years, 1 year. Now I kept on noting down the numbers. Plus 1200. This is another option a person may get. A person may be able to reinvest it at 13.63%. If this happens, then my cash flows is, this is the cash flow I will generate. And in this case, my IRR is same 13.63. Same 13.63. See, what is realized YTM is IRR calculated by assuming a reinvestment rate. Don't worry about the calculations done there. Just understand. And anyway, you will practice one question along with me now. IRR calculated by assuming reinvestment rate. By assuming reinvestment rate. Compute maturity cash flow of every year cash flow by taking reinvestment rate. By taking reinvestment rate. What can be the reinvestment rate? Given in question, or cost of debt. When I say cost of debt, whatever is the cost of debt of the company or the investor expectation, whatever the data is there. Very rare scenario. Reinvestment rate can be 0 if the intermediate cash flow cannot be reinvested. I invest money in a bank, FD. FD will give me interest. Bank says we will transfer it to your current account and you cannot touch the money. You cannot touch the money. I'll transfer to your current account. You cannot touch the money. If I can touch, I can reinvest. If I can touch, I can reinvest the money. Rare scenario. Rare scenario. If you cannot reinvest your money, your reinvestment rate is 0%, which is a very bad scenario, because what will happen if you cannot reinvest? You will get 120 as it is. You will get this 120 as it is. You will get this 120 as it is, and 1200 as it is in which year? Fourth year. In the fourth year, IRR will depress significantly. IRR will go down significantly. Reinvestment is a very important item. Without reinvestment happening, people will have significant fall in their returns. Now, I am now in the working age. So whenever I earn any income, interest income or a dividend income, I don't need that money. I will obviously want to reinvest that money. If I have some fixed deposits, any income comes, I don't want that money now because I'm getting regular salary income or regular professional income. So when that is the scenario, people want to reinvest. If reinvestment returns are less, your IRR will go down significantly. The real return for an investor is realized yield and not the yield to maturity. Not the yield to maturity. Yield to maturity is dependent on the instrument. Realized yield is dependent on the instrument and what you are doing with that money. What you are doing with the money. Able to understand the concept? Compute IRR with one initial outflow and one maturity inflow. One outflow, one inflow. Only one outflow will be there, one inflow will be there. No money comes in between. No money comes in between. I will do a problem on this in 2 minutes so that you get more grip on it. But concept is very simple. You keep getting money. You please reinvest that money. At what rate? Question will give some data. And this is the relationship. Normal YTM versus realized YTM. If you can reinvest it at a higher rate. Your realized YTM will jump. Your IRR 12%, reinvestment 20%. Your realized YTM will jump than the normal YTM. Realized YTM would be better than the normal YTM. Reinvest at the same rate. Both are same. I showed you the 13.63. And if you're reinvesting it at a lower rate, your realized YTM will start going down. Realized YTM will start going down. Understand the concept again. This is a very powerful concept from a practical world point of view. I get money. I am not in need of money. Why are you giving me money is what I'm asking the bank or asking the company. They say we pay out interest. We cannot retain your money. I will obviously want to reinvest it. Reinvestment, if I can do it at a higher rate, my realized YTM will go up. Reinvestment, if I do it at a lower rate, my realized YTM will go down. I don't even reinvest, the returns will depress significantly. See, when I say don't reinvest, you got the money, you have two choices: either reinvest or spend it. Spending is also okay. If you've spent the money also, that is okay, because you have got the benefit of that money in that year. If I had 1 lakh rupee in the last year, with 1 lakh rupee I should have got certain things. If I get those same things now, 1 lakh will not be sufficient. Inflation. So any idle money is just waste. Any idle money is just waste. Either invest it, you cannot invest, go ahead and spend it also. Go ahead and spend it also. That is also okay, but not investing will depress the returns of the investor. Any doubts on this? Able to understand the concept here? We will do a problem, but can you give me answer to this? YTM 20%, reinvestment 15%. What can be the realized yield? YTM 20, reinvestment 15. Less than 20%. Less than 20%. What number and all I don't want to test now, because that we'll have to do a detailed calculation. But less than 20%. Any doubts on this? Able to understand the concept? Now let's come to a concept called duration. Any doubts till the earlier one? Can we proceed? Okay. Now let's understand what does this term duration all mean. Now, whenever I invest in a bond, the bond pays cash flows over its life. Year cash flow. This is the structure. Let's assume 100, 100, 100, 1000, 100. Ignore the year 0. Okay. This is what the bond is going to pay. PVF at 12%. Let's just assume PVF is at 12%. 1 divided by 1.12. 12%. I have to do discounting. I get DCF. This is basically the price of the bond. Price of the bond is 939.80. What duration is going to tell us in what is the time period in which I will get back this money. To put it very simple, what is the payback period which we learn as part of capital? Similar, not exactly, okay. In what time period am I going to get this 939? I will invest 939 today. First year I'll get back 89. Second year I'll get back 79. Third year I'll get back 71. Fourth year I'll get back 699. It's not exactly payback, but I'll be getting back this money. So somebody told me 89 will come in first year, which means 89.3 on my 939. On my 939. Why on 939? You will understand in some time. These are the percentages I get back. First year I get back 9.5% of the bond cash flow of the 939 rupees. First year discounted value, I get back 9.5% of the bond value. Second year I get back 8.48% of the bond value. Third year I get back 7.58% of the bond value. Fourth year I get back 74.44% of the bond value. What duration said is, okay, let's do a weighted average. What is weighted average? First year you get back 9.5% of the bond value. Second year you get back 8.48% of the bond value. Third year you get back 7.58% of the bond value. Fourth year you get back 74.44% of the bond value. Fourth year you get back 74.44. What is the single weighted average time period? Single weighted average time period in which you get back the money invested. Some money comes in first year, some money comes in second year, some money comes back in the third year, some money comes back in the fourth year. Duration basically will tell me that on an average you get back your money in 2.5 years, 3 years, 3.5 years, 3.2 years, 4 years, whatever number. I don't know. I'll have to do the calculation. In what time period do I get? Can you tell me this answer? Quickly do in your calculator. 1 into 9.5%, which is 0.095. Use the GT function. 1 into 9.5%. Then 2 into 8.48%. 3 into 7.58%. 4 into 74.44%. 3.4696 is the time period in which I will get back the money. Duration basically means what is the weighted average time period in which we get back the invested money. I'll explain again. I invested 100, sorry, I invested whatever amount. Whatever amount, ideal amount is 939. Ideal amount is 939 because that is the real value today. I invested 939 today with the hope that I'll get back 89, 79, 71, 699. This is what I'll be getting back, present value. Okay. So I'll be getting back 100, but the present value is this. So bond pays 9.5% of its current market price in year one. 8.48% of its current market price in year 2, 7.58% of its current market price in year 3, 74.44% of its current market price in year 4. I tell bond, don't do all this. Can you give me one money in which time period? He'll say, I'll give you in 3.4696 years. I'll give you in 3.4696 years. If you don't want me to pay first year, second year, third year, fourth year, I'll give you in one date. Which date? 3.4696 years. How much he will give? 100, 100, 100 and 1100. 100, 100, 100 and 1100 all put together in single time period. That single time period is what? 3.4696. Now, this number which we've calculated is technically called weight, and then we do something called as product. Product is year 1 into the weight. This is what I have been teaching to my students, but now I found out another easier way. So I'll tell you the another easier way also, which can save maybe a minute of calculation. If you are used to this way of teaching, you continue with this. The other way is no need to calculate weight. No need to calculate weight. Then what I can do, first clear on the concept. What is the concept is, first year you get some money, second year you get some money, third year you get some money, fourth year you get some money. I called the company, don't give me money in first year, don't give me money in second year, don't give me money in third year, give me single money in 3.4696 years. In 3.4696 years. That is concept is called duration. That concept is called duration. Duration means how long on average it takes to receive the cash flow, interest payment and principal payment, weighted by the present value of those cash flow. Weighted by the present value of those cash flow. Weights were those 7%, 8%. How did you get? Using the present value. What is the other way? Other way is product is equal to year into DCF directly. No need to do weight column. Year into DCF directly. Year, cash flow, PVF, DCF, you know. Add one more column called product. This is how calculation will be done. Year, cash flow, PVF, DCF known to you. An extra column is called product. What is product? Year into DCF. Do this. Put a total. This total divided by this total. This total divided by this total. Answer is 3.4696. 3.4696. Whichever way you are comfortable. I have taught students the other way, but I find this to be little time saving. No need to calculate weight every year. No need to calculate weight every year. Year, cash flow, PVF, DCF is known to you. One extra column you have to add. What is that extra column? Product. Extra column is called product. What is product? Year into DCF. Year into DCF. put a total of the product, total of the DCF, and divide and get the answer. Now, when we solve question, one question you will do duration along with me. Other question I will only be doing it in Excel. Okay, being very clear, because I cannot use annuity here. If it is 10-year, you have to write 1, 2, 3, 4, 5 separately. Annuity concept cannot work in case of duration calculation. There is a formula also to calculate duration. Unfortunately, other formula, at least I remember. That formula I don't even remember. I'm not getting into it also. There is a formula, I don't even remember the formula. You want to go through formula approach, maybe I would have written the formula. I've not even written the formula also. At least I used to write formula, but I've not written the formula also here. So if you are interested in formula approach, Institute study material will have it. You remember formula, maybe you will save time also, but I find it comfortable doing this. Year, cash flow, PVF at YTM, DCF, year into DCF, total of weight divided by total of DCF, total of weight divided by total of DCF. In the, sorry, not total of weight, total of product. This is total of product. Just change it. Total of product. This year into DCF is called product. Total of product divided by total of DCF column, page 57. Total of product divided by total of DCF column. Okay, listen now. Listen. Let's just focus more on this area. The calculation is very simple. You will have a year, you will have a cash flow, you will have a PVF, you will have a DCF. Year cash flow, by now we have seen many questions. It's very easy to get. There will be challenging question on year and cash flow also. Then comes another point. Somewhere it has something to do with no interest rate risk. I'll discuss this in some time. Technically a concept called immunization. What is that? We will touch upon in some time. It also has something to do with price computation change analysis, which is called volatility. Both the concepts we will touch upon in some time. Now, duration is not only for an annual bond, it can be for a half yearly bond also. Then half year cash flow, PVF, DCF, product, sum of product by sum of weight. The final answer is 21 half years. If you get answer as 21, it is 21 half years. If you get answer here 5 years, if it is done in years, answer is 5 years. If it is done for a half yearly bond, answer is half years. Total of year, ignore this, okay, ignore this part, total of year into weight, okay, ignore this part. Total of year into weight. For half yearly bond, for half yearly bond, what will you do? You will do half year into weight, and the duration answer would be in half years. The duration answer would be in half years. For a quarterly bond, duration answer would be in quarters. Okay, all this was okay to understand. What do I do for this then? Irredeemable bond. A bond can be irredeemable also. Redeemable you have explained, understood. What to do for an irredeemable bond then? Because a bond can be irredeemable. Irredeemable means 1, 2, 3, 4, 5, 6. There is no end to it. In my regular class, I had shown the validation of this, which is not very critical, so I'm not spending time on that. But it is, can be a 10-year bond, 20-year bond, 30-year. Sorry, it is infinite. It is infinite. In case of infinite, we use this formula 1 plus YTM by YTM. Logic of this, let's not spend much time because it is not very critical. I don't want to spend around 10 minutes on logic on this. 1 plus YTM divided. This is the only formula which till now I have not explained the logic. Okay, 1 plus YTM divided by YTM. There can be another category of bond called zero coupon bond. What is zero coupon bond is? Year 1 you will get back 0. Year 2 you will get back 0. Year 3 you will get back 0. Year 4 you may get back 1500. If it is a zero coupon bond, duration is equal to life. Reason is you get money only in the last year. You get money only in the last year. So a zero coupon bond is one, does not pay any interest. If it does not pay any interest, I ask company, can you give me one money in at one time period? He'll say, I'll give you only one money, and that is at the last end of the life. End of the life. I'm not going to give in between money and all. It's only one money and given at end of life. What is duration? A single time period at which the company can pay me money. In this example, they can pay on 3.4696 years. 3.4696 years. Clear? Any doubts on this? Let's do this example together. Face value 1000, coupon rate 11%, life 6 years, yield to maturity 15%, compute duration. Compute duration. It says life 6 years, you make it as 3 years. Okay, we are doing 3 years. I don't want to do 6 years. Example 74, life is 3 years. Okay, right? Year, right now. Year, cash flow, PVF at 15%, DCF, product, 3 years life. I'm changing the question as 3 years. Coupon rate is 11%, face value is 1000. Okay, coupon rate is 11%, face value is 1000. It's a 3-year bond. It's a 3-year bond. Okay, year one, how much the bond will pay? 110. Year two, 110. Year three, 1110. Only 3-year life. Okay, I've changed the question. I don't want to spend time on computations. I want to spend time on logics. Okay, before we do calculation, again listen. What I'm trying to calculate here is, instead of bond paying me first year some money, second year some money, third year some money, I tell the company to give me something, at one specific point. That specific point is called duration. At 15%, 1 divided by 1.15, 3 decimal, 0.870756658. DCF, do multiplication, put a total of DCF, and product, put a total. Okay, I've started getting answers in live online, but my main focus will be on getting the grip on the concept. One extra column is to be added, which is called product column. In class, I used to do weight and product earlier, but I feel one column is sufficient. One caution: no annuity factors. No annuity factor. If you by mistake do annuity factor, you will have to repeat the calculation without annuity factor, because if you do with annuity factor, I cannot calculate it. So I multiply now. Again, put a total, and duration is sum of product by sum of DCF. Sum of product by sum of DCF. I had done this by explaining those percentages and all. Those are extra computation. This is easiest way to do it. The duration answer is 2.6980 or 2.70. There any doubts in this? Can we proceed? Understood this? There is a utility with this called as volatility. I'll touch upon that as we proceed. Any doubts in this first? Clear? So for a redeemable bond, total of year into weight you have to do, and then thereafter you have to divide. And here half year into weight, and thereafter you have to divide. Duration in half years, duration in years. Irredeemable bond, 1 plus YTM divided by YTM. 1 plus yield to maturity divided by yield to maturity. And if it's a zero coupon bond, there is no end to a zero coupon bond. There is no, so there is no interest paid during the life. So duration is equal to life of the bond. Give me answer to this. YTM of perpetual bond. YTM of perpetual bond. Yeah, I've already got the answers here. 1 plus YTM divided by YTM. 1 plus 0.08 which is 13.5 years. Now, why did we do this duration calculation? The concept of duration gets me to an item called volatility. The concept of duration gets me to an item called volatility, and somewhere this is the purpose of calculating duration. Duration helps me in calculating something called as volatility. Let's understand this. You did this calculation, you told me duration is 2.69 years. Duration is 2.69 years. Now, I want to know what will happen if PVF becomes 16%. That is, from 15 it becomes 16%. I want to know what will be the bond price. One approach is go ahead, do discounting at 16% and get the answer. There's another approach which will give approximate answer, which will give. So if I do PVF at 16%, 1 divided by 1.16 and I do DCF, I get answer is, again I'm repeating, when I start doing it in Excel, you just focus on what I'm explaining. Don't look at the screen and keep saying what is he doing and all. Don't worry about that. 909 has become 888. Can you tell me what is the percentage fall? Calculate the percentage fall. 909 has become 888. Tell me the percentage fall. Minus 888.06 divided by 909. 2.33%. The fall is 2.33. This 2.33 I can calculate using the duration concept rather than doing so much calculation. How will duration help? 2.69, which is this answer, divide by 1 plus YTM. 2.69 divided by 1.15. Can you tell me the answer? 1 plus YTM. Approximately. Exact answer will not come. Okay. 2.34. This concept is called volatility. I'll touch upon volatility now. But the objective is very simple. I want to know what will happen to my bond price if RBI increases interest rate, RBI decreases interest rate. One way is in Excel, do all this math and then get to the answer. But when I'm doing a discussion with someone, or I want to look at which bond is more volatile, which bond is less volatile, which will have more impact of interest rate, which will have lesser impact of interest rate. One way of doing it is through a concept called volatility, which is here. Volatility or modified duration and change in price due to volatility helps in finding out the impact of yield change on bond price. Yield change on bond price. What is the formula? Duration divided by 1 plus yield to maturity. You told me 2.33. How did we do 2.33? 999, 909 minus 888 divided by 888. Obviously a longer calculation. Shorter quick calculation, duration divided by 1 plus yield to maturity. There are certain other important points there, but this is the concept. What is the purpose of calculating duration is also this. Very high duration will have very high volatility, and if interest rates go up or go down, I can get impacted significantly. I can get impacted significantly. High duration indicates high volatility. High volatility, high price risk. High price risk. If I am an investor who do not want to see bond, normally less risk, but I don't want this risk also. What is the risk? Interest going up, going down. Because if interest goes up in the market, 909 will become 888. I will have a loss. Further goes up, 888 will further go down. Further goes up, further goes down. Yield and price has inverse relationship. Yield and price has inverse relationship. Because of this inverse relationship, I will be impacted. I will be impacted whenever there is a change in the interest rates in the economy. I cannot control RBI. RBI will increase, RBI will decrease. Only good thing is interest rates can't change every day and all. It is a very rare kind of a change which happens, and also that time also very limited change will happen. But still, if you don't want to take that risk, then invest in low duration bonds. Invest in low duration bond. So what it says, duration divided by 1 plus YTM is called volatility. With this, I can find what is the percentage change. What is percentage change? Listen, volatility we got 2.34%. What does volatility mean is, bond price will change by 2.34% if interest change by 1%. If interest change by 1%, assuming interest change by half percent, bond price will change by half of 2.34. Bond price will change by half of 2.34. Interest changes by 2%. Bond price will change by double of 2.34. Double of 2.34. One important point, when we do IRR calculation, we used to have lower rate and higher rate. The gap should be lower. The concept of volatility will work only for smaller change in interest rate. Suddenly you say interest rate change by 5%, 10%. This concept will fail. It can work only for a smaller change, and it is an approximate answer. It is an approximate answer which will work for a smaller change in interest rate, not for a bigger change in interest rate. For example, let's come back here. I now do 15.5. I do 15.5. 15.5 means increase of how much? Half a percent. If interest rate go up by half a percent, bond price will change by half of 2.34. Bond price will change by half of 2.34. Where is that 2.34? 2.69 divided by 1 plus yield to maturity. I'll explain this again one more time. Let me just quickly do this calculation. 15.5%. Can you calculate and tell me what is the bond price change? 909 has become 898. 909 has become 898. Tell me the percentage change. 1.22 looks high. 1.22. Okay, 1.22 is the exact answer. Approximate answer is 1.17. 1.17. What is 1.17? 2.69. You divided by that 1.15 and earlier told me an answer. That half of that volatility will give me approximate answer. Exact answer, if you want, you will have to go through this calculation. I'll repeat it once, then I do a problem, and then I'll come back again. Volatility or modified duration helps in finding out the impact of price change and the interest change. Duration divided by 1 plus yield to maturity. There will be some variation on half year bond and all. I'll explain as we proceed. Duration divided by 1 plus YTM. What will be the price change? Volatility into change in yield. 1% means into 1. 2% means into 2. Half percent means into half. 0.1% means into 0.1. And yield increases, price will fall. Yield decreases, price will increase. Any doubts till this? Any doubts on this? I'll repeat now. Year, cash flow, PVF, DCF, product, get duration. From duration divide by 1 plus YTM, get volatility. Volatility into the interest change can be 1%. Maximum is 2%. Okay, 2 itself is very high. We have not seen RBI changing interest rate by even more than half a percent. Very rarely they change such a high interest rate. So 0.25 it can handle, 0.5 it can handle, 1% and all it can handle. So volatility into the yield change will tell me what is the percentage fall in bond price or percentage rise in bond price. Bond price will go up or go down based on the interest rates. Any doubts till this? In my concepts which I was doing, one concept I did not cover. I thought I'll have a problem on that, but I'll cover that concept now. Broken period bond valuation. What is, let's understand broken period bond valuation. What is broken period bond valuation is, any bond valuation which we do, we can do it on the date on which interest is paid. When I say on the date on which interest is paid is, a bond pays interest in April and let's say March and September. These are the time period in which interest is paid. If I have to do valuation, I can do valuation on April 1 or I can do valuation on October 1 because I'll be writing year cash flow PV of DCF or half year cash flow PV of DCF. Full half year has to be there. If only half of half year is there, or let's assume you want to do it on June, July, August, those months, our technique of valuation will not work. Broken period, valuation of bond on non-interest payment dates. Let us assume bond pays interest on March 31 and September 30. I need to arrive at value of when? June 1, 2025. If you want to arrive at June 1, 2025, imagine you are on April 1, 2025. Imagine you are on April 1, 2025. Maturity could be April 1, 2045. Another 20 years exactly are there. Exact 20 years are there. 40 half years, right? Period, cash flow, PV of DCF, do all the calculation. You will get the answer of April 1, 2025. Add accrued interest to it, you will get June 1, 2025. Add accrued interest. To put it very simply, my bond valuation can give me only X interest value. It cannot give me cum interest value. What is cum interest value? Any non-interest payment date, interest will keep getting added. Accrued interest will keep getting added. You would have done this in investment accounting at CA Inter. There will be a value, they'll say X interest value, cum interest value, and you used to segregate the value as X interest, interest, and the cum interest portion. So any bond valuation can only be done on the interest payment date or the next day of the interest payment date. Any other date you want to value, very simple thing you need to add something called as accrued interest. Add something called as accrued interest. An example. Market price on Jan 1, 2019. This test lot of concept 100. Face value 100. Interest rate is 10%. Interest is payable on June 30 and December 31. I want to know the value on October 1, 2019. When is the interest paid before October 1, 2019? So then I need to know what is the value of July 1, 2019. They have given January 1. They have given January 1. I need value of which year? July 1, 2019. I'll repeat again. Any bond valuation exercise can only be done on exact interest payment date or a date after the interest payment date. Practical world, prices can be there for every day, but our valuation can be done only exact. Excel can do any date also, because in Excel I can write year as 0.234 years. In your notebook you cannot write 0.234 because divided by power 0.234 calculator cannot give. In Excel I can do any years, doesn't really matter. But from an exam point of view, you can do exact year. Can you tell me what will be the value of the bond on July 1, 2019 here? There is one concept I had explained, very difficult for you to pick it up, but let's see. It will be 100. Listen, it says 100 is the price, face value 100. It means bond is meeting investor expectation. Bond is meeting investor expectation. If a bond meets investor expectation, it will continue to quote at 100 on any bond valuation date. On any bond valuation date, it will quote at 100. This concept we learned maybe some time back. If a bond is quoting at par, it means bond is meeting investor expectation, and it will continue to be at par on any interest payment date is equal to face value. Interest rate and YTM will be same. This would mean the bond will quote at par on any interest payment date. So on July 1 it will be at 100, January 1, 2019 100, January 1, 2020 100, July 1, 2020 100, unless yield changes. If yield changes, I can't help it. As long as yield, coupon cannot change, yield and coupon remain same, bond will quote at 100. From July 1, 100 plus 100 into 10%, July interest, August interest, September interest. July interest, August interest, September interest. If you do, you will be able to get to the bond value, which is 102.50. 102.50. 100 into 10% into 3 by 12. in a hurry. This NCQ was to do this way because student may think from January I will add 9-month interest. No, you cannot add 9-month interest because after 6 months interest is paid out. Accrued interest will be reflected in the value only till it is not paid. Moment dividend is paid, bond price falls by the amount of dividend. Moment interest is paid, bond price, sorry, share price falls by the amount of dividend, bond price will fall by the amount of interest. In a practical world, every bond will behave like this. It will start going up January, June. From 100 it will go up. Interest paid, go back to 100. It will go up on a daily basis. Accrued interest added, go down. Why this happens? Because if this does not happen, I'll smartly, if it is every day like this, I will buy exactly on June 29. I'll buy exactly on June 29, sell it on June 30. Buy it on June 29, sell it on June 30. Market will not allow this. Market will not allow this. Market will keep increasing the bond price on a daily basis, and once the interest is paid, bond price will fall by the amount of interest. So if you want to do January valuation, year cash flow PVF or half year cash flow PVF DCF. You want to do June valuation, half year cash flow PVF DCF. You want to do September valuation, Excel can do it, you cannot do it. So then what will you do? Get the June answer, whichever is the last payment, and add accrued interest. Add accrued interest. Able to understand the concept? Any doubts on this? There used to be a question on this. I've removed that question. Maybe have not been tested for a very long period, but concept I am explaining, which means if at all rarely they test, you at least be aware of the concept. Any non-interest payment date you want to value, calculate the value before that exact date. We have done many questions where they said it was issued in 2008. You are in 2019. Do the valuation in 2019. I can do. So any interest payment date, do the valuation. Add accrued interest. Add accrued interest. Any doubts on the concept here? Can we proceed? Done. Can you give me answer to this volatility concept? Example 76. Live online guys, you can type it. Yield is increasing, decreasing here. Increasing. Price will decrease. Price will decrease. What will be the decrease? 4.5 into 0.25. 4.5 into 0.25. Price will decrease by 1.125 percentage. Okay. This little bit be very clear. Okay. If you have a half yearly bond, volatility calculation says that volatility is what? Duration divided by 1 plus yield to maturity. Institute material very clearly says yield to maturity means relevant yield to maturity. What is relevant? For a half yearly bond, denominator is half yearly YTM. For a half yearly bond, denominator is half yearly YTM. For an annual bond, your annual YTM. Quarterly bond, quarterly YTM. So when you do the calculation in the denominator, you have to use what? Half yearly yield to maturity. You have to use half yearly yield to maturity. The numerator can be yearly duration, can be half yearly duration. Any of them can be there. If it's yearly duration, multiply with change in annual interest. If it's half yearly duration, multiply with change in half yearly rate. Change in half yearly rate. Both will give same answer. I'll explain. Duration is 10 years. 10 divided by 1.05. Annual interest changed by 1%. Annual interest changed by 1%. Don't do any calculation at all. Okay. 10 is the duration divided by 1.05. Other option is duration in half year. 10 years means 20 half years. 10 years means 20 half year. Divide again by 1.05. Half yearly interest changes half a percent. Annual interest change 1%. Half yearly changes half a percent. Annual, I'll explain this again. Duration can be in years. Duration can be in half years. Years means 10 years. Half years means 20 half years. multiply, if it's duration in year, multiply with annual change in interest rate. What is annual change? 1% increase in full year, half a percent increase in half a year, half a percent increase in half year. So 10 divided by 1.05 into 1, or 20 divided by 1.05 into 0.5. My main worry is not that. My main discussion is 1.05. What is 0.5? Half yearly YTM. Half yearly YTM. Quickly give me answer to this. Duration of half yearly bond, YTM. What is the volatility? 5.85 divided by 1 plus 0.05. YTM is normally for a year. Half yearly is 5%. Half yearly is 5%. Any doubts on this? Able to understand this? Got clarity on this? Any doubts on this? Divided by 1.05. If this is year, multiply with annual change in interest rate. If this is half year, multiply with half yearly change in interest rate. Any doubts on this? Clear? Can we proceed? Any doubts? Now, another utility, just give me, okay. Another utility of duration is this. Duration and churning of portfolio. I'll explain it and then do an MCQ. You'll get grip. Questions and all is not there. What is duration and churning of portfolio? Till now we have learnt yield and price has what relationship? Inverse relationship. If RBI is likely to decrease interest rate, if RBI is likely to decrease interest rate, what will happen to bond price? Bond price will increase. If RBI is going to reduce interest rate, bond price will increase. Invest in high duration bond, high duration, high volatility, higher price increase. High duration, high volatility, higher price increase. If RBI increases interest rate, bond price will go down. Lower duration, lower volatility, and lower price fall. All this point, if you want to speculate, you don't want to speculate, you don't want to do any of this, then don't get into this. This is only purely for a speculation purpose, purely for a speculation purpose. If interest rates are likely to go up in the economy, if interest rates are likely to go up in the economy, I will invest in lower duration bond, because interest rates go up, bond prices go down. Lower duration, lower volatility, lower price fall. Higher duration, higher volatility, higher price increase. When price increases, I want higher duration. When price decreases, I want lower duration. Yield likely to go up, price will fall, reduce duration, replace long duration bonds with shorter duration bonds. Yield likely to go down, price will increase, increase duration. Any doubts on the concept? I'll explain again. Duration and churning of portfolio. Whether companies do, investors do, yes, practically they do this. Practically, if but it's a call on the interest rate. You are speculating on the interest rate. If you speculate on interest rate, then in that speculation case, you have to do this. Yield likely to go up, price will go down, lower duration, lower volatility, lower fall. If price will increase, higher duration, higher volatility, higher increase. Any doubts on this? Give me answer to this. It's a very good MCQ. Okay, I've started getting the answers in live online. Which is the answer? Duration is 8 years. Yield will increase. Yield is increasing. Price is going to fall. I want lower duration. Increase investment in lower duration bond by selling higher duration bond. Clear? Any doubts on this? Done? Okay. Now comes the next utility of duration called as immunization. What is immunization? Let's understand. See, whenever you invest in a bond, there are two major risks are there. Apart from that, other risks are there. There's a one risk called default risk. Default risk means you invest in Reliance Industries, default risk is less. You invest in Anil Ambani's company, they may not repay your money. That is an event driven risk. Two major risks related to interest rate is, if interest rate go up, there is a risk for me. Interest rate go down, there is a risk for me. Whenever interest rate go up, what happens to price? Tell me, price will fall. But I'm still happy about one thing here. If interest rates go up, I will get every year interest. No, I'll reinvest now at a higher interest rate. I will reinvest now at a higher interest. So interest rate going up, price will fall. I'll cry about it. Price risk. But reinvestment is good for me. I will reinvest it at a higher rate. I'm very happy if interest rates go up in the economy. One good thing will happen. Reinvestment will happen at a higher rate and price will fall. That is a disadvantage for me. If interest rates go down, what happens to price? Price goes up, but I will cry about one thing: reinvestment. So every event has two impact. One impact is increase in interest rate, price will go down. Reinvestment income will increase. Decrease in interest rate, price will increase. Reinvestment income will decrease. I am going to get to a time period. Duration basically says that if you invest for example, last question we did some 3.564 years, something came. That concept says that you buy a bond, exactly sell it after 3.56 year. Exactly sell it after 3.56 year. Why do you sell? Why can't I hold back? No, exactly sell it after 3.56. If you do that, your increase in interest rate happens, benefit of price fall, disadvantage of price fall will be offset exactly by the higher reinvestment income. There are two things happen. One is price risk, second is reinvestment risk, both opposite direction. What duration says is, if you invest for 3.5 years, price will fall by 20 rupees, reinvestment income will go up exactly by 20 rupees. One place you lose 20, another place you gain exact 20. That means you are immune to interest rate movement. Immune means interest rate go up, not bothered. Interest rate go down, not bothered. I have got immunity. This disease cannot affect me. That is called immunization. What is immunization? Is you are going to have a scenario where effect of price risk. What is price risk? Price going up, price going down is exactly offset by reinvestment risk. What is reinvestment risk? Income going up, income going down because of reinvestment. I am trying to find a time period of investment, because reinvestment income you get every year. So if you wait for 3.564 years, your 20 rupee loss will be compensated by this 20 rupee extra income. Exactly. Now, the concept as such will work only when interest rate changes once. If interest rate changes second time, then duration will again and again change. So you'll have to keep adjusting it. That and all you will understand as we proceed. But concept is immunity means, see, when I invest in a bond, I come with a mindset that I should not have any risk at all. I invested, interest comes, very happy. Suddenly RBI does something, interest rates price can go up, price can go down, and if I have to sell in between because of some reason, I will have problem. So the concept says that you immune your portfolio. What is immune your portfolios? Immunization means invest in. Somebody will say, I need money after 5 years. Go and find a bond which has an exact duration of 5 years. You do not have 5 year duration, have a 3 year duration, another 7 year, weighted average should be 5 years. You should find a bond which has a duration of exact time period for which you want to make investment. If you are able to do this, you are immune to interest rate movements in the economy. Able to understand the concept first? Now, what is immunization? Ensure investment horizon to be equal to duration of bond. I need money after 4 years. Please invest in a bond which has a duration of 4 years. I have to fund an outflow after 6 years. That is, fund an outflow means I have taken some loan or something. I have to repay something after 6 years. Invest in a bond which has a duration of 6 years. Invest in a bond which has a duration of 6 years. Able to understand the concept of immunization? Immunization, as the name indicates, immunity. Immunity means no impact of interest rate changes. No impact of interest rate changes. Able to understand till this? Any doubts? Let's see here. Duration of bond A 4 years. Bond B 10 years. I need money after how many years? 6 years. I asked the market. Market means so many bonds are there. I asked, is there a duration of 6 years? They said no. One bond is 4 years. Another bond is 10 years. I have to now do partially in A, partially in B, so that I get exactly what? 6 years. Please do along with me. This is to calculate weights. I'll be using this table at many other places. Okay. How to calculate weights? This table we will be using at least in 50 questions. How to calculate weights? Bond duration, weight, product. Bond duration, weight and product. This can get replaced with, at inter level you would have learnt, source, cost, weight, product, WACC calculation. You could have learned something called as WACC. I'll be doing in portfolio beta, security beta, weight, product to calculate weighted beta. Wherever weighted average is to be done, this is the format. Bond, duration, weight and product. I have A, I have B, I have overall. A, B and overall. Duration of A is 4 years, 10 years. Together I want 6 years. 4, 10 and 6. 1 rupee is my investment. In that, X, 1 minus X. X and 1 minus X. Or A and 1 minus A, whatever way you want to call. So this is 4X. 10 minus 10X. Total has to be 6 into 1, 6. Total has to be 6 into 1. Second column into third column is fourth column. So 4X plus 10 minus 10X is equal to 6. Let me know the answer to X. That is the investment in A. 0.67%. Then B will be 0.67% and 33%. Get the answer. Get the answer to X. This is how you will be calculating weights at different places. This concept will get deployed at multiple places. 4X plus 10 minus 10X is equal to 6. Any doubts on this? Can we proceed? So you get, what are the weights you got? 66.67% and 33.33%. Any doubts on the immunization concept? Let's first discuss bond refunding. Now, whatever we have done till now is all from investor point of view. One area which we are going to do it from a company point of view is called bond refunding. Now, what is bond refunding? Or you can call it as bond replacement. It is an exercise where an organization is going to decide whether they can replace their existing bond with a new bond, that is called bond replacement, or whether they can repay the existing bond and not issue any new bond, that is called bond refunding. Bond refunding basically means you don't issue anything new, but in ICI material, bond refunding will be called as basically a situation where I will close the existing bond and issue a new bond. Why are we doing this? Simple reason. I issued bonds in year 2023 or 22 when interest rates were on the higher side, let's assume. So I issued bonds at 12% rate of interest. Today, the interest rates in the economy has gone down. When interest rates go down in the economy, I can now issue it at 7%, maybe 9% or 10% possible. I am not able to go back to my existing bondholders and tell them that give me at lower rate of interest. They will not agree to this. They will say only one thing. You told 12%, we want 12%. Now you don't give us this information saying that you can reduce it, increase it. We don't agree to all this. You earlier told us 12%. We will work with only 12%. So how to decide on bond refunding is the expectation or objective. Here what we are going to do is we are going to repay the bond today. When you are repaying the bond today, there will be some inflows for us, some outflows from for the company. What is outflow? How to pay the old bondholders. But what will be the inflow is from the new bondholders, I'll be getting money. Net still there will be some outflow for the company. But what is the benefit of this? The benefit of this is every year I'll be saving after tax interest cost. After tax interest cost. So I'll have to calculate something called as after tax interest cost saving of every year. And last year, terminal flow, you learn these three terms when I go to capital budgeting. There is an initial outflow, in between flow, and a terminal flow. Last year, what will happen is old bond I was to pay so much, new bond I have to pay so much, the gap, if at all anything is there. So this is what will happen mostly on old bond and on new bond. In the old bond, you have to pay to the bond holders. You have to pay some money to the bond holders. They will be saying that you pay us 3 crore, 10 crore, 5 crore, whatever number. There can be call premium. What is call premium is if I am recalling the bond before its due date, before its due date, in case it is doing a before due date, it is happening, sometimes I have to pay extra to the bondholders. So I pay 3 crore, extra maybe 50 lakh. This extra whatever you pay, you can claim tax benefit on this. Old bond does not exist anymore. If the old bond does not exist anymore, you can claim tax benefit on every item relating to old bond. Write off all items relating to old bond. What is write off all items relating to old bond? When I issued the old bond, there was a flotation cost on the old bond. There was a discount on issue of debenture. All these items, as per accounting, I'm not very sure on the taxation side, I will be amortizing over the life of the old bond. Old bond does not exist. You write off this amount. You will get more clarity only when I do a problem around it. Let me first discuss little bit and then I do a problem. Otherwise, things may not get clearer. Sometimes there will be overlapping interest. Basic expectation is new bond comes on April 1. Old bond gets redeemed on April 1. New bond comes on April 1. Old bond has to be redeemed on April 1. Practical world, new bond came on April 1. Redemption took another month's time because money comes in, bank account, reconciliation, all this, that and all. Took some time for me to redeem the old bond. In that scenario, you may pay something called as overlapping interest. What is overlapping interest? Is paying interest on old bond as well as new bond. Paying interest on old bond as well as new bond. In an ideal situation, April 1 new bond came in, April 1 old bond should be redeemed. All these you have to pay relating to the old bond. Then something will be for the new bond. Step 2 and step 3 we have to assume as if the bond is continuing. I'll explain this when I do a problem. You will not get clarity as of now. This is what got tested in the recent exam. In the September 25 exam, they tested this concept. A question on bond refunding came. They did not give discount rate in the question. They did not give discount rate in the question. We have to calculate NPV. NPV means you need a discount rate. If discount rate is not given after tax cost of if not given after tax cost of new debt, yeah, after tax cost of new debt. New debt means the new borrowing, whatever is the after tax cost. This got tested in the recent September 25 exam. There was a question on bond refunding and the concept which was tested is this: after tax cost of new debt. In case the discount rate is not given, we have to calculate NPV. I'll discuss all these concepts again after doing a problem, because otherwise I can keep talking so much also, you will not get grip on this. Let's see a question and then we come back here. Let's come to question 66, 34 of the priority material. ABC Limited is contemplating calling 3 crores 30-year 1000 bond issued 5 years ago with a coupon interest rate of 14%. Bond has a call price of 1140. Initially collected 2.91 CR. due to discount of 30 per bond. Initial floating cost was 360. Company intends to sell 3 crore of 12% coupon rate 25-year bond to raise funds for retiring the old bond. It proposes to sell the new bonds at their par value, flotation cost, 40% tax, and its after tax cost of debt is 8%. After tax cost of debt is 8%. As the new bond must first be sold and their proceeds then used to retire old bond, company expects a 2-month period of overlapping interest. 2-month period of overlapping interest, on which interest is to be paid on old as well as new bond. What is the feasibility of refunding bond? Calculation shall be in lakh, rounded off to 3 decimal. Please go through this. Go through this and then we start doing it. What is the interest rate we are paying on the existing bond? A new bond will come at, and this is the only reason we are issuing a new bond. You can save on interest. You can save on interest. But in order to save this money on interest, I have to pay a lot of money extra today, which is what concept called as your, a lot of items are there like overlapping interest, some call premium. All this you'll have to analyze and understand whether refunding is beneficial or not. Calculation in lakhs and 3 decimal is what the question has said. Let's start. Working note 1, initial outflow. Initial outflow. I'll be doing 2 questions. After I do 2 questions, I'll explain the concept again. Things will register. Otherwise, it could be little difficult for, because I'll keep talking this. Clarity could be there for a student who have already understood bond refunding, but for some of you, it could be a challenge. So we will first do a problem and then get back. Problem will be at a normal slow speed only. I'll be doing initial outflow, particulars, calculation amount. Particulars, calculation amount. Cash flow relating to old bond. Underline that. Relating to old bond. ABC Limited is contemplating 3 crores of 30-year 1000 bond issued 5 years ago. 5 years ago we have issued, another 25 years is there. The value is 3 crore. Call price is how much? What is call price 1140 is, if you call in between, you have to pay extra. You have to pay 1000 and extra 140. That extra what you pay, you can claim tax benefit on that, because that will go to P&L. Extra 1000 will be removed from balance sheet, because in balance sheet there will be a debenture. It will be removed from balance sheet. Extra 140 is a P&L expense. You will claim tax benefit. Whether it happens in income tax, not happen, I'm not bothered about it. This is how we solve here. Okay. So first point is payment of par value. Par value 300 lakh minus 300. 3 crores I have to pay. Payment of par value 300. Payment of call premium. Call premium. What is call premium? Extra payment. What is extra payment? 1000 rupees is 300 lakh. 1000 rupees is 300 lakh. Extra 140 rupees is question mark. 1000 rupees is 300 lakh. Extra 140 we are paying. 42 lakh. Or technically 3 crore divided by 1000 into 1140 is the overall payment. Divided by 1000 into 1140. Moment I pay this, tax benefit on write-off. Tax benefit on write-off of call premium. What is the tax rate given in the question? 40%. Inflow. This is an inflow. Whatever extra I paid, I go to income tax guys, tell them give me tax benefit. They are saying yes, we will give you tax benefit on this. Okay. Now, when I issued this bond, it had a flotation cost of how much? 3 lakh 60. Originally, I was thinking 30 years. In that, 5 years got over. 25 years is still pending. So, in my P&L or in my balance sheet, in the asset side, there will be a fictitious item called as flotation cost not yet written off. Flotation cost not yet written off. Now, listen for a minute and then write tax benefit on write off of flotation cost. 30 years, 3 lakh 60. 25 years is still pending. This amount I will write off now and get 40% tax benefit. Get 40% tax benefit. 30 years is 360. 25 years is question mark. Tell me the value. 3 lakh. This 3 lakh will not come to me. What will come is tax benefit on 3 lakh. What is the tax rate? 40%. 1.2. I'll explain again. I had a 3 lakh 60 flotation cost. 30 years was the write off period. I was doing it over a period of 30 years. Every year I was doing it. 5 years over. Another 25 years is there, which means in my balance sheet, in the asset side, there's an item called flotation cost not yet written of 3 lakh rupees. Any doubts on this? Can we proceed? Like we had flotation cost, there was also one more item. Initially collected how much? 2.91 crore. I collected only 2.91 crore. So in my balance sheet, 3 crore is my liability, but I collected only 2.91. That balance 9 lakh is discount on issue of debenture, which I'll be writing off every year. Like flotation cost is written off every year, discount on issue of debenture. For analysis purpose, both are same only. I could have clubbed them together also. I could have clubbed flotation cost and discount together to do my analysis. So next is tax benefit on write off of discount. Write off of discount 30 years 9 lakh. What is 9 lakh? 3 crore minus 2.91. Once you are done with the question, I'll be explaining the concept again. I can do now also, but some grip will come better when you're done once writing. How many years is balance? Question mark. Tell me what is the question. 7 lakh 50,000. Write off now. 7 lakh 50 into 40%. Benefit is plus, okay. Whatever is outflow, I've written outflow. Almost old bond is analyzed. One more thing I have to pay on old bond. One more thing we have to pay on the old bond, which says as the new bonds must first be sold and their proceeds be used to retire old bonds. New bonds must first be sold and their proceeds are used to retire old bonds. There is an overlapping interest to be paid for a period of 2 months. Ideal expectation, old bond should have been a full stop at this stage. That's all. With this, old bond should not exist. Unfortunately, I am forced to pay extra 2 months interest on old bond. Extra 2 months interest on old bond. Overlapping interest. I'll pay, get tax benefit immediately. Get tax benefit immediately. Ideal situation, this should not have come. What is overlapping interest? Paying interest on both old bond as well as new bond. Next, overlapping interest. Overlapping interest 2 months. What is the face value of the old bond? 300 lakh. 300 lakh. Rate of interest 14%. 14% into by 12. This is unfortunate outflow for me. This is an unfortunate outflow for me. Ideally, this should not have happened. Overlapping interest is extra payment which ideally should not have been done. Any doubts on this? Able to understand this? But good part is tax benefit on this. Tax benefit on overlapping interest. Tax benefit on overlapping interest. 7 lakh into 40%. 2.80. Any doubts on any of these items? All this I'm paying on the old bond. I have to pay first par value. I have to pay call premium, get tax benefit on that. I was looking at the balance sheet. In the balance sheet, in the asset side, there was a miscellaneous expenditure where flotation cost was there, write it off. Discount was there, write it off. Overlapping interest paid, write it off. Any doubts in this? Next, cash flow relating to new bond. Relating to new bond. Relating to new bond. Relating to new bond. From the new bond, I'll be getting money. Cash inflow. How much is the new bondholders paying? How much are we issuing? Any issue price, anything they have given? Company intends to sell 3 crores at 12% coupon 25 years. Why 25 years? Balance 25 years. To raise funds to retire the old bond. Exactly same 3 crores I will raise. But there's one headache. I have to incur what? This flotation cost. I cannot get any tax benefit now. I'll get tax benefit over the next 25 years. Why old bond we got now? Because old bond is over. It is over now. Now we are now moving to the new bond. In new bond, cash inflow 300 plus payment of flotation cost. Payment of flotation cost minus 4. Payment of flotation cost minus 4. Payment of flotation cost minus 4. Please put a total and tell me net outflow. Net outflow. All the total. Negative 300, negative 42, plus 16.8. Live online guys, you can type plus 1.2, 3, minus 7, 2.8, 300, minus 4, minus 29.2, minus 29.2. Anybody has any doubts on this? Most important calculation. Anybody has any doubts on this? I am paying extra 29 lakh rupees today. Why am I paying this? To see if in case whether I benefit every year or not. Okay, there is a doubt which has come from a student. Shouldn't the overlapping interest be on new bonds? No. Overlapping interest is on a bond which should have been discontinued. What is bond refunding? Issue new and close the old bond immediately. New bond, you are not paying overlapping interest. New bond, you will be paying 25-year interest, not 2 months interest. New bond, you will pay interest for a period of 25 years. It is that extra old bond interest is called overlapping. Extra old bond interest, we did into 14%. That's the doubt from a student. What is overlapping interest? Is extra interest paid on old bond. Ideal scenario, old bond should have become zero on April 1 or on the beginning itself. Any doubts on this? Can we proceed with the calculation? Done. I'm going extremely slow. It's a little bit tricky area for few students. Any doubts on this? Can we proceed? Working note 2. In between flow. In between flow in bracket, saving in cost. Saving in cost. Particulars, old bond, new bond. Old bond and new bond. Now, one thing you need to be very clear is you'll have to keep this in your mind. You'll have to visualize as if the old bond is continuing. Then only you'll get the right answer. You cannot visualize this saying that old bond is closed. I can't help it. Old bond is continuing, what will happen? New bond happens, what will happen? The difference is called saving in cost. What is the saving is new bond minus the old bond. New bond you are going to pay 2 lakh rupees. Old bond you are paying 3 lakh rupees. Saving is 1 lakh rupee every year. You have to visualize as if old bond is continuing, visualize as if new bond has happened. Interest cost. Old bond, what is the interest rate? 300 into 14%. 300 into 14%. 42. Visualize as if old bond is continuing. New bond, what is the interest rate? This is a straight away 6 lakh saving, but there is another headache, tax angle, because this is not my total saving. On 42, I'll get more tax benefit. On 36, I'll get lower tax benefit. So first outflow is 42 as interest cost and 36 as interest cost. Effectively 6 lakh rupees we are saving. Effectively, this was the point, was very simple. Pay extra today and save every year some money. Is it a viable option or not? Less tax. On this interest, tax is 40%. This will give me after tax interest cost. Wait, that alone is not there. There are other items also. This will give us after tax interest cost. Any doubts on this? Able to understand this? Any doubts till this? Can we proceed? Apart from this, if I was continuing with the old bond, I would have written off two items. What are the two items I would have written off? Discount, flotation cost every year. Discount and flotation cost every year. Taken some tax benefit every year. Old bond as if continuing. New bond as if continuing. Less tax on write off of flotation cost. Tax on write off of flotation cost. What was the flotation cost of old bond? 3.6 divided by 30 years. Every year this is the write off. 3.6 by 30 years. Why 30 years? Old bond was for a 30-year period. Again repeating, old bond as if continuing, new bond as if it's getting issued. If you get confused with this, do two separate table. Old bond one table complete fully, new bond one table complete fully. Your answer is going to remain same. The answer is going to remain same. 3.6 divided by 30 into 40% tax benefit. 0.048. Every year I was getting some tax benefit. In the second working note alone, outflows are written positive, inflows are written negative. This alone you have to adjust. Because I want to know what is the net outflow. I'm calculating net outflow. For calculating net outflow, outflow is positive, inflow is negative. This alone you will have to adjust. If you are still getting confused, then you will have to change sign for everything. That is also okay. Minus 42, all these are plus. Your interest cost will be minus 42. All these items will be plus. Net answer will remain same. If you are comfortable this way, it is preferable. How much is the flotation cost on new bond? How many years is the life? Into 40%. 0.064. Now, what is the objective is, we are seeing how much old bond we were paying every year, how much new bond we are going to pay every year. Extra, are we saving money or paying extra? Mostly there will be saving. Less tax on write off of discount. There was a discount which was there. Complete the table and then I'll explain again. How much was the discount figure? 9 divided by 30 into 40%. 0.12. Please tell me the net amount, net cost. Once this is done, I'll explain again. Get me the net cost. 25 point. Other one. And this is the game I'm trying to play. I was earlier paying old bond 25 lakh 3,200. New bond I'm paying 21 lakh 50 25 lakh 3,200 and 21 lakh 53,600. There is obviously a saving which is happening in the new bond. Every year we are saving for how many years? 25 years. For 25 years we are saving money. This saving, is it sufficient or not, is what we are trying to check here. Any doubts on the calculation here? Any doubts on this? Can we proceed? I'll again explain. I paid interest, self-explanatory. Tax on interest, self-explanatory. Flotation cost of new bond, self-explanatory. Old bond, visualize as if you are continuing. Visualize as if you are continuing. Saving every year. Tell me the difference. Key point. Now, is 3.496 for 25 years a good saving or not, is what NPV will tell. How much we paid extra? We paid 29.2 to save what? 3.496 for how many years? 25 more years. Doesn't end here. Working note 3. Terminal flow. Most of the question this will be 0 only. Terminal flow. Old bond, new bond. Terminal flow. Old bond, new bond. Payment to a redemption value. Redemption value. What is redemption value? Is what you would have paid if old bond had continued. Call premium is different. Okay, call price is basically in between. If I had continued for another 25 years, I would have paid 300 here. Here also I pay same 300. So net no difference. 300 and 300, difference is 0. Difference is 0. So what we have done in a bond refunding is paid extra 29.2 and saved 3.496 for 25 years. Is it good saving, bad saving? NPV will tell. For NPV, I need a discount rate. The recent exam, they did not give the discount rate. That is what they ended up doing. If discount rate is not given in the question, what is the interest rate of the new bond? If it's not given, 12 into 1 minus tax rate. This will be the discount rate. In case it is not given, after tax cost of new debt. After tax cost of new debt. What is after tax cost of new debt? 12 into 1 minus tax rate. In this question it is given. They have told after tax cost of debt is how much? 8%. Now write year, cash flow, PVF at 8%, DCF. Year 0, 1 to 25 and year 25. Year 0, 1 to 25 and year 25. Year 0, how much extra we paid? Minus 29.2. Minus 29.2. 1 to 25, how much we have saved? Year 25, nothing is there. No extra payment, no saving. Last year, nothing will come most of the time, okay? I am not getting into the NPV calculation. 25 years, annuity factor 1 divided by 1.08, 25 times you have to do, which will take time. Okay, let's quickly see the answer. 8.12, company should go ahead with the bond refunding. Company should go ahead with the bond refunding. 29.2, 3.496, NPV positive. NPV positive. Company should go ahead with bond refunding. Okay, comes the next concept. Forward rates. Now, what is this forward rates? Sometime back today, when I started, I had said that first year interest rate is 10%. Second year interest rate is 11. Third year interest rate is 12%. We did a problem and then I said there are two types of rates. One is called forward rates and second is called spot yield curve. Spot yield curve. Question may give you some information and tell you to calculate future interest rates. Tell you to calculate future interest rate. Your job is to predict what will be the interest rate in future. How is that prediction done? Is this concept. I am going to predict interest rates of India by using some information. That prediction is called forward rates. There will be two types of question. One where cash flow of bonds are given. Second, where interest rates are given. Interest rates is the easier, both are easy only, but less time consuming is interest rate. Let's first me discuss the interest rate part. What is interest rate part is, I went to the bank. Bank told me 0 to 1, 10% interest. 0 to 2, 11% interest. 0 to 3, 12% interest. I want to know what is the interest rate for 0 to 1, 1 to 2, 2 to 3. I want to know 0 to 1, 1 to 2, 2 to 3. What bank gave me? 0 to 1, 0 to 2, 0 to 3. My objective is to calculate what is 0 to 1, 1 to 2, 2 to 3. When I did initially those two examples I was explaining, I said interest rates can be given as spot yield curve. Interest rates can be given as forward rate of interest. Forward rate of interest is predicting 0 to 2, anybody can tell today. But what will be 1 to 2? That is in 2026, what will be the interest rate? 2027, what will be the interest rate? Anybody can tell from today till 2027, this is the interest rate. If you create an FD, it is over, that's all. But I am trying to predict what is the future interest rate. Predict what is the future interest rate. This and this is same. 0 to 1, 0 to 1 is same. 0 to 2 is 11%. In a calculator, do 100 plus 11% 2 times. 123 point. Do 12% 3 times. 12% 3 times. 4, 9. Let me explain again. I invested 100 today. In 1 year, it will become 110. If I do 11%, 2 years directly, 100 plus 11% plus 11%, 123. 3 years if you do 100 plus 12%, 12%, 12%. You came to me. I told as a banker, for your good thing, saying that please invest for 3 years. You will get 140 rupees. But you are adamant saying that no, I don't believe in you and all. I don't want to do this. So what you did? You did 0 to 1. You got 110 rupees at the end of first year. What is forward rate is the rate at which this 110 can become 123 in second year. 110 can become 123. See, I can create a 2-year FD. If you create a 2-year FD, what will happen? 11% first year, 11% second year. What is the other option? Get 10% for first year and maybe 12% for second year. On an average, you get your 11% again. On an average, you get your 11% again. I'll explain again. I went to the bank, created fixed deposit. 100 rupees I gave bank. Bank made it as 110. Bank made it as 123. Bank made it as 140. I'll give the formula in some time. Understand the logic. Can you tell me what rate will make 110, 123 in 1 year? From first year till second year. 123 minus 110 divided by 110. 12 point. What rate can make 123, 140? .14. Now you have two choices. First choice is you want to invest for 3 years. Invest at 12%. Easiest choice. Other choices, invest for 10%. Expecting it will be 12.01% at the end of year 1. Expecting that it will be 14.02% at the end of year 2. Both will give same answer. This is prediction. Whether it happens, not happens, that's a different story. But prediction says that 10, 11, 12 is 10, 12.01 and 14.02 from a forward rate point of view. This is technically called as FR, forward rate, first to second year, is equal to future value factor for longer period, 2 years, divided by future value factor for 1 year minus 1. Future value factor for second year divided by future value factor for 1 year minus 1. I'll explain again. I went to the bank, asked them 2-year interest rate. Bank is giving me 3-year interest rate. Bank is giving me 4-year interest rate. Bank is giving me. I asked them, give me 1 to 2. He said, what are you asking? Who will tell you future interest rate? Then I said, okay, you give me first year, you give me second year. I will do prediction. I will do prediction. How will I do prediction? 2-year bank told me 11%. So concept is very simple. 1 plus 11% power 2. 1 plus 11% power 2 divided by 1 plus 10% power 1. 1 to 2 power 2 power 1. 2 to 3 power 3 power 2. 3 to 4 power 4 power 3. 3 to 10 power 10 power 3. 3 to 20 power 20 power 3. It can be anything. It can be anything. So future value factor for 2 years divided by future value factor for 1 year. This will give me the rate. Can you get me the answer here? $12 clear. Now I'll come to the formula logic. Okay, this is the formula. Interest rates are given. Forward rate of year 1 is spot rate of year 1. What is forward rate of year 1? 0 to 1. Whether you call it a spot rate or you call it as forward rate, same. 1 to 2 you want future value factor for 2 years divided by future value factor for 1 year. 2 to 3 you want future value factor for 3 years divided by future value factor for 2 years. 10 to 11 I want future value factor for 11 years divided by future value factor for 10 years. 99 to 100 I want future value factor for 100 years divided by future value factor for 99 years. 10 to 20 I want future value factor for 20 years divided by future value factor for 10 years. This is what the calculation is. Any doubts on the concept? If they give interest rate, future value factor for the longer period divided by the future value factor for the shorter period minus 1. Future value factor for the longer period, future value factor for the shorter period minus 1. Any doubts on this? Any doubts on this? Which interest rate? Spot yield curve interest rate. If they give forward rates, then what will I calculate? They have already given forward rate. That is the forward rate. That's all. From forward, I can do spot yield curve. From spot yield curve, I can go to forward. Anything can be done. Clear? Any doubts till this? Any doubts in this? In case, instead of giving interest rate, if they give cash flow in the question, if they give cash flow in the question, I have no problem. You give me cash flow, I will have 1 year bond. In the 1 year bond, when you do calculation, PVF of year 1 will be balancing figure. When you do the calculation, you will understand. PVF of year 1 will be balancing figure. What is PVF of year 1? PVF of year 1 is equal to 1 divided by 1 plus first year interest rate. 1 divided by 1 plus first year interest rate. When you analyze a second year bond, PVF of year 2 will be balancing figure. What is PVF of year 2? If you remember, PVF of year 1 divided by 1 plus the second year interest rate. PVF of year 3 will be balancing figure. What is PVF of year 3? PVF of year 3 is PVF of year 2 divided by 1 plus the third year interest rate. This is what you learned. PVF of year 2 is equal to PVF of year 1 divided by forward rate of, when I say forward rate, it is 1 plus forward rate. Okay, 1 plus forward rate. PVF of year 3 is equal to PVF of year 2 divided by 1 plus forward rate. 1 plus forward rate. Clear? Able to understand this? This I should have ideally done when I did that concept in the morning. Morning first concept we did this only. There was something called as forward rate and something called as spot yield curve. Able to understand this? I'll repeat again. If cash flows are given, write year, cash flow, PVF, DCF. In the process when you do, PVF of year 1 will be balancing figure. PVF of year 1 is equal to 1 divided by 1 plus interest rate of year 1. When you do 2-year bond, PVF of year 2 will be balancing figure. PVF of year 2 is equal to PVF of year 1 divided by 1 plus interest rate of year 2. Where did we learn? We learned this today morning only when I started that forward rate concept and spot yield curve concept. You want to make it more simpler? I give you interest rates. I give you interest rate. For example, 6-year interest rate is 7%. 5-year interest rate is 6%. Implied 1 year forward rate 5 years from now. From after 5 years, what is the interest rate? Year 5 to year 6. Future value factor for 6 years divided by future value factor for 5 years minus 1. Future value factor for 6 years divided by future value factor for 5 years minus 1. Able to understand this? Any doubts on this? Any doubts on this? Okay, two, three concepts are there. One is called nature of yield curve. What is nature of yield curve is, if I get future interest rates given in a question, in the problem which I told you to write, 1 year 3%, 2 year 4%, 5 year 3%, some numbers were there. Normal yield curve means interest rates will go up for a longer period and interest rates will be lesser for a short term period. What is normal yield curve is, long term interest is greater than short term interest. That question which I did, in that question they will ask what is the yield curve. You can do this at home, that MCQ question you can do. So what is yield curve is, if long term interest rates are higher, that is called normal yield curve. Why long term interest should be higher? I give you loan for 1 year period. I know that in 1 year you will return it. I'm not worried much about it because I can track what is going to happen with you in 1 year. I give you loan for 10 years. I know in 10 years a lot of changes can happen. You may become successful, you may become a failure. I don't know. After 10 years, what will happen? I don't know. Recovery of money can also be little doubtful after 10 years. After 10 years. So for longer period, higher interest rate. For shorter period, lower interest rate. The problem, that example which I gave, long term interest rates were going up, short term interest rates were on the lower side. That is called normal yield curve. That is called normal yield curve or upward sloping yield curve. Opposite happens. What is opposite? Short term 20%, long term 11%, 10%, 9%. That is called inverted yield curve. That is called inverted yield curve. Ideal situation, normal yield curve. Opposite is inverted yield curve, where long term interest rates are lower and short term interest rates are on the higher side. People are not ready to give a long term loan and all. They are saying we'll give it to you at short term only, and that short term also at what? Very high interest rate. An inverted yield curve is an indication of an upcoming recession. If a recession is going to come in an economy, that can have an inverted yield curve. It can have an inverted yield curve. India as of now has a normal yield curve. You go to any bank, ask for FD rates. 1 year 7%, 2 year maybe little more, 3 year maybe little more, 4 years maybe little more, 5 years are normally they'll give same rate and all. After that, if you ask, they may almost give the same rate. Sometimes they may reduce it also. Normally, it will be a normal yield curve. What is normal yield curve? Interest rates will keep going up for longer period and go down for shorter period. That is called normal yield curve or upward sloping. Opposite is called inverted yield curve or downward sloping, an indication of upcoming recession. Flat yield curve means both the interest are same. Both the interest rates are same. Long term same, short term same. The example which I gave you, 1 year you noted down the numbers, the interest rate kept on going up. That is called normal yield curve. That is called normal yield curve or an upward sloping yield curve. Any doubts on this? Clear? That question, that MCQ asked these also. What is the type of the yield curve? Any doubts on this? Can we proceed? Next comes a concept called bond convexity. I will explain it. You are not going to write anything because it is a longer time consuming calculation, tested 2-3 times in exam. I want to close it in exact 15 minutes. I don't want to spend more than that. To do that, I will be doing all the calculation. You understand the concepts. Now, let me go back to a question. Now there was a bond. This is the cash flow of the bond. Year, cash flow, PVF, DCF. 17% is the bond. Everything is same. Duration is calculated by us. The duration in this case was, I don't want you to write even a small word. Be listen, understand it fully. The chart, everything will explain it very simple, but understand it fully, very clearly. Writing will take time. I can directly tell you that this is how it is done, but I want to explain the full concept. Duration was 2.6005. Convexity. convexity is this 1.17, sorry, volatility, sorry, volatility 1.17, 2.2226. We had done this question some time back. So these were the numbers. Now company said interest rate will go up by 1% and you have to calculate the new price. What will you do? One option is repeat this. How will you repeat this? You will repeat this table at 18%. This is one option to calculate the new price. Interest rate has gone up. What did I do? I did 18%. PVF at 18. I got answer is 956.84. Best approach is this. Best approach is this. This is called intrinsic value method. So right answer, price at 18%, 956.84. Second option, I wanted to act little smarter and do faster. Price at 18% is equal to 977.6 minus 2.226 percentage. Volatility concept. Volatility concept. Can you give me the answer? Can you give me this answer? 9 point, not a very big deviation, but still there is a deviation. Not a very big deviation. I agree that there is not a big deviation, but there is still a deviation, which is where another concept came called as convexity. Volatility is one part of it. Another concept came called as convexity. What convexity said is price at 18% is equal to 977 minus 2.226 percentage plus something. Convexity is always added only. Convexity is always added only. What is that number and all? I'll explain. Plus some number is equal to a number closer to 956. I want a number closer to, not again still exact. Exact you want? Intrinsic value method. Exact answer you want? Intrinsic value method. I want to at least go little closer to 956.84. In order to calculate convexity, that is why it may not have that much utility. Calculating convexity takes time. If you want to do convexity, base was 17. Increase interest rate by 1%, get an answer. Decrease interest rate by 1% and get another answer. You have to get two answers. Increase it by 1%, decrease it by 1%. Some question will say increase it by 2%, decrease it by 2%. That will be given in the question. I'll show it to you in some time. PVF at 16%. PVF at 16%. 1 divided by 1.16. 16%. I got two answers. One is 956, another is 1000. Now, what is convexity saying is, because you are doing duration, what duration assumes is that uniform change. What is uniform change? Is linear change. Linear means 1% goes up, 2% fall, 2% goes up, 4% fall, 3% goes up, 6% fall, which is not very logical because bond will not exactly move linearly. There will be some deviation. That convexity is trying to bridge a little bit. It is not fully bridged also. What is convexity is V plus. V plus means what is the value if yield goes up? V minus. V minus. What is the value if yield goes down? Subtract 2V0. 2V0 means today's value. Today's value. One is the value if price goes up. One is the value if price goes down. And 2 times of today's value. 2 times of today's value. Divide this by 2. Divide this by 2. I'll touch upon little bit again. Let me do this first fully. One price is 1000.36. Another price is 956.84. Today the price is 977.6. Divide by 2. Give me this answer. 1000 plus 956 minus 2 times of the base value whole divided by 2. Live online guys, participate please. No, off. Sorry. What are you getting? No, minus 2 into 977. 1000.36 plus 956.84 minus 2 times of 977. 2 times of 977. Exactly 1 I'm getting. Exactly 1 rupee I'm getting. That is the exact answer I'm getting. 1000.36 plus 956 minus 2 times divided by 2. What is this oneness? They are saying whatever answer you got earlier, add 1 rupee to that, your answer will become more accurate. Add 1 rupee to that, your answer will become more accurate. I'll explain again. It will take little bit of time for you to register this. Let me now explain with the chart. Bond convexity, price computed using volatility, does not match with price computed under PV discounting method. Gap between these two prices can be reduced using convexity and make estimation more accurate. Somebody wants to calculate future price. First approach, discount at the new yield to maturity. Best approach is this. Second, old price plus or minus price change due to volatility. Third approach, old price, volatility and convexity. Moment you bring in convexity into picture, answer the gap between the two will get bridged and you will have a lesser gap. Either you go through volatility concept or discounting concept. One answer is doing discounting. Second answer is only with volatility. Third answer is with convexity and volatility. Is there any utility of convexity? I don't see much utility of it, but still, if at all a question asks, you may have to do it. I will again come back to the formula in some time. Let me do it in a question. You are not going to write anything. Be in listen mode. Understand the full calculation. Any doubts till now first? Some of the items will still not be very clear. It will take me some time to explain it. Let's see this question. Following data are available for a bond. Face value 1000 to be redeemed at par on maturity. Years to maturity 5 years. Yield to maturity 10%. You are required to calculate current market price, Macauley's duration, volatility, convexity, expected market price if there is a decrease in YTM by how much? 200 basis points. So we will be taking 200 basis point, not 1%, 2% for the calculation purpose. 2% for the calculation purpose. I'll repeat again. 5-year bond. Today YTM is 10%. Interest is 8.5%. They've asked us to do current market price, self-explanatory. They've asked us to do duration, self-explanatory. They've asked us to do volatility, self-explanatory. Convexity is new thing which I have to explain. Clear? In order to do this, you have to write year, cash flow, PVF, DCF, product. Okay. Then after that is done, you will get current market price, you will get duration, you will get volatility. Then I have to do new price calculation. For new price calculation, there is a decrease in yield by 200 basis point. One approach is doing discounting. Another approach is discounting and volatility. Third approach is discount, that is volatility and convexity. Nothing for you to be written. Just be in listen mode. Today, year, cash flow, PVF at question asset 10%, DCF, product. Year, cash flow, PVF, DCF and product. The life of the bond is 5 years. 5 years cash flows are written. Cash flow given in the question is 8.5%, which is 850. 10,000 rupees into 8.5% on maturity 10,850. Till now, whatever I'm explaining is already known to you. I'm not teaching anything new. Convexity part alone, I'll tell you to write when I'm coming to that part. PVF at 10%, 1 divided by 1.1. DCF, sum of this 9431.50 and product. Clear? Current market price 9431.5. Second requirement is duration 40,103.35 divided by 9431.5. Give me a 4 decimal answer. 2521 years. Volatility 4.2521 divided by 1 plus YTM 10%. 8655. Any doubts on this? Convexity is to be done. For convexity, I have to increase rate, decrease rate. Both I have to do. Question has told us to increase and decrease by 200 basis point. Now write along with me. Year, right. Year, cash flow, PVF at 12%, DCF, PVF at 8%, DCF. 12 and 8. 12 and 8. Year cash flow, PVF at 12%, DCF, PVF at 8% and DCF. Year cash flow, PVF. Now directly I'll write 1 to 5 and year 5. No annuity, no individual numbers. Okay, 1 to 5, 5. 850, 10,000. Tell me the annuity factor, 12%. 12%, tell me the factor. 3.605 and the fifth year factor, multiply. 8734.25. $8734.25. Tell me 8% factors. 99, 3 and 681. Double 394.05 and 6810. I've done 3 decimal. You change the decimal, answers will change. I'm not getting into that discussion itself now. Any doubts on this? Any doubts on this? Till now, I don't see anybody having any confusion. No new teaching. Nothing has been taught new to you. Only thing is you have to calculate one price at a higher rate, one price at a lower rate. Now, new price with YTM decrease by 2%. Expected market price, if there is a decrease in the YTM by 200 basis point. New price with YTM decrease by 2%. 10,204.05. Intrinsic value method. 10,204.05 intrinsic value method. 10,204.05 intrinsic. What is intrinsic? Is doing discounting. Doing discounting. New price under duration method. New price under duration method is equal to old price plus volatility change. 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 Old price is 9431 plus My volatility number is 3.8655. Listen, 3.8655 into 2, 2 times. 3.8655 into 2. This much percentage increase will happen. 9431, 3.8655 into 2. Double change will happen. 3.8655 into 2. What's the answer you said? 9? 9439. No, percentage. In the calculator, do it like this. In the calculator, 3.8655 into 2, which is 7.731% add. In the calculator, add 7.731%. 9431.5 plus 7.731 percentage. 10,000. 10,160.65. I see a gap of around 40 rupees. The right answer is 10,204. Exact. Approximate answer 10,160. Next, new price. New price with duration and convexity. With duration and convexity. With duration and convexity. 9431 plus 3.8655 into 2 percentage plus something else. I'll have to add something else there. Convexity adjustment is always added only. Convexity adjustment is always added. Maybe an area which you can see day before exam. Convexity alone day before exam. Bond refunding and all is not that tricky. It is also not tricky, but thing is it is a little bit technical. Clear? Now right, convexity adjustment is equal to higher price plus lower price minus 2 into base price divided by 2. Higher price, lower price, 2 into base price divided by 2. Higher, lower, 2 into base price divided by 2. This is called convexity adjustment. Higher price, lower price, 2 into base price divided by 2. Higher price is 10,204. Lower price is 8734. One thing is you have to do 2% more, 2% less. It can be 1% also. Answer will little bit vary. Whatever the question says, silent 1% more, 1% less. Minus 2 into 9431.5 base price whole divided by 2. Whole divided by 2. 10,204.05, 8734.25, 2 into 9431.5 whole divided by 2. What's the number you get? 37.65. 37.65. What they say is now add this 37.65 here. Answer will become more accurate. Add this 37.65 here. Answer will become accurate. Answer will become little bit accurate. That's all. We will get very close to 10,204. We'll get very close to 10,204. Earlier 10,160 you got, no? Add another 37.65. What's the answer you get? 10,198. I'll explain this again. To calculate future price, easiest, simplest is do discounting, most accurate. Most accurate. In case question wants us to go through duration logic, then I'll go through duration logic. What is duration logic? Old price plus change due to volatility. Change due to volatility. Along with volatility, I add one more item called convexity. Along with volatility, I add one more item called convexity. How do I add this convexity adjustment? Higher price, lower price minus 2 into base price divided by 2. This is the formula. Then, but this is not convexity. This is the convexity adjustment. Now, right, convexity adjustment percentage. convexity adjustment percentage is equal to convexity adjustment percentage is equal to convexity adjustment divided by today price into 100. Convexity adjustment divided by today price into 100. Divided by today price into 100. Divided by today price into 100. 37.65 divided by 9431.5 into 100. 0.39. Give me a 4 decimal answer. 3992 percentage. Convexity adjustment is whatever adjustment you got in rupees divided by the price. Divided by the price. And finally, now only I'll come to convexity. I'm yet to come to convexity. Convexity is equal to convexity adjustment in rupees. Convexity adjustment in rupees divided by V0. V0 is price today. Price today into delta Y. Delta Y. I will not get into logic of it as of now. It will become too much for you to absorb. In case you still want to know it fully, there is a detailed video available on convexity, I think, in my YouTube channel. If at all you are really interested in knowing more, then you can go through that. What is the convexity adjustment in rupees? What is the base price today? How much was the change in interest rate we did? 0.02, 0.02. 0.02, 0.02. 0.02, 0.02. I can explain this part also, but it will become little too much for you to handle now. 37.65 divided by 9431.5 divided by 0.02 divided by 0.02 9 point, I think this number you will get 9799 9.9799. That is called convexity. That is called convexity. I don't see it to be tested in exam, but still I didn't want to leave anything. That is the reason I've covered it. Okay. Now, if I go back to, it is technically called a second derivative of price equation. Something called as differentiation is done. I don't want to get into that explanation unnecessarily. It will complicate for you. So the calculation is, you have to find V plus. V plus means higher price. V minus lower price. 2V0 divided by 2. Divided by 2 is called convexity adjustment. Further divide by V0 and further divided by delta Y, which is what you have done. Convexity adjustment in rupees divided by V0 delta Y will give me convexity. With the convexity, I will answer if the question is asking what does convexity adjustment. Be very clear. Convexity adjustment, very simple. Higher price, lower price, 2 into base price divided by 2. Percentage you want, divide by V0. Convexity you want, divide further by delta Y. Divide further by delta Y. With this, my bond valuation discussion is over. Okay, let's proceed ahead now. We are done with equity valuation, bond valuation. Now I'll be proceeding to preference shares, warrants, and something called as convertibles. These are miscellaneous area, and the last part will be money market instrument. I was thinking that today it will get over, but one part will get over. Maybe money market instrument alone could be pending for the next session. Next is valuation of preference share. Very rarely tested, but very simple. What is valuation of preference share? Year, cash flow, PVF, DCF. Year cash flow is preference dividend every year, and then discount it at some rate and get the value. This is if it's redeemable. Irredeemable, use the formula of current yield. What is current yield? Current yield is equal to interest by current market price, PD. PD divided by current market price. Current market price goes to the other side. So present value of future cash flow discounted at investor required return. There is one question in one of the problem which I have not done where preferential valuation is asked, and irredeemable is equal to PD by current market price. Current market price goes to the other side. PD by investor expectation, or technically cost of preference. PD divided by KP. 11% preference share of 100 is currently quoted at a yield of 13%. What should be the current market price? If life is not available, it is irredeemable data. Life available, redeemable. What is the formula? Current yield is equal to PD by current market price. Current yield is 13%. PD is 11 by CMP. CMP will be 11 by 13%. What is the answer? 11 by 13%. 84.62. This is one approach which may come very rarely, but it's okay. It's just to know about it. There is one question I think in our material where you will be doing preference share valuation. I've not discussed that question. If you want to practice, you can practice this question. Question 16. Okay, it's not there. There also it's not there. I've removed it. I think I've removed the preference share valuation question. But very simple. Present value of future cash flow discounted at investors' required rate of return, and you will get to the answer. Any doubts in this? Okay. Next part is valuation of warrants. What is warrants is, in a practical world, whenever I want to raise money, one way of raising money is by issuing equity share. Another way of raising money is by giving something called as warrants. What is warrants is, I will issue warrant to a promoter or a strategic investor, a big company, somebody, I'll give a warrant. What will the warrant do? Warrant will say you can convert one warrant into 10 equity share. One warrant into 10 equity share over the next 3 years, 5 years, 10 years, whatever time period they decide. For this, I may have to pay some amount today. Could be 20 rupees, 25 rupees, 30 rupees. I'll pay today. One warrant can be converted into 10 equity share at 50 rupees. I have to pay 50 rupees only. The share price can be even 500, but I'll pay only 50 rupees. I'll pay only 50 rupees. The share price can be 500, 1000, 1500, whatever be the share price. On the contrary, if the share price goes down, I will not exercise the warrant. I will not use the warrant. Warrant is a letter. A letter tells me that you use the letter, you will get 10 shares by paying 500 rupees. If I want, I will use the warrant. If I don't want, I will not use the warrant. If I don't use the warrant, the initial 2025 is waste of money for me. The initial 2025 is waste of money. I have paid that money and it is waste for me. So, how do I value warrant? Option to purchase shares at a predefined price. A company has issued a warrant which can be converted into what? 10 equity share by paying how much? 50 per share. Today the price in the market is 80. Very happy about it now. I will pay 50 and the price in the market is what? 80. I'll use the letter. Get 10 shares. Pay 500 rupees and sell it in the market for 800. Sell it in the market for 800. How 800? 10 into 80, which means the letter is worth 300 rupees. The letter is worth 300 rupees today. One warrant, the fair value of that warrant is 300 rupees. It is similar to RE, right entitlement. It is similar to RE because RE will give you at 15 rupees and you expect 15 will become 20. That gap you are getting compensated by the other person. So concept here is very simple. 50 rupees. 50 rupees is the price at which conversion will happen. Technically, it is a call option. I'll discuss in derivative. I don't want to confuse at this stage. But 50 rupees is where the conversion is going to happen and market price is 80. If market price is 40, the value of the letter is 0. Nobody can force me that use the letter. The value of the letter will become 0. If I want, I can convert. If I don't want, I will not convert it. Clear? Any doubts on this? But I'm paying some price today. I'm taking a future call on the company. Company becomes successful, I'll make huge money. Company becomes failure, my warrant which I paid will get waste. Any doubt in this? Can we proceed? Okay. Now comes another segment which is called convertible instrument. I'll discuss a little bit about first this and then go through each of the term on convertible instrument. We will take an example and then do it. Now, there are two modes of raising money. One is equity, another is debt. All this preference, everything is of no use. Practically, it's either equity or debt. In equity, I can have multiple other things like warrants and other things, but predominantly it is equity or debt. Now, I told you that invest in my company, and I told you I'll give you equity shares today. You say I have doubt on your company performance, I am not happy, I'm not sure whether your company will survive or not survive. If it survives, great, I will make money in the equity, but if it doesn't survive, my value can become zero. Then I said, okay, borrow, give me a loan at least. Then again I'm arguing, saying that if I give a loan, I'll get only fixed return, I will not get, if you become successful, I will not get more money. In equity, successful, my value can go 10 times. In debt, I am successful or failure, mostly debt will get repaid. Let's assume mostly debt will get repaid. So debt has low risk, low return. Equity has high risk and high return. Now suddenly I tell you that you give me something called as convertible debenture. You give me something called as a convertible debenture or a convertible preference share. What is convertible debenture? Pay rupees 120 today. Pay rupees 120 today or one 10% debenture. For one 10% debenture of face value rupees 100. Of face value rupees 100. I'm telling you that please go ahead and pay 120 rupees today. You're asking, why are you asking 120 and all? It's 100 rupee value only. No, I tell, no, it's a convertible debenture. You have to pay 120. If you're interested, let's discuss. You agreed. You paid 120 for this. What will this do? Life, 5 years. Life is 5 years. Over the period of next 5 years, I will be repaying this debenture to you, but there's a conversion option. What is that conversion? Let's understand. Life is 5 years. Investor expectation on similar bond is 10%. Investor expectation only 10%. What is the company paying? 10%. Investor expecting, ideally this should have been issued at 100. Ideally this should have been issued at 100. You want 10%. I am also giving 10%. But what are you paying? 120. Why are you paying and all? We will discuss. Okay. You are paying 120 rupees. You wanted only 10% return. I am giving 10%. Option for you is convert one bond into 5 shares. Convert one bond. Option, okay? It's only an option. Convert one bond into 5 shares in year 5. This is the choice given to you. In year 5, if you want, you can convert it. If you want, you can convert this into 5 shares in which year? In year 5. Okay? Any doubts till this? Current market price of share rupees 16. Today the price is only 16. My plan was not to buy the debenture itself. My plan was to buy only equity share. I am little confident about your company, but still want to play safer. So I looked at the price in the market. If I buy 5 shares today, how much I have to pay? 5 shares, what is the payment I have to do? 680. But I am paying 120. I am paying 120. 5 shares if I want to buy today, price is 5 into 16, 80 rupees. 5 into 16, 80 rupees. But I acted little smart, or whatever it is, I paid 120 rupees. Whether it's foolishness or smartness, we will discuss as we proceed. Clear? 5 into 16, I made the payment of what? 120 rupees. Dividend from equity share. Rupees 1 per share. 1 rupee per share is the dividend which the not even 1 rupee. Just give me a minute. 0.2 rupee per share. Okay, these are the information. Now I'll be explaining various terms which are related to convertible instrument. 1 and 3 exams, a question will come. 3 or 4 exam. Very simple terms. This is the story. Any doubts still on the story? First thing is conversion value. This is the first thing we calculate. What is conversion value? Is today you convert, your conversion is not going to happen, but today you convert your bond into 5 shares. Today you convert your bond into 5 shares. If you convert today, the value is 5 shares into 1680. This is called conversion value. First term is conversion value. You convert one bond into 5 shares today itself. Will it happen? I'm not debating on all that. Okay, one conversion value means conversion is done today. So the first term is conversion value. Other name for this is stock value. Conversion value, value received if bond is converted today. Current market price of share into the conversion ratio. Quick answer to the MCQ which is there. This will have different numbers. Just give me a minute. Why it is not getting? Okay, answer is there, but I don't want you to look at the answer. I can't help it. The values are given here. You read the question and then give me the answer. You just read the question and then give me the answer. Unfortunate answer is that I can't help it now, but okay. 5 shares into 15 rupees, 75 rupees. Any doubts in this? This is the first term. The question may ask conversion value. Other name for this is stock value. I'll explain with my example after I am done. We will do 2-3 questions where I'll not explain anything. Okay. So if you have doubt, you'll have to tell me. Clear? So my example, I do the study material, that is the MCQ example you are doing. By that you should get clarity. Second is conversion premium. How much did you pay for the debenture today? 120. What is the conversion value? 80. You are unnecessarily paying extra. You are unnecessarily paying extra. That extra is called conversion premium. That extra is called conversion premium. So what is conversion premium is current market price of bond minus conversion value. My request to you is don't remember the formula, understand logic only. If you try to remember formula, it will be very difficult to remember things. So 120 is what you are paying. You should have ideally paid only 80 rupees. 40 per bond is extra. 40 rupees extra you are paying per bond. Why are we paying this 40 extra? Maybe in few days 16 becomes 18, 18 becomes 20, 20 becomes 25, 25 becomes 30. At some stage the gap can become 0 or negative also. The gap can become 0 or negative also, and that is the reason we are paying that extra amount. OR. If you divide this by 5, what is 5? Conversion ratio. If you divide this by 5, you will get per share extra. Per bond extra is 40 rupees. Per share extra is 40 by 5. 8 per equity share. 8 per equity share. We are paying extra how much? 8 rupees per equity share. Any doubts in this? Any doubts in this? 40 per debenture, 8 rupees per equity share. Conversion premium percentage. What is percentages? 40 on 120. What is 120? Current market price. Can you tell me 40 on 120 is how much? Of current market price. Extra 33% on current market price. ICI doesn't write this answer. Other one is 40 on 80. What is 80? Is conversion value. 40 on 80. Tell me the percentage. So I am paying extra 40 rupees per debenture, extra 8 rupees per equity share, extra 33% of current market price, or extra 50% of conversion value. Extra 50% of conversion value. Any doubts on any of the number? Answer can be any of the 4. Answer, if clarity is not there, I'll end up writing all the 4 in exam. Okay. So conversion value, extra payment made. Current market price in excess of conversion value. Per bond, CMP minus conversion value. Per share, per bond by the conversion ratio. Percentage divided by conversion value, which is what ICI normally does, can be divided by CMP also. Whenever you calculate that percentage, write OF, CV, OF, current market price. Give me the answer to the below one. Conversion premium per share. Below example, conversion premium per share. I've got the answer in live online. Per share. Conversion premium per share. 100 rupees we are paying. Conversion value already you have calculated how much? 75. So extra is how much? 25. Extra is 25 per bond. What is the conversion ratio? 5. So 25 divided by 5 is 5 rupees extra. Any doubts in this? Any doubts in this? Done. I'll move to the next concept. Next concept is straight value, intrinsic value, real value. I think different names can be there. What is this? Present value of future cash flow without the conversion option. Ignore this conversion. What will you do? Year cash flow PVF DCF. Year cash flow PVF DCF. Year I will write it here, but the answer I already know. Answer is 100 itself. The real value was that. Year cash flow PVF DCF. The bond will pay 5 years. It will be paying 10 and 110 in the end. 10 and 110 in the end. PVF at 10%, 1 divided by 1.1, DCF, we get 100 rupees is the answer. This is called straight value, intrinsic value, real value, whatever name you want to give. Whatever name you want to give, that is called the next. So first term they may ask is conversion value. Second term they may ask is conversion premium. Third term they may ask us straight value, intrinsic value, floor value, minimum price, present value of future cash flow without conversion option, discounted at investor required rate of return. Is this something new for us? No, we have been doing this multiple times. Can you tell me bond straight value here? Do the calculation. It will take you some 2-3 minutes. This example, right? Bond straight value, year cash flow PVF DCF. Write in your notebook, year cash flow PVF DCF. The simplest of the lot is this in this chapter. Very simple approach. Year cash flow PVF DCF. How many years is the life? 4 years. What is the interest the bond is going to pay? So 8 rupees. At the end of year 4, 100. What is the discount rate? Rate of interest on similar bond. Similar bond is 9.5%. Similar bond is 9.5%. You will do the discounting, get the answer. I don't want to really discuss. What is the answer you got? 95.26. Any doubts on this? Any doubts on 95.26? Can we proceed? Clear? So coming back to my example, real value 100 rupees, conversion value 80 rupees, and I am paying 120 rupees. I am paying 120 rupees. 120 minus 80 was called conversion premium. Any doubts till this? Okay, next element. Why did I pay 120 when the real value is only 100? My logic was somewhere share price will go up and I will benefit. In case if the share price does not do well, option of conversion is eliminated. Nobody will do conversion. If share price from 16 goes down to 10, 5, 3, 12, I won't go for conversion itself. Practically, has this happened? Yes, it has happened with many investors. They will not do conversion itself. Why? Because share price is not performing. So in case company does not perform well, 120 will crash down to its real value, which is 100. 120 will crash down to its real value. What is real value? 100. It will not crash down to 80. 80 is conversion value. 120 will crash down to 100. This is called downside risk. The downside risk is 120 can go down to its straight value. 120 can go down to its straight value or the real value. 120 can go down to the straight value or the real value. Any doubts in this? Today it is 120 rupees. Why did you pay 120? You paid 120. Another friend of yours did not do convertible debenture. He paid only 100. He would have paid only 100. Why 100? Real worth is only 100. So downside risk. Downside risk means current market price of bond minus real value of bond. What is real value? Straight value. Real value of bond. How much we are paying? 120. Real value 100. 20 OR. 20 divided by 100. 20 divided by 100, which is 20% of intrinsic value. 20% of intrinsic value. OR. 20 divided by 120. You can divide by 100. You can divide by 120. You can divide by 100. You can divide by 120 and give a percentage. If you divide by 120, it is 16.67 percentage of current market price of bond, or 20% of straight value, or rupees 20. This is the downside risk I face. The downside risk is potential fall. Why will this fall happen? Share price is not performing well. The value of the bond will go down to its real value. The value of the bond will go down to its real value. Any doubts in this? I'm going very slow in the initial explanation. This is not a very tricky area and all, but too many terms are there. So I want to be very clear on all the terms. Any doubts in this? So downside risk, potential fall in bond value if conversion does not happen. Current market price in excess of the straight value. Per bond, current market price 120 minus 100. Downside risk in rupees, divide by 100. Downside risk in rupees, divide by 120. You can divide by straight value. What is straight value? Is the intrinsic value. This can also be called as premium over straight value. It can also be called as premium over straight value. In that other example, 100 minus whatever, I don't know, some error is there or something. You see the MCQ later at home. There is some error here, but the concept is very simple. What is the concept? The downside risk is current market price of bond minus real value of bond. What is conversion premium? Current market price of bond minus conversion value. Any doubts till this? Clear? Conversion premium in rupees, percentage by dividing with two numbers. This also in rupees divided with either 120 or 100. Any doubts till this? Any doubts on this? Can we proceed? Any doubts on this? Okay, I did all this. Then suddenly I asked, no, I'm not liking this bond and all. You have told me to invest. I've invested. Now, can you tell me what should be the share price today so that this 120 is not extra? It is not looking like extra for me. I have paid how much? 120. What is the share price today? 16. I paid 120. You paid 16 into 5. You are very happy about it. I paid 120. You are paying now 18 into 5. Again, you are happy. I paid 120. You are paying 20 into 5. Price is going up. If it becomes 24, we both are equal. If it becomes 24, we both are equal. That is called conversion parity price. What is conversion parity prices? Whatever is the price of the bond, divide by 5. What is 5? Conversion ratio. Divide by 5. If share price becomes 24 today, you are also paying same amount. I am also paying same amount. You are also paying same amount. I am also paying same amount. If it touches 24 and somebody tells we have to do conversion, I'll be happy about it because I get my 120 rupees. I get my 120 rupees. What is conversion parity price? The price at which if conversion happens, no profit, no loss. If conversion happens, no profit, no loss. In my example, 120 divided by 5. 120 divided by 5. So conversion parity price, market conversion price, minimum price for conversion, break even price is nothing but 120 divided by 5. 120 divided by 5. If the price touches 24, you are also paying 120 rupees. I am also paying 120 rupees. Any doubts till this? Different names are there. Some question will use conversion parity price, market conversion price, minimum price for conversion, break even price, price at which conversion can be done. Different terms can be used. Any doubts till this? Okay, last two more terms, then we do some question and then I come back to other areas. Any doubts till this? Okay. Now, I paid how much? How much did I pay for the debenture here? 120. You have paid how much? You bought shares. Okay. You bought shares. I bought debenture. I paid 120. You paid how much? 80. You are very happy about it. Then I say I am also happy about one thing. I will earn every year. I will earn every year 100 into 10%, 10 rupees. You will earn every year 20 paise into 5 shares. You will earn dividend. I will earn interest. You will earn dividend. I will be earning interest. You were saying that you paid extra. I agree, I paid extra. But wait. I paid extra. I paid how much? I paid 120. You paid 80. I earn 10 rupees. You earn 1 rupee. You earn 1 rupee. So this is called the gap. 10 minus 1 is called my favorable income differential. I earn extra. I earn extra. Favorable income differential. Favorable income. What is 1 rupee? 20 paise into 5 share. You invested in shares. Every year your bank account gives 1 rupee. Every year my bank account is credited with 10 rupees. One bond 10 rupees. 5 shares 1 rupee. 5 shares 1 rupee. The gap is called favorable income differential per bond, 9 rupees. One bond extra 9 rupees. You can also do one share, 9 divided by 5. 9. Everywhere you want to do per share divided by 5. I paid extra 40 and every year I get back 9 rupees extra. 40 by 9 is my premium payback period. 40 divided by 9. I paid extra 40, no? That extra 40 is coming back to me. In what form? Extra 9 rupees every year. I'll explain this again. I bought debenture. You bought equity share. You were saying you paid extra. I agree. I paid extra. I am agreeing to that. I paid extra how much? 40 rupees. Every year I get extra 9 rupees. 40 by 9 in 4.5 years. My money is back. In 4.5 years, that's called premium payback period. That's technically called premium payback period. Whatever extra I paid, I get it back. I get it back. I'll explain this here. Favorable income differential, extra income in bond as compared to equity share. Per bond, total income per bond minus total income per share into the conversion ratio. That is interest income minus dividend income. Let me put it very simply. Interest income minus the dividend income. The calculation is interest income minus the dividend. Interest income 1 bond, dividend income can be 10 shares, 15 shares, 20 shares, 25 shares. That difference is called favorable income differential per bond. If you divide by the ratio, favorable income differential per share. And if you bring it here, conversion premium per bond 40 rupees, favorable income differential per bond 9 rupees, 40 by 9 is premium payback period. You can do at a per share level or at a per bond level. Per share level or at a per bond level. With this, yes, my terms are over. One more thing to be discussed. I'll discuss that later. I'll again quickly revise this and then we start doing problem. First term we introduced was conversion value. What is conversion value? Value of the bond if conversion is done today. Value of the bond or value of the convertible instrument if conversion is done today. What is the formula? Current market price of equity share into the conversion ratio. Second term, conversion premium. What is conversion premium? Extra payment in excess of the conversion value. if you subtract per bond, divide by conversion ratio per bond, per share, and then you can also get percentage, which is dividing by conversion value, ideally can be divided by CMP also. Third is straight value, intrinsic value, floor value, minimum price. This is what we did in bond valuation for such a long period. For such a long period, we were doing this in bond valuation. This concept is what we did there, where present value of future cash flow without considering the concept of conversion. Downside risk means company not doing well, bond price from 120 crashes down to 100. That gap is called downside risk. You can divide by 100, you can divide by 120. Conversion parity price. If conversion is happening today, I would have been very happy if the share price is 24 rupees. If the share price is 24 rupees. Favorable income differential can be per bond, can be per share, can be per bond, can be per share. What is per bond? The calculation is interest income per bond minus the dividend income for 5 shares, 10 shares, 20 shares, 25 shares, whatever number. And if you divide by the conversion ratio per share, whatever extra I paid is numerator, whatever I receive every year is denominator, and my premium comes back in that many year without considering time value of money, ignoring the time value of money. Any doubts in any of the concept here? Any doubts here? Clear? Can we proceed? Any doubts on any of the concepts here? Valuation of convertible bond. Valuation of convertible bond. Now, what is valuation of convertible bond is, you did straight value sometime back. When you did straight value, you did as if conversion is not happening. As if conversion is not happening. What does valuation of convertible bond is? Present value of future cash flows discounted at investors' required rate of return. Everything is fine. One change alone, year 5, when I say year 5, last year will be higher of two numbers. The last year cash flow. What is last year cash flow? Redeemable value. Redeemable value. One, you can redeem it as debt and get 100 rupees. Or you did sometime back one straight value question where you took 1000 as it is. That is for straight value. But if you want to value the real bond, you have to estimate what will be the share price in year 5. How will you estimate? Maybe Gordon's formula. P5 is equal to D6 by Ke minus G, or Modigliani Miller approach. P0 to P1, P1 to P2, P2 to P3. If that you can estimate, then you have to find what will be the conversion value on the maturity date. What is maturity date? Last date. What will be the conversion value on which date? On the maturity date. If you get that number, higher of the two will be taken as conversion value. Higher of the two will be taken as conversion value. Year, cash flow, PVF, DCF. Year 1 interest, second year interest, third year interest, fourth year interest, fifth year interest, plus redeemable value or conversion value, whichever is higher. Redeemable value or conversion value, whichever is higher. In fact, one excellent question is there at CA Inter. I'm not that question. I have not drafted it here. I should have brought it at final itself, where they will give you first. They'll give you KE. What is the purpose of KE? What they'll give you beta. With beta, you will calculate KE. Then they'll give you some dividend data, past dividend data. You will calculate the growth rate. Using the growth rate, you will go to the 6th year dividend. Then you will do D6 by KE minus G and estimate what will be the price at the end of year 5. All that we have already done in equity valuation. So here, very simple, you have to estimate what will be the price of the equity share on the maturity date. How do you do estimation? I need not even discuss much about it. We have already done equity valuation. Let's see an example. Face value 1000. Rate of interest is, bond is convertible into 10 equity share whose current market price is how much? 80. Growth rate in equity share is 10%. What will be the terminal cash flow at end of year 5? This is the simplest way I can ask you a convertible bond. What is the current market price of the share today? 80. It will grow at what rate? 80 plus 10% for first year, plus 10% for second year, plus 10% for third year, plus 10% for fourth year, plus 10% for fifth year. This is my estimation today. Into How many shares it is going to convert it? 10 shares. So my terminal cash flow is higher of this number or 1000, whichever is higher, whichever is higher. Able to understand the concept? Concept is very simple. You have to estimate the share price at the end of year 5, year 10, year 15, year 20. Every year when I do the estimation, the numbers can change. Why it can change? Today 80 plus 10% for 5 years. Next year, excellent year, 80 could have become 120. Then 120 plus maybe 15% for 4 years. Whatever be the number, you have to estimate what will be the share price on the maturity date. What will be the share price on the maturity? Is it a new concept? No, this is done at CA Inter, something called as convertible bond. You could have done it, but may not have paid that much attention. So concept is very simple. I am going to calculate the expected share price on the maturity date. Expected share price on the maturity date. Once I calculate the expected share price on the maturity date, year, cash flow, PVF, DCF, first 5 years interest, fifth year principal or conversion value, whichever is higher, because I will have both the choices. Any doubts on this? Can we proceed? Last concept is decision on conversion. What is decision on conversion is, should I convert or should I continue it as bond and get it redeemed? Should I convert or should I continue it as bond and get it redeemed? Simple logic. By conversion, if I get more money, I will do conversion. By conversion, if I get less money, I'll continue it as bond. Example, current market price of bond is how much? One bond is convertible into current market price of share. If you convert today, 125 into 10, what will you get? 1250. Convert, sell it if you want. Convert and sell it if you want. 1250. Basically, compute conversion parity price. If the current market price is more than conversion parity price, very happy to do the conversion. If it's lesser, okay, the answer is wrong here. Okay, you may change this. Current market price is greater than conversion parity price, opt for conversion. I don't know, it got missed there. Current market price greater than conversion parity price, opt for conversion. It got interchanged. Okay, opt for conversion, and the other one is do not opt for conversion. Logic is very simple. Okay, so that's what I'm again saying, logic is only very critical. I have only drafted the chart, but maybe I made a mistake. If I don't understand logic, I would have said follow this. Understand logic, you will know where there are mistakes and all done. So current market price greater than conversion parity price, I'll be very happy to go for conversion option. Otherwise, I will not do conversion option. Any doubts on this? A small concept is there which is called enterprise valuation. Three concepts are there. I will discuss that now. I may still have time. If time is there, I'm going to revise the entire security valuation from the beginning. So let's now first discuss this enterprise value concept. Practically extremely valuable concept is this enterprise valuation. ICI, very limited testing is there, but in the recent exam, they ended up testing enterprise value in exam. There was one question on enterprise value which clubbed with other areas. They ended up asking enterprise value in exam. What is enterprise value? Is the value of the firm. In FM, the term owner means debt guy, equity guy, preference guy. So enterprise value means equity, debt, preference, minority interest all put together. Minus one item is there, cash and cash equivalent. Minus one item is there, cash and cash equivalent. You just need to know total enterprise value. Other two is not very critical, but still I'll discuss it. What is this cash and cash equivalent? Today, let's assume I acquire a company. When I acquire a company, I have to pay something to the equity guys, something to the debt guys, something to the minority interest guys. If they are there, I'll have to pay them also. But one thing I do is, after paying all of this, I can immediately use the available cash. available cash. So real value of the company which I'm paying is equity, debt, minority interest minus cash and cash. This is my outflow to acquire a company. Outflow to acquire a company is what? Equity, debt, minority interest minus cash and cash equivalent. What exam question may end up doing is they may give you EV, they may ask you to calculate equity. EV is equal to equity plus debt minus cash. You can keep it. Very simple formula. Minus cash. Preference may not be there. Minority interest may not be there. From the total enterprise value, if you remove, very rare, okay, non-operating asset data is there. That is called operating enterprise value. What is non-operating? Not related to operations of the company. From this, if you remove any non-core asset, you get operating enterprise value. You get operating enterprise value. I think ICI at best may test a total enterprise value, which is what I saw in one of the exam question. Some example, nothing much for you to write and all. Book value of equity 1000, no use. Market value of equity 2000, use. Reserves and surplus, no use. Value of debt, useful. Cash and cash equivalent 400. Equity market value, debt market value minus cash and cash equivalent. Equity, debt minus cash and cash equivalent. 2000 plus 800 minus 400. Enterprise value is given, debt is given, cash is given, equity. This is what tested in the exam. The exam ended up testing this. They gave enterprise value, but they gave you information to calculate enterprise value. From EV, you had to calculate equity. What is the formula? EV is equal to equity plus debt minus cash. EV number given here is 40 lakh. Equity number is what you are calculating. Debt number is 10. Cash is 5. What is the equity number you get? Sorry, 35. Any doubts on this? Clear? Very simple calculation. This got tested somewhere in the recent exam. If you look at the September paper, you will find somewhere a discussion on enterprise value. I can arrive at the enterprise value using some multiple. Like we have a P multiple approach. What is P multiple approach? MPS by EPS. Enterprise value can be arrived at by doing EV to EBITDA or EV to sales. EV to EBITDA or EV to sales. What is EV to EBITDA and EV to sales? I will give you EBITDA, multiply with the EV to EBITDA multiple, you will get the EV. Like I give you PAT, you multiply with P multiple, I give you EBITDA. What is EBITDA? Earnings before interest, taxes, depreciation, amortization. Very useful method in the practical world. EV to EBITDA approach. EV to sales approach means I will give you sales, multiply with EV to sales, multiply with EV to sales. Let's understand this. This area along with that other formula got tested in recent exam. Maybe I'll show you the question if time permits. EV to EBITDA is what? Enterprise value is equal to EBITDA into that multiple. PAT into P multiple. EBITDA into this multiple is called enterprise value. Example, Infosys 1000. EBITDA of Infosys is how much? So Infosys is at 4 multiple. 1000, 250, market is giving 4 multiple. For which company? Infosys. What will be the enterprise value of TCS? If EBITDA is how much? So TCS will be 50 into 4. TCS will be 50 into 4. Infosys is at 4. TCS will also be 50 into 4. I explained you that you can adjust the multiple using ratio. All that logic will come in the practical world. But for you, very simple discussion. Infosys is at 4 times. My company will also be at 4 times. EV to sales multiple of industry is 1.5. EV to EBITDA multiple of industry is at 5 times. Sales of ABC is how much? The enterprise value is 5,000 into 1.5. 5,000 into 1.5. Not a very critical discussion. 5,000 into 1.5. You get 7,500. EBITDA of ABC Limited 2,000. 2,000 into 5. 10,000. Average of the two. Average of the two is the final answer. Average of the two is the final answer. Any doubts in this? Just give me a minute. there was something like this: number of equity share, current MPS, 10% debt, cash and cash equivalent, gross profit, indirect expenses, depreciation, risk-free rate of return, market rate of return, beta of the company, and applicable tax rate. Equity value of the company if the EBITDA multiple is 4. If the EBITDA multiple is 4, so enterprise value is equal to EBITDA into 4. Enterprise value is equal to EBITDA into 4. And once you get the enterprise value is equal to equity plus debt minus cash and cash equivalent. ICI is yet to give the suggested answers, but this is what they should have ideally done. Can you read this data and tell me what will be EBITDA? EBITDA means before interest, before taxes, before depreciation. You look at the data. Straight simple only. What will be the number? GP minus indirect expenses 7 lakh. That is before depreciation, before interest, before taxes, everything. So EBITDA is how much? 7 lakh. EV is 7 into 28, and EV is equal to equity plus debt minus cash. This is what was tested in exam. It's a very simple calculation if you know what is enterprise value. But an area which is least preferred among the student, they may not pay that much attention to this, but it's a very simple area. So equity plus debt, is there a doubt? Equity plus debt minus cash. So 28 is equal to equity. How much is the debt? 2 lakh. Cash 5 lakh. This will give the equity value. Ideally, this should be the ICI solution. Yet to look at the solution. I'm not sure if they've released it, but if they release, in case there is any variation, I'll let you know. But this is the approach. EBITDA multiple will give you enterprise value. EBITDA multiple will give you enterprise value. P multiple will directly give you equity value because that is on PAT. PAT belongs to equity guy. EBITDA belongs to equity guys, debt guys. Everybody enjoys the EBITDA. So you do EV to EBITDA multiple and get enterprise value. From the enterprise value, equity plus debt minus cash and cash equivalent. Any doubts on this? This is what got tested in exam. This is the max they may end up testing. And they may ask something called as cash return on total investment. What is cash return on total investment? Is EBITDA. EBITDA is a non-cash, EBITDA is a item where non-cash item is yet to be subtracted. What is non-cash item? Depreciation. We are yet to subtract it. So EV by EBITDA. EV by EBITDA. EV is cash item. EBITDA is also cash item. If you do inverse, that is called cash return on investment. What is investment? Denominator, enterprise value. I am investing enterprise value in a business and earning EBITDA of that business. I am investing enterprise value of a business and earning EBITDA of the business. See, I have never paid that much attention to this area. In my class itself, I take only for 15 minutes. Practical world has a lot of utility. And I never expected ICI will test also, but they ended up testing in the September 25 exam. And the calculation, if you now see the answer, it will look very, very simple. There is zero computation issue. So small things, this is discussed in the ICI material. That's why I've kept it. 1 by EV to EBITDA multiple. EV to EBITDA multiple is 5 times. Return is 1 divided by 5, 20%. Any doubts in this? Any doubts in this? Now, what is money market instrument is those instruments which have a life of less than 1 year. Normally, when a company wants to raise money, we have till now learnt you can raise money in the form of equity, which is equity valuation, long-term money, debt, bond valuation, long-term money. But there is a need for short-term money, and that is where this instrument or this market comes into picture. Money market instrument is money market is basically a market for short-term instrument. Now, what will exam test us here is they will ask us to compute what is the cost of a money market instrument or what is the return of a money market instrument. If I invest, if I am the company, for me it is called cost, for you it is called return. There are various instruments available. I'm not going to discuss the theory angle as of now, but there are instruments like treasury bill, commercial bill, certificate of deposit, CP, multiple names are there. all of this you will see in the theory section. I'll explain what we do for theory later. But what we are trying to do here is we are going to compute what is the cost or what is the return of a money market instrument. Then the second segment, we focus on one specific instrument called commercial paper, where we do a detailed discussion. And then there are third segment where we discuss on an area called repo and reverse repo. These are the few pointers we are going to discuss in the session. Now, first point, yield of a treasury bill, other name is discount of a commercial bill, yield of a certificate of deposit, yield of a commercial paper or bond equivalent yield, basically calculating return. Formula is very simple. What I get back minus what I give divided by what I give into 365 by number of days. Preferable is always days calculation. Unless data is in months, we do days calculation. It will be less than a year. It will be less than a year. 365 by number of days into 100. What normally happens in a money market instrument is they will say face value. Face value is 1 lakh and the issue price will be something like 95,000. So 1 lakh is the maturity value, 95,000 is the issue price, divided by 95,000, do the number of days and compute the return. This is what the segment is going to focus on. Same formula can also give us issue prices balancing figure. The same formula can give issue prices balancing figure, where I will give you the return, you compute the issue price as a balancing figure. A small example, current market price of a treasury bill is 95,000. Current market price is 95,000, which means at 95,000 an issue can happen, or you can buy it at 95,000. Face value is 1 lakh, which means you will be receiving 1 lakh minus 95,000. Maturity value is 1 lakh and your issue price is 95,000 or your investment is 95. Divided by 95,000 into 365 by number of days, March 31, July 20. For days calculation, you can ignore one day and consider the other day. Ignore March 31, consider July 20, or ignore July 20, consider March 31. This is what normally will happen. So April 30 days, May 31 days, June 30 days, and July 20 days, ignoring the March 31st. Ignoring the March 31st, my number of days is coming out to be, maybe this is what it should be, April 30, May 31, June 30 and July 20. 111 days is the investment and we will compute the yield. We will compute the yield. This is one way. The other way around is I will give the yield and you will end up calculating the issue price. You will end up calculating the issue price. All these instruments are issued for a period less than a year. For a period less than a year. Let's see the second example. RBI sold 91 days treasury bill of rupees 100 with a yield of 12%. 91 days, 12% yield. What is the issue price? Right along with me. Example 104. Yield is equal to maturity value minus issue price divided by issue price into 365 by days into 100. Yield is equal to maturity value issue price divided by issue price into 365 by days into 100. The yield question as mentioned is 12%. If you do into 100 in the calculation, you should write 12 this side. And if you don't do into 100, then you should write 0.12. So this is 12. Maturity value is 100. Whatever is the face value will be the maturity. 100 minus issue price divided by issue price 365 91 100. The denominator goes to the other side. 12 into IP into 91, and this side we multiply 100 into 365 into 100 minus IP into 365 into 100. Issue price 365 100. We'll have to simplify this and get to the issue price number. So 12 into 91, 1092 issue price, 36 lakh 50,000, 36 500 IP is equal to 3650 divided by 37,592. This should be the number 37,592. 36 lakh 50 divided by 37,592. 97.10 is the broad issue price. After we are done, this is reverse working. We will do a forward quick check. 100 minus 97 divided by 97 into 365 by 91 into 100 should match the percentage given in the question. It should match the percentage given in the problem. Any doubts on this? Any doubts on the computation? Clear? Can we proceed? So either I ask you to compute this or we ask you to compute this. Now, whatever this formula we are using is technically called as bond equivalent yield. It's technically called as bond equivalent yield. But there is one mistake or issue with this formula. What is that mistake or issue? We'll understand, and which is where another formula also comes into picture. This is the formula we will mostly be using, but there is one technical issue with this formula. For example, my maturity is 100, issue is 90 divided by 90. Can you tell me what is the percentage here? Assuming it is into 12 by 6, you will say 22%. 12 by 6, 22%. 11.11 into 2, 22.22%. This is what we do. But the concept is there's something called as effective annual interest. What does effective annual interest is? Instead of doing 365 by D, we should do 1 plus R power 365 by D minus 1. Instead of multiplying, you should do 365 power 365 by D. What is this power 365 by D? Let's understand. I earn 11.11%. If I ask annual return, you will say 22.22%. In the calculator, do 100 plus 11.11% 2 times. My 100 become 123.45 and not 122.22. This is what reality will happen. If you earn 11.11% for first 6 months, another 11.11% for the next 6 months, 100 will not become 122.22. 100 will become 123.45. So in reality, the ideal formula is effective rate of interest is equal to, you would have learnt this maybe at even your 12th or in your foundation, 1 plus R by N power N minus 1. Now what is this 1 by R by N power N minus 1 is? Let's assume you calculate in the earlier formula 10%, earlier formula into 365 by D. After doing that, 1 plus 10% divided by, what is this division? How many times are we going to do compounding within a year? You may do compounding once a year, which means same answer you will get. You may do compounding twice a year. What is twice a year? Half yearly compounding. You may do compounding 4 times a year. You may do compounding 12 times a year. And you may do continuous compounding, which is called e power RT, which we will learn in derivatives. 1 plus 10%, assuming I do 4 times compounding in a year. Divide by 4, power 4 minus 1. If you do this, your effective rate will not be 10. It may go up to 10 point some number. It may go up to, can you give me the answer here? 1 plus 10% divided by 4, power 4 minus 1. 1.025 power 4, 10.38%. 10.38%. This is called effective interest, and logically this is the correct approach. Very rarely we use this in any of the problem solving. We normally do into 12 by M. When I did mutual fund, I said just do for annual return 12 by M, which is wrong. If you get monthly return, 1 plus monthly return power 12 minus 1 is the annual return. 1 plus monthly return power 12. If you have yearly rate, you want to know monthly rate, you cannot do divide by 12. You will have to do square root of 12. You will have to do square root of 12 and then get to the answer. But very rarely we use. Two reasons could be: one, we are not using financial calculators in exam, so maybe I say I didn't want to get into that, because square root of 12 times square root and all not possible in our calculator. So we normally end up doing 365 by number of days. You get an answer here. Bring that answer to this place. Bring that answer to this place and divide by n. N is what? Number of times you do compounding in a year. To put it very simply, you did that 365 by n, no? Reverse that 365 by n and take a power of that. Take a power of that. That is called effective. Higher frequency of compounding will increase the effective income of an investor. Will increase the effective income of an investor. Many a times in the practical world, when I create a FD, the bank will tell me it is 7% compounded quarterly, effective rate is 7.4%. Many banks give this data, 7% compounded quarterly. But when we take a loan, loan is paid monthly. If you pay monthly, it is technically monthly compounding. So when a loan is taken, your loan rate will be 8% per annum. Effective rate could be 8.5. They will not tell that information. The effective rate they will not tell. For loan, they will not give the effective rate. But for an FD, mostly they'll give an effective rate. So if somebody says I'm paying 2% for a month, 24% for a year, no, you're not paying 24% for a year, you're paying 27, 28%, because you have to do power 12 minus 1. Able to understand the concept? Most of the places we will be using the earlier formula. There are few places we will do power 12 minus 1. Now on the CP computation, this is a format we follow for an area called as compensating balance logic. Also without compensating balance, I may follow this approach. The earlier approach, what we did is we calculated the interest cost, added stamp duty charges, added rating charges, everything. The way we calculate, the solution can change a little bit. Okay, the answer can change a little bit, this approach and the other approach. Let me first explain what is compensating balance. Bank, in order to increase their income, use a strategy called compensating balance. What is compensating balance is, I took a loan from the bank. The loan amount is 1 crore rupees. Bank says, in this 1 crore, you need to keep 5 lakh with us. You cannot take that out. You cannot take that 5 lakh out from the bank. You need to keep it in the bank only. You should not take this. You can keep it in the form of current account, or maybe they'll allow even a fixed deposit. So what happens because of compensating balances? I take a loan of 1 crore, pay interest on 1 crore, but I use only 95 lakh. I use only 95 lakh. This indirectly will increase my interest expense. This indirectly will increase my interest expense. I wanted 1 crore rupee. Bank told take 1 crore and you can withdraw only 95. Or if I need 1 crore, I may end up taking a loan of 1.2 crore or 1.1 crore. With this, bank will increase their income. Only thing in practical world is whatever is kept as compensating balance, that can give you some income also. So whenever I issue a commercial paper, first I incur interest cost. What is interest cost? Face value minus amount raised. On top of it, I may incur a cost of placement, stamp duty, issuing and other charges, rating charges, total cost. This is one way of solving the question. What we did in the previous question, we calculated effective interest cost, added the rating charges percentage, added the other percentage, and gave a final answer. Other way is converting everything into rupees. Would both approach give same answer? No, slight variation can happen. When to follow which? No clarity is there. MCQ based question, we are done. But if it's a descriptive based question, it will be challenge. And if a question has something called as compensating balance, then only this approach will work. Okay, so I have an interest cost, I have a cost of placement, I have a stamp duty, I have a issuing and other charges, I have a rating charges. All of this I will pay. From the CP, what will I raise? Let's assume I raised 10 crore. In this 10 crore, I have to maintain a line of credit with the bank. What is line of credit is? Bank is saying you cannot withdraw 20 lakh rupees from your 10 crore loan which you have taken. That I deduct. If I'm paying upfront all expenses, upfront means on the day zero, if you pay, deduct all of that also. It says all cost other than interest, but practical world, sometimes interest is also paid upfront. Interest is also paid upfront. Interest should also be deducted in case there is a upfront payment of interest. What is the logic we are trying to establish here is very simple. Cost for a company is equal to all expenses, which is logical. Divide by effective amount raised on day zero. What is effective amount raised? 10 crore taken, 20 lakh compensating balance taken out, 1 crore interest also taken on day zero, 10 lakh rating charges taken on day zero, 1 lakh stamp duty taken on day zero. Remove everything which you have paid on day zero. If you are paying it on the last day, don't remove it, because logic is very simple. I went with the bank saying that I need 10 crore. He did all these fancy thing and handed over 8.5 crores to me. He deducted interest, he deducted compensating balance, he deducted stamp duty, he deducted rating charges, everything deducted, and ultimately I got only 8.5 crore. So my logic is very simple. Effective cost of CP is equal to total cost divided by effective amount raised. Effective amount raised. This in simple words is like maturity value minus issue price by issue price. It's like that, but not exactly that. Okay, maturity value minus issue price divided by issue price, because whatever you pay is deducted, and that is technically the total cost. That is technically the total cost. So total cost divided by effective amount raised, 365 by n or 12 by m into 100 is the pre-tax. If they ask post-tax, pre-tax into 1 minus tax rate, which is self-explanatory. Any doubts on this? Clear? Let's see this example. Face value of a CP is 100 lakh. Interest expense on CP paid upfront 4 lakh. So I wanted to raise 100. 4 is paid on day zero. Firm is required to keep balance in line of credit 5. Effectively, I will get only 91. Effectively, what will hit my bank account is only 91. On what am I going to pay interest? On 100. But what will come to my bank account is only 91. So 91 is the amount raised. My expense is 4. This line of credit is a refundable deposit. That is not my expense. 4 by 91 into 12 by m into 100. This is another way of calculating cost of CP. Both approach, the last question we did an approach where we calculated interest and added everything, or this approach ideally will give a very similar answer, but variation can still be there. Any doubts on this? And if there is a compensating balance in a question, this is the only way you can do. Compensating balance means what can happen in the practical world is in this 4 there will be a minus. What is that minus is? On that 5 lakh, no, I may earn some income. I may earn some income on that 5 lakh. Bank may pay me interest of some 10,000 rupees or 20,000 rupees, which can be reduced from my expense. From my expense, I can reduce the income which is getting generated, which is logical. I can go ahead and reduce that from the calculation. Any doubts on this? Can we proceed? Able to understand? Yeah. Okay, his doubt is whether the brokerage is on issue price or on face value. Ideally on face value, but it all depends on what the question says or what practically happens, but it's ideally on the face value for the these type of instruments. Any doubts on this? Can be upfront also. It depends. See, there are a lot of places where interest is calculated upfront by people. There are a lot of places where interest is paid on the maturity. How can I collect upfront calculation is I give a loan of 10 lakh. I tell you that 10 lakh, I deduct your interest and give you only 9 lakh rupees, you return me 10 lakh. This is upfront collection. I can do upfront collection also. See, as from an investor, I can do as an investor, I can deduct the interest upfront, or it can be a later one. It depends on the terms of the agreement. Again, I'm saying I have practically seen CP, interest is paid on the maturity, no upfront, no upfront. But if the terms indicate, it can be upfront also. That is why there is a note. It says all cost other than interest you subtract from your effective amount raised. Interest should also be subtracted in case there is a upfront payment of interest. In the MCQ which I did, I only created the MCQ, so I gave very clear clarity saying that upfront payment. Problem clarity may be there, may not be there. That assumption we take and proceed. A concept called repo and a reverse repo transaction are something called as a clean price and a dirty price transaction. Now let's understand what is this transaction all about. See, in the practical world, we have something called as a repo transaction and a reverse repo transaction. Not very critical for you to understand, but very simple point is a repo transaction is one where I take some money from the RBI, and a reverse repo transaction could be I deposit something with the RBI, something around that. Now, I am a bank. I am in need of money. I am in need of money. I need some 100 crore rupees. I have invested in 12% Government of India bonds. I've already invested. I've already invested in Government of India bonds. 100 crore investment is already done. When did I do? 1 year back, half a year back, sometime back, I've done this investment. After doing the investment, suddenly now I need money. One option, obvious option, is to sell this. But I was thinking, why should I sell this? Because government is giving me 12%. I went to another bank, asked them, can you give me loan? To a bank or to RBI. Okay. I went there, asked them a loan. They said, yes, we are happy to give you loan. We will give you a loan at 6% rate of interest. I became very happy because I already earned 12%. Why should I sell this? I can take a loan at 6%. But he will say, give me some security. Give me some security. So what I will do is, I will give this GOI bond as a financial security. I'll give this GOI bond as a financial security. This is just given to the other party. I continue to be the owner. I continue to earn the interest, but lien mark to that party. If I fail, then he will take that asset. Bank B gives me loan at the rate of 5%. Bank B gives me loan at the rate of 5%. What will happen? I gave them 100 crore. 100 crore is the face value. On this 100 crore, in the last 6 months, accrued interest is extra 2-3 crore. So 103 crore is the value. So I had 100 crore asset. Today the worth is 103 crore, including the accrued interest. Against this 103 crore, he gave me a loan of 101.5 crore. He deducted something called as a reserve or a margin. Practical world, nobody will give you full value. If you give 1 gram of gold for taking loan, today the value is 13,000, but they'll give a loan of only 8,000 or 9,000. Some reserve will be held back. So I gave 100 crore asset whose worth is 103 crore today, and they gave me 101.5. I continue to earn 12% and I have to pay interest at the rate of 5%. So after a period of 10 days, 15 days, very short period, okay, I have to return 101.5 plus interest at the rate of 5%. Plus interest at the rate of 5%. This transaction is called as a repo transaction. Very simple transaction. Two interest rates will be there in the question. One interest rate will be there on your financial security, which only you earn. Second, there will be a repo rate or the rate at which you have to pay interest. Now, in this, we have two things: clean price and dirty price. What is clean price? Is X interest. Dirty prices come interest. Clean prices X interest. Dirty prices come interest. Value without accrued interest. Value with accrued interest. In the above example, accrued interest will be 12%. Accrued interest will be at 12%. But I took a loan at what rate? I took a loan at 5%. That is different. This is different. Okay. Two things will happen. One, there will be a start proceed and there will be an end proceed. There will be a start proceed and a end proceed. What is start proceed? I gave you 20 lakh GOI bonds. Each GOI bonds dirty price. What is dirty price? Including the accrued interest is 102.5. Please pay me 20 lakh into 102.5. But he says, no, no, I will deduct some margin. I will deduct some margin. Then I have to repay this plus interest in my above example 5%. Interest in the above example, I have to pay how much? 5%. Able to understand this? Very simple transaction. To put it very simply, it is a transaction where I give some security. Only challenge comes is there will be two interest rate in the question. Sometimes students confuse themselves. Another example is I wanted loan from you. I gave you this calculator. Against the calculator, you have given me a loan. Calculator does not have any interest rate, so no confusion is there. But the financial security will have some interest rate in the question, and because of which you see two interest rate in a problem. Sometimes students confuse themselves with this. It's a very simple transaction. Give a calculator, take a loan of 20 rupees, return 20 rupees plus interest, take the calculator back. This is what is a repo transaction is all about. Any doubts on this? Question may ask you to calculate clean price, dirty price, start proceeds, end proceeds. Any of this can be there. I will first do a forward working question and then we do a reverse working question. This is a forward working study mat question. Let's see this. Bank A enters into a repo with Bank B for 14 days in 10% GOI bonds. 10% GOI bonds. So my financial security has a 10% interest at a rate of how much? 5.65% at a rate of 5.65%. There is a doubt what is initial margin. I'll explain as we do. At a rate of 5.65%. So I have to pay interest of how much? 5.65 for how much? 8 crore. Assume the clean price is 99.42. Initial margin 2%. Accrued interest 262. You are required to calculate dirty proceeds, dirty price, start proceeds, and end proceeds. Clear? Let's write. Dirty price is equal to clean price plus accrued interest. Clean price plus accrued interest. Clean price plus accrued interest. What is the clean price given in the question? Assuming face value 100, okay? It's very close there. 100. What is the rate of interest on my security? 100 into 10%. How many days? No. Accrued interest is how many days? 14 days is my loan. So don't confuse that, okay? Loan is different and security is different. How many days? 262. Question has specifically said 360 days. Give me a 2 decimal final answer. Specific 360 word is there, okay? 106.70. Now I became very happy. I have security worth 8 CR, which is face value understood to be, but the value of that is more than 8 crore. Reason is accrued interest. Reason is accrued interest. And I didn't want to break this chain of interest earning. I want to earn interest at 10%, but pay loan at the rate of 5.65%. Pay loan at the rate of 5.65%. Next, start proceeds. Start proceeds. First leg. This is called first leg of the transaction. 8 crore divide by 100. 8 crore divide by 100. 100 is the face value. Into 106.7. Okay, there is an initial margin given which is 2%. What is initial margin is very simple. I will not give you full loan. I will deduct 2% and give you the loan. Is that my income? No, that's not my income at all. I'm giving you a lower loan. I'm just giving you a lower loan. Do this and deduct 2%. Deduct 2% and this is the loan I will give you. I'll give you a lower loan. ₹8 crore, 36 lakh. I could have ideally got a loan of 8 crore 53 lakh rupees, which is including the real value is 8 crore 53. But question is saying no, 2% margin. In the practical world, when you go to a bank for a loan and all, no, they do 25% deduction. For the asset value, they'll deduct 25% and then only give a loan. This is among the banks. Comfort is there. That is why this is coming 836. End proceeds. End proceeds. Second leg, 836 plus I have to pay interest on this. Plus I have to pay interest on this. Very simple transaction. I have to pay interest on this. How much interest? 836. How many days we are taking the loan? 14 by 360. At what rate? 5.65%. I take a loan at 5.65%. Loan is taken at 5.65%. Any doubts on this? Able to understand this? Fairly simple, straightforward calculation. What is the return amount? 8 crore 604. The calculator is worth 8 crore 36 lakh and you have returned 8 crore 38 lakh. That is what this transaction is all about. This is what repo transaction is all about. Any doubts on this? Clear? Can we proceed? Initial margin, as I said, is nothing but it is a deduction done on day 0.